Good morning. It is 9 a.m. on Wednesday, January 26th. This is Yahoo Finance Live. I'm Julie Hyman. That is Brian Sozzi. Let's take a look at what's going on with the futures here this morning. It's been suspenseful every morning coming in and figuring out where the market is going to go over the course of the session, as we have seen some wild swings here. This morning, things are in the green. Nasdaq futures pointing to a gain of 2.25% at the open. S&P futures up 1.5%. Dow futures up 1% as well. We've got a Fed meeting that's concluding today. We'll be talking about that in just a moment. Of course, that could determine where stocks go by day's end. Meanwhile, nothing but blue skies. Microsoft shares rally after its forecast shows that growth in its Azure cloud business is set to continue, perhaps with the same momentum. The shares are up by nearly 6%. Happily ever after, Elsa reunited with Barbie after Mattel wins back the license to produce Disney princess toys. The shares of Mattel are rising. And it's electrifying. Sozzi had the chance to catch up with Ford CEO Jim Farley about the company's electric vehicle future, from wine country no less, even as Farley warned about persistent supply chain issues. You will see that interview a bit later in the show. But first this morning, we have to talk about the markets and what we have seen over the past few sessions here, where, as I said, you never know from one moment to the next what was going to happen in terms of where stocks were going to be headed. And Brian Sozzi, the setup today isn't any different from a fundamental basis than it was yesterday or the day before in terms of news flow necessarily, except for perhaps Microsoft influencing things positively. But other than that, not much has changed here, except perhaps, I don't know, some selling exhaustion, if you will. And so we have seen the major averages really tumble over the past few days, particularly the Nasdaq. And now we're seeing a number of strategists come in and say, too much. It's time to come in here and maybe do some buying.
Yeah, and that's one thing that has changed, Julie. We have not seen that, I would argue, over the past week and a half or so. We've seen a lot of bear market calls. I'm looking right at Morgan Stanley's Mike Wilson, who came on our network last Friday and basically predicted this latest plunge down in markets. He was looking for another 10% correction. The mood a little bit different today. Goldman Sachs out this morning, Peter Oppenheimer, one of my favorite analysts or strategists out there on the street, coming out with a very interesting note here, suggesting that now might be a good buying opportunity for longer term investors. His basic call to me, Julie, sounds just like a valuation call that stocks have come down too hard, too fast, even when considering we're looking at a couple interest rate hikes later this year. Now, Oppenheimer joins the likes of JP Morgan and Citigroup with also out notes this morning suggesting investors may want to step in here and buy that dip. And when these heavy hitters speak on the street, these heavy hitters are essentially providing guidance to trading desks, aka the folks that move these markets. So in light of these calls, I'm not surprised to see the futures here perking up a bit.
Yeah, and there are a number of strategists here. I think you mentioned Citigroup saying this as well. Wells Fargo earlier in the week, actually on Tuesday, saying it was time to put new money to work. Not everybody is positive. The folks over at Barclays are saying that mutual funds and retail investors are still, quote unquote, very overweight equities. So we could see some more downside in the markets. But by and large, as you say, we're seeing a lot of those folks come in and talk about buying. I do want to talk a little bit about the setup on the bond market side as we go into today's Fed meeting, which again, we're going to talk about in just a minute, because as I say, fundamentally, nothing has necessarily changed today. And as you can see, yields have actually come down over the past few sessions. So that's not been the thing that has been fueling the sell-off in equities, even as folks have cited the Fed as a reason for the equity sell-off, Saz.
Yeah, no, listen, I appreciate these calls by the street, Julie. I totally understand where they're coming from, but we can pull up this chart. We just showed it. It is the world market cap compared to global GDP, and you still get the sense, even though you have these calls and you're having some folks out there in the streets kind of strike an optimistic tone on stocks, the valuations on many markets are still well above historical norms here. So I appreciate what they're saying. And there's that chart right there. You can still see, just given where GDP is now around the world, it is decelerating. Valuations for equities in many markets do remain inflated.
Yeah, Well, we'll see how it plays out in the coming days. All right, let's bring in our Brian Chung because we keep alluding to the Fed, or at least I keep alluding to the Fed. Here he is, Brian Chung, talking about what we could hear from the Federal Reserve today. We know there's not going to be any change in rates today. Really, we're looking to the language to try and figure out what's happening next. I mean, is there even a chance today that we start to already get some balance sheet roll off, or is that too early?
It's probably too early for that, and it's also too early for interest rate hikes, and that's because the Fed wants to make sure they clearly communicate to markets exactly what they should be expecting as they do eventually tighten policy later this year. But again, that meeting expected later this afternoon in terms of the announcement. So let's take our three big takeaways, if you will. I'll call them our FOMC3, our Federal Open Market Committee, three questions that I've got. And the first is, 3, 4, 5, how many rate hikes are we going to get this year? Do you get it? The little boot for hiking boots? Anyway, the point is that a lot of people on the street are guessing, are we going to get 4 interest rate hikes this year? Are we going to get perhaps less or more than that? And even though we're not going to get a new set of economic projections from the FOMC in this meeting kind of showing where interest rates could go over the next few years, what we will get is a press conference from the Fed chairman at 2:30 where he could either add some kind of credence or throw a little bit of water on the calls that we're seeing on Wall Street for more or less aggressive rate hikes over the course of 2022. Certainly something to watch. But the number two question that I have in my FOMC3 concerns the Federal Reserve's balance sheet. When will the balance sheet run off? You get it? The person running. The idea right now is that the Federal Reserve has a $9 trillion balance sheet. And right now they're in the process of bringing any asset purchases that have been further expanding that balance sheet to a full stop. They plan on having that done by mid-March. But the question is going to be, at what point down the line do they then start actively allowing its balance sheet to shrink instead of going up, starting to come back down? Well, some of those on the street are saying that could happen sometime in the summer, perhaps in July, or maybe around the Federal Reserve's August Jackson Hole conference. Now, if the Fed does follow through on that later this year, keep in mind, contracting the balance sheet would actually give the Fed a little bit more flexibility to raise interest rates less to quell inflation, and that's because of the effect of higher term, longer term rates. But my number one question is really all encompassing those first 2 points that I had. My number one FOMC3 question is simply, when does inflation go down? And that's because the Federal Reserve has messaged very clearly we should continue to expect to see eye-popping readings on year-over-year inflation in both the consumer price index and the PCE index, the other reading of inflation. Now, depending on how fast or slow those inflationary numbers start to come down and eventually what they come down to is going to be very important for the Fed and how aggressively they want to start tightening policy through balance sheet runoff and eventually raising interest rates. That's going to be commentary we'll get from the Fed chairman at 2:30, which, of course, we'll have the full coverage of right here on Yahoo Finance.
Brian, a very busy day for you, I'm sure. You know, I've seen some, or I've just heard some chatter this week on the street. A lot of folks starting to say that it is a good thing the Fed is raising rates because it signals the economy is in a good place. But is that the right read? Because we continue to get a lot of reads to suggest that the U.S. economy and global economy are decelerating.
Yeah, well, I mean, that's underscored by the conversation that we had yesterday with the IMF, which actually downgraded expectations for U.S. growth this year. But on the other hand, everyone that you talk to, most economists would say, well, of course you're going to get a slowdown in the economic pace of recovery. And simply that's because of the rapid bounce back that we got over the later parts of 2020, 2021, and now 2022. So, of course, you're going to see a bit of a downshift from the very large quarterly GDP numbers that we had gotten. Keep in mind, we're going to get another print on Q4 GDP not long from now. But, of course, the question for the Fed is going to be this Goldilocks situation where you're tightening your policies into economy that's going to recover and continue to recover, but not at a speed that would abruptly end that recovery. And I think that when you take a look at the shape of the yield curve, you are seeing a little bit of doubt on behalf of financial conditions that the Federal Reserve can rapidly raise interest rates without triggering an abrupt end to this recovery. Now, the Federal Reserve, for their part, has insisted, well, even after we raise interest rates and even when we start to let the balance sheet shrink, by and large, that could still be below the natural pace that the economy can stand in terms of higher interest rates, where actually it will continue to be accommodative, even if the federal funds rate is 50, 75, 100, 125 basis points higher than it is right now. But of course, the Fed might prefer a steeper yield curve to be hiking rates into. that would allow the Fed to kind of get a little bit more of a metering stick on the economy to say, actually, things are in that Goldilocks position where it's not too much or too little for you to start raising rates.
All right, Brian Chung, it's a tough needle to thread, if you will. Appreciate it. Well, much like perhaps growth is slowing globally, but it's still growing pretty well. Microsoft brings me to Microsoft and Azure, which is where a lot of the focus is with the company's business. The shares are up 5% this morning. Azure, of course, its cloud services business, growth last quarter 46%, which sounds pretty good. There was a little disappointment initially that it wasn't as much as the 48% reported the prior quarter, but then investors took heart when the company came out with a forecast for sales growth of $48.5 to $49.3 billion in the current quarter, which is ahead of where they had estimated. And you can see here also, of course, we had a beat in the prior quarter. Really, we saw gains in sales across the board, not just in the cloud services business, but also in Windows, actually, because of demand for PCs right now that has been hot during the pandemic. Gaming revenue up 8% as well. And of course, that's without the benefit of the Activision acquisition, which is likely going to take a while to close in any case. So, Brian Sozzi, it seems like here it is interesting, this sort of turnaround that you saw in the shares after the forecast came out. But it seems like there's a relatively high degree of confidence here that Microsoft continues to have a relatively rapid growth rate.
After those earnings hit the wires, Julie, the stock was trading down, and you thought, wow, the world was ending. Microsoft, the great Microsoft growth story is slowing down. The stock's going to go way down. But there you have Microsoft and CEO Satya Nadella. As you can imagine, this is as you can recall, I should say, this is our company of the year for last year. He went on the call and said, hey, our growth is strong. People are rebuilding offices in this work from home environment. Our team's business is strong. You had CFO Amy Hood hop on the call and say, look, we're looking for a sequential or quarter over quarter acceleration in Azure cloud services. That quieted down any concerns that has reached peak growth. And a couple notes I jotted down, Julie, here. One, is this quarter from Microsoft, which was strong across the board, pretty strong guidance here from the company, will it help really set a short-term bottom in tech shares? Because immediately the way one should be thinking is, well, Salesforce, that stock has been sold off very aggressively. Will they come out and put up a good quarter? You had Satya Nadella talk about a great PC renaissance on the earnings call last night. Well, does that mean the quarters out of HP and Dell are going to look pretty strong? I would suggest that they will look pretty strong. And then secondarily, let's go back to that Netflix quarter, Julie, on Friday. Does Netflix now represent the outlier in tech where growth is slowing sharply and they're coming out here with the cautious outlooks? It's something to think about.
Yeah, I think you make some good points there in terms of whether this represents at least a short-term bottom in this tech selling cycle, particularly software selling. But I don't know that you can put Microsoft and Netflix in the same basket in any case, even though they're both large cap tech companies, just because Netflix is so consumer facing and Microsoft's business is much more enterprise facing. That said, Netflix is bouncing along with other tech stocks here this morning. So
of course
it does seem like that there is, just like we were seeing a lot of wholesale selling, we could be seeing a more broad-based rebound, particularly in technology this morning. All right, we're going to take a break. When we come back, stock futures are higher this morning. Refreshing to come in and see that. Let's talk about next whether it is time indeed to come in and nibble at tech here. We'll be right back.
After a volatile few days in the markets, the question is similar among many investors: buy, sell, or hold. Let's explore this more with Advisors Capital Management Portfolio Manager Joanne Feeney. Joanne, nice to see you. Thanks for taking some time here. Look, we were just talking about these Microsoft results, and you've covered the tech industry for some time. Is there enough juice in this Microsoft report and their outlook just to settle markets down here a bit?
Well, it certainly helps. I agree. Good morning. Microsoft obviously is a bit of a bellwether. It's giving us a really strong signal, though, on the continued strength of demand in the cloud computing space. And that not only is a positive signal for Microsoft, but for other suppliers into data centers that enable the cloud, whether it's a Broadcom, or the software suppliers. It also signals continued strong demand for cybersecurity. And given the tech pullback we've had, we've seen now a lot of valuations come in that is really creating a pretty good opportunity for, not just a conservative investor looking to the long term, but also for the more aggressive growth-oriented investor, because, some of these opportunities have become extremely attractive after these pullbacks.
Joanne, it's Julie here. And I'm curious, as we talk about these growth stocks, what growth is going to look like in the coming year. Most of the discussion around the tech companies has been around margins and valuations and not so much about actual growth. So I guess, what do you think the pace of growth is going to be like for large cap tech going into the next year?
Yeah, Julie, that's exactly the right question to focus on, because, with all this chatter about what's the Fed going to do and what are, rising interest rates going to do to the broader economy, you really have to look at sort of two different segments of the economy. Yes, growth is going to slow down from last year, naturally, because we had that recovery from the worst of COVID, really, pumping up the numbers last year. Going forward into this year, companies like Microsoft, Broadcom, Apple, they still have very strong drivers in place, and they should be among the fastest growers in terms of revenue and earnings. And that's why we think that these valuations really do start to turn around and come back up after what we saw really was a reset because of the expectation that interest rates would move higher. I'm not going to try to put a number on that. Companies are very different depending on which end markets they're in. But, low double-digit growth for some of these would not be surprising. And that's a pretty good environment for the tech investor right here.
Joanne, in terms of just pure market mechanics, just with the action we have seen this week, are you seeing any buy signals in the market?
Yeah, that's a little bit of a trader type question. What we're seeing in terms of signaling, I guess, is more of a dislocation between intrinsic value of some of these companies that have pulled back 20%, 30%, 40%. And, those valuations. And so, yeah, in terms of an investor looking for a great way to position for, appreciation over the next 2, 3, 4, 5 years, there's clearly a buy signal here among some of these stocks, whether it's, again, something like Microsoft that has pulled back sharply, and Apple and Amazon, for example. We do think that separation that we're seeing between intrinsic value, their ability to grow, their ability to continue to increase profits over time, is a pretty attractive opportunity for the longer term investor. I don't know whether we're done with the sell-off. We're going to see what the Fed says today. I don't think they're going to shock us, really. But clearly we're in a period of elevated uncertainty, and that means more volatility. So while we think it's a good idea to stay exposed to tech and perhaps increase your tech exposure at this point, we do think it could be a little bit of a bumpy ride between now and, say, 6 months or a year from now. But that shouldn't dissuade the long-term investor at this point.
And Joanne, we keep showing Broadcom, which is, I guess, a deep tease to say that you like shares of Broadcom. So when we talk about tech, why semiconductors specifically, and then why Broadcom even more specifically within that sector?
Yeah, we like that space for a couple of reasons. Number one, obviously, semiconductor companies have been trying to increase their capacity because there's such strong demand. And what's different now than, say, 10 or 20 years ago is that semiconductors sell into so many different end markets that it's created a broader based demand environment. And so, not just cars and automated features in your home, factory automation, just consumer electronics just everywhere. So that creates a broader based demand environment, which is really positive for the companies, and it has damped down volatility in their sales and earnings over time. So we do like the space. Plus, we're seeing more capacity come online this year. Starting in the middle of the year, more factories will be up and running, and that's going to create greater capacity for them to generate sales and profits. Broadcom is an even more diversified company because it has software, it has storage that it sells into, it has security software as well, and it's selling into enterprises and cloud. And right now, enterprise demand is really rising. They got constrained last year because of COVID. They couldn't do a lot of the spending and improvements of their IT infrastructure that they wanted to do. And now that's starting to come back online. And in addition, Broadcom sells into the iPhone. And that's, we think, a place where they continue to get more and more dollar content year after year. And it's something that we think is going to really boost their earnings over time. So it's relatively stable. It has very good end markets it sells into. And also for folks that like to have a little bit of a dividend, the dividend yield is pretty nice compared to the S&P as a whole.
Well, staying on this theme of diversification, Joanne, you also like BorgWarner. What's the play there?
Right. So back to semiconductors. So the auto industry, as we all know, has been constrained in their ability to increase the supply of cars because of a lack of chips. And now with more and more of that chip capacity coming online, there's going to be more ability to produce those cars. And BorgWarner is really appealing because it sells drivetrains and other features that improve the fuel efficiency of cars and the power of cars for fuel efficiency and for pollution controls. So it's an area where all the car manufacturers are moving towards. So just increasing car manufacturing helps them. Moving towards more efficient cars helps them. And they're also positioned to supply more and more over time into electric vehicles. So we really like positioning in that. And, the stock has not done as well as we think it's going to over the next couple of years. So good opportunity to get exposure to what looks like a structurally growing area.
Interesting picks. All right, we'll leave it there. Advisors, Capital Management Portfolio Manager Joanne Feeney. Always good to see you. We'll talk to you soon. All right, coming up, Mattel shares are on the move after a big Disney license win from rival Hasbro. We'll have more on that and a dive into some key earnings reports straight ahead.
What goes down must come up, I guess, is the principle under which we're operating today. We've got the futures indicating a higher open after some pretty intense, wild swings over the past several sessions and a lot of selling as well. Nasdaq futures indicating a gain of 2.25%, and we've seen pretty high level of consistency in the future since we got underway here this morning, which has been unusual. All right, let's talk about what's going on with some individual companies as well. Maybe this does go for Boeing too, Brian Sozzi. I don't know. That's what you thought I was talking about at first.
That's tough.
Boeing out with its numbers this morning and had a surprise free cash flow reading for the first time since 2019, $494 million in fourth quarter free cash flow. Analysts had been looking for negative free cash flow of about $1 billion. So that was better than estimated. But overall, the numbers otherwise not looking fantastic. That's even as Boeing has been producing more 737 MAXs, now 26 jets a month, up from 19 back in October. That's according to a note that CEO Dave Calhoun sent to employees. So the recovery is happening. It just seems to have quite a long ways to go, Saz.
Yeah, I'm just rolling through or just looking through these analyst takes. Our very own Jared Blickery just passed onto our digital desks. One caught my attention. Benchmark analyst Josh Sullivan, he's still buy rated on Boeing, calling this quarter a bit of a kitchen sink quarter here. But look, you're seeing the stock really volatile here in the pre-market. The fact is Boeing lost a lot of money, a lot of uncertainty around the MAX, a lot of uncertainty around the outlook for the 787. And until investors get more clarity on this and a sense of stability, it's going to be hard to get very excited about this, Doug.
Yeah, it does seem that way, even as the company talks about relaunching in China and seeing revenue there once again. But again, kitchen sink sort of implies that this is perhaps the worst it's going to get. At least that's what that used to mean. But the stock is not trading as though that's what he means in this particular case, right? You would expect to see it up more if people thought this was sort of kitchen sink in the sense that they're throwing it all in and things are going to go up from here, right? Traditionally, that's what that kind of comment would mean.
Yeah, it's been a tough, Julie, it has been a tough 2 years. Just optically, looking at the core loss per share for Boeing in 2021, $9.44 a share. The year before that, of course, when everything hit the fan with them, with the MAX, they lost $23.25 a share. That is the core loss, or excluding any one-time items. It just shows how much Boeing has struggled over the past 2 years, has struggled last year, and will likely struggle just to regain a lot of the bulls on the street that had liked Boeing before the past few years of operational messes.
So there's the opening bell on your Wednesday, and Boeing's a little bit of a bump notwithstanding. Overall, it looks like we are going to have a higher open here this morning. Will that remain intact through day's end? We'll see. A lot of that is going to depend on Jay Powell and company and that Federal Reserve announcement and then press conference this afternoon. The announcement coming at 2, the press conference coming at 2:30. Our Jared Blickery is standing by for that. First, he's standing by for us here with this morning's action. Good morning, Jared.
Good morning, Julie. And let's go to the Wi-Fi Interactive, where I am looking at the S&P. Of the bond market, where it looks like we have the 10-year T-note yield up a whopping 1/10 of a basis point. So really not pressure as well. So let's take a look at the heat map here for the Nasdaq 100. We're also going to get into some sector action. And look at this, Microsoft up 5.8%. Really interesting price action last night. I was watching the earnings release when it happened, and Microsoft sold off 5%. There was no guidance at the time at the announcement, but then when it was given during the presser, or not the presser, I'm thinking FOMC now, when it was given during the conference call, really shot up on that announcement. You can see all these software names really just going up in sympathy. Datadog is up almost 8%. Mondo is up 6%. Twilio almost up 6%. So you take a look at what's happened over the last 2 months, still a lot of room to claw back here, but nice to see some action in these guys right here. And as far as the Chair Powell presser today, all he has to do is walk back a little bit of the quantitative tightening. He doesn't have to say anything about the actual announcement, anything like that. I think the markets will run with that, but he has to deliver.
We'll see, won't we? All right, thanks so much, Jared. There's actually some suspense today. There's not always suspense surrounding the FOMC, but I'm liking a little suspense.
Well, let's create some, Julie.
Of unexpected stuff. No, there is suspense this time. We don't know exactly what he's going to say. All right, let's talk about some other earnings reports real quick. Let's start with Kimberly-Clark. That company coming out with guidance that trailed estimates. This is after, you see the shares are down about 5.5%. The earnings last quarter actually beat estimates, and sales did too. Sales were up 2.7% last quarter, so it's really the forecast here that is to blame for what's going on. Earnings per share this year are going to be at most $6. Analysts had been looking for $6.72. So that beat last quarter and the fourth quarter, less relevant, I guess, when it comes to where the shares are trading today. So some of this has to do with costs. Of course, the CEO saying we expect inflation and supply chain disruptions to persist into 2022. We are committed to recovering margins to pre-pandemic levels over time, though, and we're optimistic about gradual recovery later in the year. I mean, we'll see. It doesn't look like that there is a lot of that optimism baked into those numbers.
This quarter didn't do it for me, Julie, at all. This is just another challenging quarter from Kimberly-Clark, which is, I would say, challenging quarters from this company were the hallmark or just consistently happened last year. I want to highlight two numbers. One, in this quarter, since inflation is going to be top of mind today with the Federal Reserve meeting, Kimberly-Clark noting they had $530 million in input cost inflation in the fourth quarter. For all of last year, $1.5 billion in input cost inflation. That is major money that is weighing on Kimberly-Clark's operating profits here. They're forecasting even more inflation in the hundreds of millions of dollars this year. So they're going to have to push through a lot of price increases on toilet paper and other products here just to help alleviate those pressures and just support margins here. But look, the way to play this space, it has been proven out the past year. If you're inclined to play consumer products and that stay-at-home trade, it is Procter & Gamble. Procter & Gamble's results, stack those up alongside Kimberly-Clark, and they continue to be very striking.
Consumer products-wise, I guess more discretionary consumer products, toys, bad segue. But anyway, let's talk about what's going on with Mattel here this morning. The shares are up by almost 7%. And Hasbro and Mattel has sort of ping-ponged back and forth the Disney rights over the years. Mattel winning back that license this morning. Disney princesses and the Frozen movies are what they're getting in this deal, this multi-year global licensing agreement. The new collection going to go on sale at the beginning of 2023. It lost these rights, Saz. I didn't realize it had been so long, back in 2016. So obviously this is a big deal for them.
Big deal, and this is a big win for Mattel CEO Anand Kriz, who's been a frequent guest on our airways. He has led a complete transformation of Mattel, cut out hundreds of millions of dollars of costs, realigned the business here, and he has a strong resume with content and studios and filmmaking. And I think this deal is really indicative of all those things coming together, where he can reach out to Disney and say, hey, guys, we are running a tighter ship here at Mattel. I am also rolling out more new content. Let's get this brand, this key brand, back in-house. Now, Stephanie Winsink, also a friend of the show, analyst at Jefferies, sending me a note just now. This business could add about $250 million in revenue for Mattel once these dolls start to be made in 2023. Now, while it's a loss for Hasbro, let's keep in mind Hasbro is a very diversified company. They did come out today saying that they won a Indiana Jones toy license from Disney, very key. They're also in the content business as well via an acquisition they made about a year and a half ago. So the battle is on. The battle is on.
Yeah, I'm curious, who has the Encanto rights, right? That's that newer hit movie from Disney. Because I don't know, like, does the protagonist there, does she count as a princess? She's not really a princess, but the song associated with that movie has been a huge hit.
I'm more of a He-Man license, and I believe Mattel relaunched that last year. So I picked up a couple of He-Man dolls for my nephews, and they really liked it.
All right, you got to do that Encanto research for me, please, and
Okay.
report back, Saz. Quick check on Microsoft here before we go to break, since that is the big earnings report really of the day that folks are reacting to, and that's giving a little bit of a lift, I think it's safe to say, or at least an excuse to buy for folks who were looking at some of these battered tech stocks. The shares up 5% here. And also, as we go to break, want to check on shares of AT&T. And that's because coming up next, we're going to talk to Craig Moffett of MoffettNathanson about the company's numbers, which beat estimates. The shares trading down by 0.6%. We'll be right back. AT&T, as I mentioned before the break, was out with its numbers this morning, and by and large, those numbers beat estimates, at least if you look at earnings per share, 78 cents on an adjusted basis, beating estimates. It looks like the company's forecast for this year as well leaves it room for it to beat estimates. It was pretty much in line. The shares, though, are down by 1.1%. Let's bring in Craig Moffett, MoffettNathanson co-founder and senior analyst, to make some sense of this. I mean, it feels like it was sort of another maybe noisy quarter from AT&T. There's a lot of outstanding issues, including what's going on with Warner Media. There's the 5G rollout that's sort of hanging over them. What did you make of the results overall?
Yeah, look, thank you for having me on, by the way. It's very hard to make sense of these numbers because there are so many moving pieces. Remember, they have divested DirecTV. They're in the process of divesting Latin American DirecTV under the name of Vrio. They've sold their advertising business. They're waiting for the close of the sale of all of Warner Media. So there's so many different pieces that when you look at the numbers initially, the as reported numbers for any category, you're not really seeing a picture of what the company is going to look like. Cut through all the noise, and what you're left with is a company that on a pro forma going forward basis, just what's going to be left after all the divestitures, you've got 0.0% organic revenue growth, and you've got 0.0% organic EBITDA growth. In the most inflationary time that we've had in macro economy in decades.
So Craig, 0% growth to me as a former analyst, I don't want to hear that. That does not sound good. What is management? No, what does management need to do? How do they get investors after they spin off these assets? How do they drum up enthusiasm for the stock?
I have no idea. Because look, right now the wireless business, to be fair, is doing better, right? It's at least growing revenues 4.6% service revenue, which isn't terrible. All that's coming from subscriber growth because they're being very promotional. So ARPU, or revenue per user, is actually down a little bit, again, in a very inflationary environment. So the wireless business isn't awful, but if you look forward, they're going to have a network disadvantage relative to T-Mobile. And T-Mobile not only will have a better network, but it also has much lower prices. And you're competing against the cable industry that's now offering wireless at much lower prices than AT&T. So it's hard to be particularly optimistic about AT&T's growth prospects in wireless. And the rest of the business is worse. The wireline business, the commercial wireline business that nobody pays much attention to, but it's 22% of the business after the Warner Media spinoff, is now shrinking at more than 5% a year. You can't outrun that. That's shaving 100 basis points off of top line growth. And the consumer wireline business that gets a lot more attention with fiber is also flat revenue and shrinking EBITDA. So again, it's just really hard to find anything here that's likely to get people excited.
Well, speaking of things to get people excited, I'm going to lump together AT&T and Verizon for just a second, because 5G was supposed to be the greatest thing since sliced bread, right? And this was the thing that was going to get consumers excited and get them signing up. And it hasn't really felt like it's worked out that way, Craig. What happened?
Well, first, to be fair, 5G was and probably still is more about enterprises than it is for consumers. It's nice as consumers to think about how fast our phones are going to download data. But the value proposition for consumers is a little squishy. So there was supposed to be a lot in 5G for enterprises. Things like IoT or Internet of Things with thousands and thousands and thousands of small devices connected to the net, private networks for factory of the future, and people talked about autonomous vehicles and things like that. The problem with most of those enterprise fantasies around 5G is that they all bring different competitors to them. And mobile edge compute is one of the sort of buzzwords around 5G wireless. Mobile edge compute is essentially what it sounds like. It's computing out at the edge of the network. Well, if that sounds a lot like cloud, it's because it is a lot like cloud. And so you have to ask yourself, are Verizon and AT&T going to compete successfully in that business versus Amazon and Microsoft? Probably not. In private networks, the problem is, well, they're private networks. They are essentially more akin to a Wi-Fi network for an enterprise than they are for a public network. And therefore, they're probably not significant revenue pools for the carriers. So 5G maybe is a little bit less exciting than people would have hoped for consumers. But I think the real issue is whether there are real revenues for businesses. And that, to me, is a bigger question and still very much a question.
And in a recent note, to go back to the issue of pricing, in a recent note, you wrote about that really more than 5G right now, the issue for these carriers is these price wars that you alluded to. I mean, is it a better time to be a consumer of wireless service now than it has been in a long time because of this? And how long is that going to last?
Well, look, when Sprint and T-Mobile merged, the thesis for the industry from a lot of people was, this is fantastic. We're finally going from 4 competitors down to 3. That should be good for pricing. Unfortunately, we're not really going from 4 competitors down to 3. We're arguably going from 4 competitors up to 5. The cable industry has come in and is now stronger and more competitive in wireless than Sprint was. So there's probably been a net intensification of competition. And Dish Network is around the corner building a network with its own spectrum and with an MVNO agreement from AT&T that'll add to competition even more. So you've got more downward pressure at a time when you have lots of CapEx required for building out 5G networks. You have more downward pressure on pricing. AT&T has sort of led that spiral, by the way, by being very aggressive with promotionality, giving away free phones to existing subscribers, which is something we hadn't seen since 2013 or so. And that has pulled the industry back into this very hyper-competitive pricing environment.
Bad for them, perhaps good for us. Craig Moffett, thanks so much. MoffettNathanson, co-founder and senior analyst. It's always great to get time with you, Craig. Appreciate it. All right, we're going to bring you our stat of the day. Since it's been such a bearish week, we have a couple of them for you. The 10% correction in the S&P 500 happened, the last one happened nearly 22 months ago. That's according to BMO Capital Markets. And the average S&P 500 correction lasts 110 calendar days. That's before it goes up again and recovers that 10%. It has on average a price decline of 13.2%. After the break, we're going to bring you Sazi's interview with Ford CEO Jim Farley on the state of electric vehicles, how the car maker's navigating supply chain issues, and who it sees as its biggest competitors. We'll be right back.
Ford CEO Jim Farley has a lot on his mind as his company's stock price hovers around a record high. I caught up with Farley as Ford just inked a deal to supply wine growers in California with electric vehicles.
Ford Pro is something we started about a year ago. We've been building it out. This is the first time small, medium-sized business, about 90% of all commercial customers, we're almost 50% share in this business, will get a full one-stop shop offer from Ford to allow them to finance their vehicle and their charging, having charging and energy management software and hardware for their new electric vehicles, telematics solution for them, and a full service, including remote service for the physical repair of the vehicle. We're going to offer that for Ford and also non-Ford customers, and it'll be the first time in the industry that anyone's ever done that.
Why the decision to open it to non-Ford customers?
Because so many of our fleets, look, we're 50% of the market. We're #1 brand in Europe as well. But still, our customers, some of their vehicles aren't Ford, but they still want telematics solutions. They still want financing products. They still want servicing. And we can do all of that. So we just want to make it easier for customers. So that's why we decided to make it not just Ford.
Your E-Transit electric vans, when do they start arriving to customers?
Soon. We're just in the final production right now, preparation. We should be launching, very soon. We have over 10,000 orders already from a lot of different customers. I think we just got over 1,000 orders from Walmart. So the demand is very high. There's a lot of focus on Lightning and, of course, the Mustang Mach-E and how sold out we are. But actually, E-Transit is strategically very important for the company because of our dominant position in commercial. A lot of Lightning customers are retail customers. Some are commercial, but an E-Transit is going to be 100% commercial. So this is our, first foray into electric and digital vans.
10,000 orders. That's a significant amount of orders, Jim. I mean, are you still taking orders for these vehicles? I know you closed down orders recently for the Maverick pickup truck.
We're getting close. I mean, we had to close down reservations and orders for Lightning as well, not just Maverick. Mustang E is sold out for Mach-E is sold out for quite some time. We're getting close. We're not there yet. Commercial customers are a little different. They want to know if their racks fit, if their equipment fits. They want to test out the vehicle. They want to make sure the operators feel comfortable. And then you have to install charging equipment, both in the operators, maybe home sometimes, or even depot charging. So they take a little bit more time to get the orders correct. But I wouldn't be surprised if we're sold out on E-Transit.
You've been around this industry for some time, Jim. Did you ever think we would get to a day where you're essentially telling folks, well, we can't take any more orders for one of these vehicles we're selling?
No, I never thought we'd be in that position. A lot of people said about Ford's strategy to get out of sedans. Why are you doing that? The Fusion's very popular, but they didn't see that we could invest it in Maverick and the Bronco Sport, the Lightning, the E-Transit. These products are so exciting. But we have the chip crisis going on at the same time, probably the biggest supply shock I've seen in my career. So all of it is happening at the same time. But I think the real encouraging thing is that Ford can develop great products where we do really naturally well, and we're being handsomely rewarded for focusing on our strengths.
Definitely want to talk about the supply shortage. It's something you and I have talked about. You and I have talked about in the past, but just on the Lightning, how many orders do you now have for that?
We have about 200,000 reservations. Now we're converting those into orders where people have to physically order the vehicle. Almost very few of them are falling out. And, our original capacity was like 40,000. We went to 80. Now we're at 150,000. So, we actually, it's incredible how nimble the company's been in upping our capacity. But it's really encouraging to see.
In terms of capacity, I know Ford has moved very quickly in adding extra capacity for electric vehicles with an eye towards really 2025. But just given the demand you're seeing for these electric vehicles and even hybrids, what's the next move by Ford? Are you looking at now a new series of electric vehicle investments?
Well, I think the first thing for us is to scale. A lot of people have come out with electric vehicles, but our ambition is to get to 600,000 units of scale for our electric vehicles in 22 months. That means sometime later next year in the third or fourth quarter, we'll have a production of about 50 to 60,000 units a month. That is a huge scaling by the company. It requires us to more than double our capacity we had planned on already. So this is a huge scramble by the company. That's our first milestone, to get to 600,000. We think that'll put us, probably number 2 on electric. We were number 2 in the US in sales this year. We now want to be number 2 with our scaling of our electric production globally. And that's before Tennessee comes online, which is hundreds and hundreds of thousands of incremental products in 3 years from now. We're breaking ground on Tennessee right now and the Kentucky battery plants. So that'll give us even more capacity. So right now we're just busy scaling. We have hits on our hands. We just need to make more of these.
Does it feel like an arms race inside the auto industry? Every day there's a new announcement of new EV vehicles, new EV capacity. What does it feel like to you right now?
I think everyone's really excited. I wouldn't be surprised if some of them have seen the response by Lightning and Mach-E and very encouraged. But I wouldn't treat them all the same. I think what we found is sticking in our wheelbase on F-150, Mustang, Transit, and really executing very emotional products, even commercial vehicles, very emotional products, and giving them a lot of data capability and digital capability is work for us. I think we're scaling before a lot of competitors. Yes, a lot of people are investing. Yes, there are a lot of investments in manufacturing. What I'm encouraged is that in this first inning, our vehicles are sold out. And we're not going to generic small cars. We're really focusing on what we do well, which are those 3 vehicles.
You're a competitive guy, Jim. You race cars. This is well known about you. I mean, who do you think is your biggest competitor in the EV market? That person where you sit in your office, wherever it might be, and say, hey, I really want to beat them, and I really want to beat them bad.
Well, the companies that I think about that I admire because of their commitment and, frankly, the hard work they did to earn their reputation, companies like NIO and Tesla, they've been at this a long time. They engineer their vehicles differently. I'm most respectful of Tesla's profitability. They're now making more than $10,000 a vehicle in their second quarter earnings. But I think Ford has a real chance here. We're not going to be in the same segments as them. We're really doubling down on the customers and the segments we know really well. F-150 has been the best-selling vehicle in America for 40 years. And now we're electrifying it. We're just getting started. So I love those companies, but I think we have a wonderful opportunity at Ford. Maybe one we haven't had since the Model T.
Well, stocks are hanging on to gains here ahead of the Fed presser this afternoon. We've got the Nasdaq up by 2.5%. I was also taking a look at the sector action here, and as you can kind of see, as hinted by the Nasdaq's outperformance, the XLK, the tech sector ETF, is the best performer on the day. It's up by 2.8%. Consumer discretionary, financials, and energy are also outperforming in today's session. Well, when we come back, we've got much more ahead, including a conversation with U.S. Secretary of Commerce Gina Raimondo on the chips shortage and some new data out from the government about how severe that shortage continues to be. Plus, the state of crypto with the CEO of CoinShares. We'll be right back.
Welcome back to Yahoo Finance Live on this Wednesday morning. Julie Hyman and I will have you covered for another hour of really intense market action. And as we are seeing this week, the next hour of trading could be wild, wild, and wild. Right now, all three major indices are solidly in the green for a change, but as we have learned by the action Monday and Tuesday, that could change at the drop of a dime. But right now, all three major indices nicely in the green, a little over 30 minutes into today's session. Now, here are a few other things we are watching for you at this moment. Whipsaw action. Microsoft stock has reversed earlier losses after earnings as the tech giant struck an upbeat tone on demand for its cloud services on its earnings call. Jefferies tech analyst Brent Thill called the results impressive and said the stock is still attractively valued. And running in 10th gear, Ford has inked a new deal with wine growers in California for its electric vehicles. But Ford CEO Jim Farley tells me the supply chain issues plaguing the auto industry are far from over. I have a deeper dive into my chat with Farley now up on the Yahoo Finance homepage. So give it a read, give it a click, and give it a share. And chip supply crunch. We're live with Commerce Secretary Gina Raimondo on a new report that shows an alarming shortage in semiconductors. But first, let's get over to Yahoo Finance's Inez Ferre, who's manning the Wi-Fi Interactive for us. Inez.
of the S&P 500 right now in the green, with technology and consumer discretionary that are leading the gains. Let's show you the Nasdaq 100 on our Wi-Fi interactive board. A lot of green here, especially on the left hand of the screen where you can see the mega caps are in the green. You've got Microsoft up more than 4%, Tesla more than 4% ahead of its quarterly results after the bell. And speaking of Microsoft, I do want to show you the software space because we're seeing a lot of these software names that are also higher today, as well as the semiconductors. Take a look at NVIDIA, up more than 4% today. I want to show you ARC Innovation ETF, the holdings there. Today, they're seeing green. If we pull up a year-to-date chart, though, these names still underwater year to date. I also want to mention the electric vehicle space because I had mentioned Tesla. I'm still on that year to date chart. Take a look at the equal weight and some of the names that have been underperforming since the start of the year, or losing the most year to date. Rivian down 39%, ChargePoint, QuantumScape, some of these companies that went public last year. A lot of money flowed into these companies. Rivian, in fact, had a market cap of $153 billion on November 16th. Today, it's at $55 billion. Saz?
All right, thanks so much, Inez. The street is now embracing Microsoft's earnings report after initially being disappointed with slowing growth from Azure cloud services. Rishi Jaluria covers Microsoft at RBC Capital Markets and joins us now. Rishi, we were joking a little bit before we started this segment. Perhaps Microsoft should put their guidance on this press release here because there was concern initially about slowing growth in cloud services. Were you satisfied with the quarter and the company's outlook?
Yeah, absolutely. And thanks so much for having me. That's exactly it. And look, my take is this was a really strong print across the board, right? The outlook for cloud and Azure seems really strong. It seems when we think about whatever headwinds or tailwinds there are in the economy, right? Be it the labor shortage out there or anything like that, they have solutions that can benefit from that. And the read-throughs, I think, are really positive here for broadly tech, right? Be it software, be it cloud platforms, gaming, security, everything I think sounded really good to me. And Microsoft seems to be firing on all cylinders here.
Rishi, do you think Microsoft has the type of report that will just alleviate any concerns regarding software companies? We mentioned a Salesforce earlier on in the show, but look, Microsoft's quarter was strong. Theoretically, you should see strong quarters from many of its competitors, right?
I think that's the case, right? I think this is very much a broad trend in software, right? We are still very much in the early stages of digital transformation, of the migration to the cloud. And so this does bode well for the rest of software. Look, all of us are keeping our eyes on ServiceNow tonight and Atlassian tomorrow, right? Both multi-billion-dollar revenue software companies that I think can, work along Microsoft to find a good barometer on the software sector as a whole. But it's hard not to look at these results from Microsoft and kind of breathe a sigh of relief that software is here to stay, and these same tailwinds that have been powering software before, during, and now maybe as we start to enter post-pandemic are here to stay.
Rishi, glad you mentioned ServiceNow. I'm going to be catching up with CEO Bill McDermott later on today to talk about the results. What does that company need to do to arrest the stock price pressure it has seen?
Yeah, look, I think it comes down to they just need to provide an outlook for next year that is strong and conservative at the same time, which is obviously a tough, thing that you got to do. It's really just a tough balancing act. But that's what I think really needs to happen. Look, if I take a step back and I think about, the labor shortages, the increased need for back office automation, ServiceNow should be able to benefit really well from those trends. So I think they're in good position as we head into the print tonight. But I really think it comes down to, a good beat, but really the outlook for next year coming in strong.
Let's get back to Microsoft. I have a couple more there for you. This upcoming deal or this pending deal with Activision Blizzard, do you view it as a game changer? And how might this shape the financials of Microsoft longer term if, in fact, the deal closes?
Yeah, absolutely. And look, we do expect the deal to close, right? There might be guardrails around it. It's probably going to be, maybe a year and a half from now until it closes, but we do expect it to close. And I'm glad you said that. I absolutely think this can be a game changer for Microsoft and gaming, right? With the combination of Activision, not only is Microsoft effectively going to be the second largest gaming company out there, slightly behind Sony, but effectively tied with them. But really, I think this bolsters everything they have across the stack and gives them kind of end-to-end gaming, right? From the infrastructure and the raw bare metal behind it with Azure to Xbox to Game Pass to the actual games and IP that they get with Activision to mobile. Microsoft will be the true end-to-end platform for gaming out there. And I think this just extends the runway of growth for Microsoft. I think that's the amazing thing about this company is it seems no matter what environment we're in, right? Inflationary, temporary recessionary, labor crunch, supply chain, they seem to hold up well and continue to execute strong. And I think gaming just gives them another secular tailwind in the economy that they can continue to benefit from. And this enhances their position against other gaming companies out there.
Rishi, I picked up on Satya Nadella, CEO of Microsoft, a minor flex on the earnings call. I'm curious if you've picked up on it too. He said Microsoft Teams is now becoming the dominant player in that work from home technology environment, suggested they are gaining market share. What's the read through to a company like Zoom, who, if we talk to them today, I'm sure they would be saying the same thing?
Yeah, it's really interesting because, we focus a lot on Teams and Zoom, and we very much take the view that this workplace collaboration space is going to be a two-horse race or a duopoly. And really, it is going to be Microsoft Teams on one hand and Zoom on the other, right? And I think I've used both platforms. I still think Zoom is the superior platform in my experience, but Microsoft has the integrated experience. There is a lot of Cisco WebEx out there. There is a lot of Google Hangouts and Google Meet, even BlueJeans, right? There is a lot of non-Zoom, non-Microsoft Teams solutions out there that I think are going to be displaced. And by the way, I think that rate of displacement, especially of Cisco WebEx, will accelerate when we start to see these office reopenings post-Omicron and people rip out their traditional hardware meeting rooms and replace them, with Zoom or Microsoft Teams and start to move away from their legacy contracts that come up and get onto next generation platforms. So I think this is one where both Microsoft and Zoom can benefit.
Pretty stunning stat too. Also on the call, LinkedIn Sales Solutions passed 1 billion in sales over the past 12 months for the first time. That is big money, and Microsoft continues to show that LinkedIn was a really good acquisition for them. What's the outlook for that business, and is there any chatter that LinkedIn should be a public company again?
Yeah, look, I 100% agree that LinkedIn was a phenomenal acquisition for Microsoft, right? A lot of us were questioning it at the time, especially given the price tag. And remember, this is when LinkedIn had its, massive pullback. But really, I think LinkedIn would not be in this situation without Microsoft, right? And I think really LinkedIn is in position to benefit across the board, right? Not just the traditional recruiting side of LinkedIn, but yes, sales and marketing and all these new verticalized use cases that they've had, right? Arguably, LinkedIn is one of the most valuable sales tools for any salesperson or any marketer out there. And then you layer in what they have with LinkedIn Learning and training, and in this time of a growing skills gap at enterprises, LinkedIn is really well positioned. So I think there's a really long runway for LinkedIn, and I think it should stay part of Microsoft, right? Yes, you could probably make an argument for some financial engineering if it got spun out as a separate company, but because of how Microsoft has been able to manage the asset and invest very aggressively in it, I truly believe LinkedIn should remain part of Microsoft.
Well, really very helpful analysis for us on Microsoft. Rishi Jaluria covers Microsoft at RBC Capital Markets. Good to see you. All right, stick around. We'll be right back with U.S. Commerce Secretary Gina Raimondo to get an inside look into the ongoing semiconductor shortage.
we know there is a severe chip shortage that has been affecting companies around the globe, and in particular here in the United States. The Commerce Department out with a survey that puts a little bit more data around that. There are only 5 days right now of inventory of key chips versus 40 days back in 2019. Let's talk a little bit about how the U.S. government is trying to address that. U.S. Commerce Secretary Gina Raimondo is with us right now. Secretary Raimondo, thank you so much for being with us. What really stood out to you from the survey that helped you better understand exactly what this problem looks like and how long it's going to last?
Thank you and good morning. The survey really confirmed for us in very great detail and in alarming detail what we already knew. We all know, every American knows we're struggling with the chip shortage. It's why you can't get your appliances in on time when you're redoing your house. It's why car prices are so much higher. It's why it's hard to find a new car or used car. The answer is not enough chips. So we all know this. What we learned in this exhaustive study is that the chip demand is up 20% relative to where it was a couple of years ago. And the factories making the chips are producing at their maximum limit. You know, they're at more than 90% capacity. So the only solution is to build more facilities in the United States of America to make chips. And the 5 days of inventory that you referenced, that's an alarming statistic. And what it tells you is that we have no room for error. You know, if there's a storm or a COVID outbreak, which takes a manufacturing facility anywhere in the world in the supply chain offline, that could cause massive disruptions here at home. So it just added a great deal of urgency to getting the CHIPS Act passed in the Congress so we can get to work making more chips in America.
Secretary, this morning we spoke with Ford CEO Jim Farley, and we asked him about the chip shortage. We'd love to get your reaction to what he told us about this.
We have the chip crisis going on at the same time, probably the biggest supply shock I've seen in my career. So all of it is happening at the same time. But I think the real encouraging thing is that Ford can develop great products where we do really naturally well. And we're being handsomely rewarded for focusing on our strengths.
Secretary, so what is the message to CEOs like Farley? Should they be hoarding the chips they could find? Should they be cutting back production? How could they navigate the situation?
Yes. So first of all, the word I heard was crisis, and I don't think that's an exaggeration. It is a crisis. Chips are unique in their importance. You know, there are chips in everything you use, phones, cars, you know, medical equipment. So it's a unique product, and the shortage is a crisis. Secondly, we need to make more chips in America. You know, I think they should not be hoarding. There's no purpose in hoarding. That just distorts the market further and creates even more disruption. I will give credit to GM and Ford. They have actually reached out to semiconductor companies. In the case of Ford, they did a partnership with Global Foundries. They're trying to be creative, forging these partnerships with the chip makers. But really, at the end of the day, we need to make more chips. I'll give you a concrete example, and it relates to Jim Farley. The average electric vehicle, which of course is the future, takes 2,000 chips in one car. The average traditional non-electric vehicle is maybe 600 or 700 chips. So the demand is just going to continue to be off the charts. And short-term solutions like hoarding, like stockpiling, they don't get you anywhere. What we need is to make more chips in America.
And I know that you've been working very hard on that. Congress has been working on it as well. The Senate passed a bill that had some measures to increase semiconductor production in the U.S. The House working on something similar. What are the chances at this point of passage? I mean, we talk about crisis. We talk about the sort of acuity of the need right now. This is a longer term solution, to your point. Does that mean that there's not going to be enough of urgency and a push to actually get this through?
I think there is urgency. I have spoken to dozens of lawmakers this year, in the new year, Republicans and Democrats, House and Senate. There is urgency. There is broad bipartisan agreement and recognition that this is a problem that needs solving and we need action right away. I am hopeful that the House will have this bill on the floor next week when they return, and that they will swiftly, move to passage so that we can hash out the differences as between the House and the Senate. There are differences. This is hard work, of course, but the fundamentals of this bill have broad bipartisan support. And you hear it yourself. You hear, retired generals, national security folks saying this must happen. It's untenable that we purchase the vast majority of the most sophisticated chips from Taiwan, from one company in Taiwan. Many generals and leaders in the military have been ringing the alarm bell on that. By the same token, you have CEOs of every major company in America saying their business depends on chips. So this is definitely not a Democrat issue, Republican issue. It reminds me a lot of the bipartisan infrastructure package. Yes, there were differences, but what the sides agree on, I believe, outweighs what they disagree on.
Secretary, how much is the chip supply shortage, from your vantage point, impacting the U.S. labor market? Because when you talk to folks like Farley, his contention is that this is not having a bill like this passed is hurting the creation of new jobs, but also hurting the impact of jobs of the future, especially in the tech space.
There's no question that is true. By the way, jobs of today, both Farley and Mary Barra, many auto companies have had to lay off or furlough thousands of workers because they couldn't get their hands on enough chips. I can't even estimate how many cars and trucks right now in the United States of America are, partially assembled and can't be fully assembled because of chips. And so that means workers are put out of work. Not to mention, as you say, the potential job creation. I was in Ohio on Friday. Intel announced a new manufacturing facility for chips in Ohio. That one facility, they estimate, will create over 10,000 jobs. So the job creation element of this package of substantially enhancing manufacturing in America is gigantic.
Secretary, as you alluded to, there is bipartisan support for these types of measures, that type of U.S. manufacturing. Not as much for the president's Build Back Better package, the next tranche of aid for the economy. And I know a number of CEOs, including Jim Farley, are set to meet at the White House today. I believe you'll be at that meeting as well. What's going to be the message of the administration? And are you hopeful that getting these business leaders on board can also help get, maybe it's a bridge too far to say Republicans on board, but maybe some of the intransigent Democrats on board at least?
I hope so. I hope that members of Congress will listen to these business leaders. As you just put up on the screen, this is a range of business leaders across industry, software, tech, financial services, industrials, automakers, and they all believe what we know and what the president knows is that the investments which the president is proposing in Build Back Better are good for the economy, will create jobs, will enable people to go back to work, will expand the labor force, and will ultimately enhance American productivity. I give these CEOs a lot of credit. They're coming forward and saying, pass Build Back Better because our businesses need these investments. Whether it's investments in childcare so women can work and be productive, or investments in climate, which creates jobs and saves the planet, or investments in job training, which will enable the workforce of the future. These are investments which are good for business and good for workers. And so often I hear Build Back Better miscategorized as a quote unquote social spending bill. Well, you don't often get a dozen or half a dozen leading CEOs behind quote unquote social spending bill. What you're going to hear today is this is good for the economy. So let's get it done. And let's build and enhance the productive capacity of our economy and create jobs while we do it.
Secretary Raimondo, and I know you've talked in the past about its help in making the U.S. more competitive as well. So I'm sure that will be part of the discussion. Thanks so much for being here. Good to talk to you. Secretary Gina Raimondo, the U.S. Secretary of Commerce. Thanks so much. We're going to take a quick break now. When we come back, talk about the latest moves in cryptocurrencies with the CEO of CoinShares. We'll be right back. We are seeing cryptocurrencies continue their rally today that began yesterday. And a lot of crypto bulls still confident in the long-term prospects for cryptocurrencies as well. Among them, Cathie Wood, who predicted $1 million price for Bitcoin by 2030. Let's bring in Jean-Marie Mognetti. He is CoinShares CEO. It's Europe's largest digital asset manager. Jean-Marie, thank you for being here. So what are you hearing from clients right now as we've had this recent volatility in Bitcoin? I imagine people who have been in the space for a while are accustomed to this sort of bouncing around. But even so, even for them, the drop has been perhaps alarming. What have you been hearing?
Well, first, thank you for having me. We've been in this space since 2013, 2012, and I can tell you that even if you're there since this time, it's still painful and you're not getting used to it. You tend to forget that this thing can happen. So it's always a good reminder. So our clients are, as we are, getting accustomed to it and getting used to it. The real differentiation is which wave of client is being impacted these days. And, you get a lot of new entry in 2021, and these clients were the one which were not really used to this cycle, but the beauty of CoinShares products is we have clients which are very much with us for the long run. We have clients which are with us since 2015, 2016, and which are experienced this cycle. And they are almost the one educating the community to make them understand how the journey is going.
I was surprised this morning to see Cathie Wood come out here and call for Bitcoin reaching $1 million by 2030. Does a call like that make sense to you, just given where we have seen crypto prices go the past few months?
Well, crypto price over the last few months, along with like growth stock, has bears the grunt of the market bleeding. I think Nasdaq has probably erased all 2021 gain. Bitcoin and crypto in general are down 50% from the all-time high market cap. So we're definitely in this kind of weird situation where people have been suffering a lot so far in 2022. And we see some sign of recovering on the back of some Fed announcement on the back of FOMC minutes, which are not going to be as drastic as people were thinking last week. So the kind of uncertainty we are in, where we know the Fed is going to announce something, but we don't really know what. People were talking 50 basis points last week. It's going to more looks like 25 basis points. We don't really know until we have more certainty and more direction from Jay Powell about the gradual proposition about tapering. Tapering is a big word nobody used for many years, and probably some of us never heard. So it's a process, and I think the market is like trying to figure out how it's going to handle this process in the months and years to come. So to come back to your earlier question about Cathie valuation, I think she put analysts put a very strong penetration rate case behind it to show where it's going to penetrate and how it's going to penetrate the market. And everybody can go with his own call. I know Milton came on this show earlier last year to call 100 grand. It's a very, numbers are very relative depending on what they are. So we're not going to comment further, I guess.
So let me ask you a more modest question then. Can cryptocurrencies, and let's just pick Bitcoin for ease of talking about it, can Bitcoin rally this year in the face of Fed tightening?
The question is not so much about Fed tightening, is how much the Fed is going to be able to tighten. And that's going to be the message we are looking for from everybody. Like Bitcoin has been sold out, and cryptocurrencies in general on the face of the uncertainty coming in and the rates going up. It's going to be interesting to see how it reacts in a bit of a more medium-term perspective. But I think Bitcoin still has some room, and it's going to be almost testing the capacity of the Fed to tighten the economy and also the interest rate and get back with the grip on the economy.
Jean-Marie, we're going to have to leave it there, unfortunately. Thank you so much for being here. Jean-Marie Mognetti, who is CoinShares CEO. Thank you. Well, coming up, the IMF urging El Salvador to remove Bitcoin, speaking of which, as its legal tender. We'll have more on that and other top business stories. luxury car maker to make such an announcement. That investment will include research and big upgrades to its sole assembly facility in Crewe, England through 2032. The company, owned by Volkswagen, originally announced its electrification goals back in 2020, along with its plan to become carbon neutral by 2030. The first EV is scheduled to launch in 2025. And the IMF is urging El Salvador to drop Bitcoin as a legal means of payment due to large risks associated with it. El Salvador was the first country in the world to make Bitcoin legal tender last September. It previously used the US dollar as its main legal tender since 2001. In a statement, the IMF said that Bitcoin poses risks for financial stability, financial integrity, and consumer protection. Some Marc Jacobs shoppers were in for a surprise upon checkout yesterday. The website had a major glitch and allowed some customers to receive a 100% discount on their bag purchases, also known as free. That's according to the Wall Street Journal. The company quickly caught on, calling it an inadvertent error, since canceled the order. So the folks who thought they were getting $300 bags for $0, unfortunately for them, fortunately for Marc Jacobs, they will not be receiving those bags. Let's get a quick check on markets before we leave you. We are seeing the rally intact, but it is losing a little bit of steam. The Nasdaq was up as much as 2.5%, now up 1 3/4%. The S&P up 1%, and the Dow up just 0.5% at this point in time. After the break, we're going to talk to the top chief of a visual effects and animation company that's been working with the likes of Disney and Netflix. You're looking at some of their work right now. We'll be right back.
Visual effects and animation company DNEG is going public in a SPAC transaction that values the business at $1.7 billion. DNEG is seen as the leader in the space, having long-time relationships with large content producers such as Disney and Netflix. Worth noting here, unlike most SPACs, DNEG is profitable and has been profitable for some time. Namit Malhotra is the chairman and CEO of DNEG and joins us now. Namit, congratulations on this deal. Look, I think a lot of folks are very familiar with your work, but don't realize you are the company helping to bring a lot of this content to life. What are some of the projects you're working on right now?
Thanks for having me. It's a pleasure to be talking to you and showcasing the company on its next phase. We obviously have a big, bouquet of projects. Recently we obviously, worked on projects like Matrix and Dune and James Bond. And what's coming up in the next little bit are projects like Shazam 2. We're doing that for Warner Brothers and New Line. We're working on a bunch of TV shows like Stranger Things, Meg 2, and we've got a bunch of animation projects as well, like Garfield, which we're producing. So there's a massive order book and a splatter of projects that we're currently working across all our different offices.
For those on our platform, Namit, that are sizing up your company and soon your stock, what are some of the biggest drivers? Is one of them streaming, and do you play in gaming yet?
So we are, using a lot of game engine technology in our current workflows, and that's where we believe the next phase of our business is headed towards, is the convergence of gaming and what we do. So when we work on a project like Uncharted, which is a rendition of a video game into a movie, we are actually now, we believe that that happens because of our quality profile and our technology profile, where we can produce assets at a very high quality end, which we believe can now be transferred onto the gaming world, which is where I think the gaming industry wants to go. So that's something that's going to happen imminently and very, very organically. That being said, the tailwinds in our industry are massively being driven, especially through the pandemic, on the back of the streaming, universe of content, which is only growing at faster and faster clip. And that creates, a lot of opportunity for companies like us to be able to really bring our absolute tier one profile of high quality, imagery and storytelling capabilities to this massive gap that's been created because of each streamer and each big content player now wanting to own and operate on their own library.
Namit, it's Julie here. One of the challenges that poses as well is getting good people, right? And competing with gaming, with the other visual effects houses to get good people as well. And I noted in your investor presentation that one of the reasons you're going public is to be able to offer stock options to folks of a public company. Talk to me about that competition for talent and what it's like now versus a year ago, 5 years ago, for example.
Sure. See, there's always been, at the very high end of any business, there's always going to be a dearth of good enough or enough talent out there. All I can show from the history of our evolution, when we acquired Double Negative in 2014, we were about 700-800 people in London. We are about 7,000 globally. We were about 8,000 people right before the pandemic. So we've actually shown that we can actually globalize and operationalize different sites, and access to talent therefore becomes a little easier because of the way our platform is designed. Our tech tools are designed where we can train and bring people onto their best capability in a much, much faster clip than, let's say, most of our competitors can. So that's a big differentiator. The other is that having a deep historic bench of, a massive talent pool in India certainly helps, where we know that there is no shortage of people. What they need is a lot of training and support. And that's what the company has already built over the last, let me say, almost 15 years of my journey has been about building and scaling that part of the world to be able to deliver high quality product for whatever we do. So we are, as part of the journey we're on, it's just that today our ability to scale is a little bit more, let's say, stable, because we don't have to worry about what happens a year or 2 years from now. We have future visibility, we have much better order books and a much stronger demand curve. So we can be investing in training and new technologies whilst opening up new offices that make access to that talent much more, let's say, comfortable or easier. And that sort of gives us, I think, a unique position to any of our competitors who, fortunately or unfortunately, don't have that sorted, because our genesis itself is a function of East meets West. I came from setting up a very successful capability in India and then acquired companies in the West. So we kind of brought the two worlds together in our journey, and that takes a lot of work and a lot of effort in really integrating and aligning culture, behavior, training, and that we've sort of done and established through our last many years of building this company.
Speaking of journeys, talk to us about your journey. Am I correct that you started this company at 18 years old out of your grandfather's basement?
Yeah, so I started in Mumbai. That's absolutely right. In 1995, literally in a car garage that my grandfather had bought, and my father and we lived in the same house, but in an apartment in Mumbai. It still exists, by the way. At some point, we'll publish pictures and talk about that. But that's literally where I started when I was 18, and with an Apple computer and a bunch of guys who taught me computer graphics in a 6-week course that I did, and I hired them as my key partners, and we set ourselves up, and that's the sort of journey that we've had.
Well, very interesting story here. Congrats on the upcoming debut. Namit Malhotra, Chairman and CEO of DNEG. Good to see you.
Thank you. Thanks.
All right, stick around. We'll have a few final thoughts on the markets straight ahead.
We are seeing stocks maintain their rally for the moment. Of course, everything could turn on the Fed commentary this afternoon coming from Jay Powell. But if you look at the major averages, giving up a little bit, but now kind of holding steady at these diminished levels, with the Nasdaq now higher by 1.5%. We've also been watching crude oil prices, Brent crude in particular, reaching $90 a barrel. That's for the first time since 2014, October of 2014, I believe, as we have seen this latest surge higher. It's not above that level at this particular moment, but it did get there. Another stock that we're watching at this hour, stock versus oil, I should say, is Navient. That company coming out with numbers that missed estimates. Navient, the student lending company, down 7% after earnings and sales missed there. So Saz, this is one of the more actively traded stocks today in the wake of those numbers. You're looking at DraftKings as well, which is also a trending ticker and one of the more actively traded stocks.
Yeah, wait for this one, Julie. Investors are placing bets on shares of DraftKings in their future. Yeah, I like that one. I know. Seeing Morgan Stanley analyst Thomas Allen upgrade the stock to overweight, which is the equivalent of saying, hey, go out there and buy the stock. We really like it. Allen likes the long-term opportunity for online gambling. Threw a lot of big numbers into its report, but again, the stock is reacting very positively. Ahead of this downgrade, shares of DraftKings were down about 68%. Really got caught in that whole tech sell-off downdraft, which in many respects is still continuing.
Yeah, although, we did have at the top of the show, we talked about some strategists coming in here and saying now is the time to buy. I don't know if that optimism will sort of change now that once we actually get some commentary from the Federal Reserve this afternoon. But I think the theme that's been emerging in our discussions with various market watchers is that the Fed's job is really hard right now, right? I mean, that's kind of what it comes down to. This idea of controlling inflation while still maintaining what has been a relatively robust job market and maintaining growth. That is really going to be the challenge for the Fed. And how markets react really seems to hinge on how they're going to be grading the Fed on being able to thread that needle, being able to maintain that what looks like a tricky balance.
Hey, it's hard, Julie, trying to listen to 3 earnings calls at the same time like I tried to do last night. Didn't work out too well. I'm losing my touch a little bit, but did listen to 2. So that's a win for me.
I know a way you could win by not doing that. Maybe reading the transcript afterwards.
I knew you were going to say that. I knew it. I just knew it. I knew it.
You just don't need to make things harder for yourself. The Fed has no choice. You, Brian Sazi, you have a choice.
I don't.
All right. And we know that you all out there watching us have a choice as well. So we appreciate you choosing us on this Wednesday morning and to help guide you through all of the madness that we've been witnessing this week in the markets. Kiko Fujita and Brad Smith are going to guide you through the next 2 hours of trading. You are in their very capable hands. And then, of course, we will have coverage of that Federal Reserve announcement and press conference this afternoon. Brian Chung will be helping guide you through that as well. Keep it right here on Yahoo Finance.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brad Smith. On this Wednesday, we've got stocks moving higher here. All three major indices in the green early on in the session. The Nasdaq staging a bit of a comeback, up well over 1.5%. The Dow up about 0.5 percentage point, and the S&P 500 up about 1%. Investors bracing for comments from Jerome Powell as the FOMC wraps up its two-day policy meeting. And we are watching bond yields very closely here, looking at the 10-year at 1.78, while the 30-year yield sits at 2.12. Microsoft leading the tech gains. It is latest earnings results, calming some nervous tech investors. And we've seen shares pop in a big way, up well over 4% as the company issues better than expected revenue guidance for the quarter. And the White House making another push to build back better. The president hosting CEOs from Intel to General Motors to discuss his domestic priorities and those issues with supply chains. Why Ford CEO Jim Farley says those disruptions are the worst he has seen in years. First, though, stocks rebounding after yesterday's volatile session. And Brad, today it is all about that Fed decision. Of course, we've got Yahoo Finance's Brian Chung watching that for us this afternoon. But let's kick things off with Jared Blickery with a look at the market action. Jared.
That's right. We're looking at a nice rally ahead of the FOMC announcement. And guess what? This usually doesn't happen. We get something called Fomc Drift, and that's where the Fed just realizes, or market participants just realize that the Fed, it's all about the Fed and they don't need to do much. But we're seeing a lot of volatility today, and that's par for the course for what we've seen recently. Here's a 5-day look of the Nasdaq, and you can see we were down considerably only one day, and now we have risen, I'd say, decently. Now, yesterday was a unique day, almost, and that's because we had the Dow almost closing up after 2 days of 2% down days. Didn't happen, but nevertheless, I want to get a look at the futures here, and this is going to be the S&P 500 futures, and we're going to take a multi-day look, and we can see this is a spike bottom that we got earlier in the week, and now we are right back up against resistance. So I think it's all going to come down to what the Fed says today. Only thing that has to happen is Jerome Powell might ease off the QT rhetoric and not say anything about rates necessarily, probably going to go ahead with March. But if he just eases back on that rhetoric, you have to think that the markets are going to run with that. If they don't, watch out below. This is our commodities heat map. Just wanted to point out that Brent just hit $90 per barrel for the first time since 2014. So crude oil definitely resuming its bull market. And let's take a look at WTI as well. We can see that's up to 87.50. Haven't seen that price in a couple days, and a couple dollars higher. We're going to see if they can take out those 2014 highs as well. Here's the Nasdaq 100, and we're seeing a lot of green here. Microsoft after earnings, very favorable outlook. That stock is up about 4% right now. And we're also taking a look at Apple. Apple's going to be reporting earnings after the bell on Thursday. That stock's up 1%. Alphabet is next week. Tesla is after the bell today. I'm going to be bringing those earnings to you about 4:10. So let's take a look at the semiconductors. Those are popping today, as is the software space. I'm not going to go through all the names. Just want to show you this is a market reversal from what has happened since the beginning of the year. And here is a year-to-date look. You can see a lot of these names still mired in the red. Even Microsoft, the big king there, is down about 11%. Do want to check in on the banking sector. We have seen, and this is a year-to-date view. Let's go to an intraday, and you can see JP Morgan up 2%, Citigroup up about 2%, and Goldman Sachs, that's up almost 2% as well. But we want to get a read on what the Fed is expected to do today. So, Brian, I'm going to kick it to you.
My earpiece, it's looser than the Fed's monetary policy settings right now. The Federal Reserve is expected to make a decision later on this afternoon at 2 p.m. And I've got three things I'm watching for in that big meeting alongside the press conference from Fed Chairman Jay Powell. Call it your Federal Open Market Committee 3 or your FOMC 3. And the first question that I have is 3, 4, 5. How many rate hikes are we going to have this year? A little hiking boot emoji there. But of course, all eyes are on the commentary from the Fed with regards to how aggressively they're going to raise interest rates from the near zero setting that they've had since the depths of the pandemic. We're not going to get a new update of summary of economic projections showing where each member could see interest rates going over the next few years, but Fed Chairman Jay Powell could add a little bit of commentary with regards to the median appears to be baseline reading from Wall Street that we should expect to see 4 interest rate hikes this year. But my number 2 question is really all about the topic du jour, which is, of course, Federal Reserve's balance sheet, because the Fed is not expected to do anything on interest rates today. They'll likely tee up the first rate hike in March. Instead, the Federal Reserve is still in the process of trying to end its pandemic-era policies of adding U.S. Treasuries and agency mortgage-backed securities to its nearly $9 trillion level. Now, the Fed plans on ending that process by mid-March, but the Fed has said after that is when it's fair game to start raising interest rates. That's going to be a very interesting commentary to look for in that press conference at 2:30. But my number one question is really all about the Fed speak and the inside baseball stuff at all. My number one question is what every other American is thinking as well. When does inflation go down? We need to get a new updated outlook from the Federal Reserve with 7% year-over-year growth in the consumer price index as to when the Fed expects those numbers to start going down. Federal Reserve officials have said so far we should expect to see more eye-popping monthly figures in the next few months. But is it in the summer? Is it in the fall that we start to see inflationary pressures go down? How much longer will Americans have to deal with this? That's something we should expect the Fed chairman to be pressed on in that press conference later this afternoon, which of course we'll have the full coverage of right here on Yahoo Finance.
I always love the use of emojis, Brian, in talking about Fed policy. As Brian said, he's going to be all over the decision. And we've got live coverage of that press conference coming up here on Yahoo Finance Live later this afternoon. But let's kick things off this hour with Rebecca Walzer, Walzer Wealth Management President. And Rebecca, you've highlighted this very tricky line that the Fed has to toe in terms of the messaging. It was already difficult going into this meeting in light of the recent volatility in the markets. How do you think the Fed navigates the messaging?
Yeah, Akiko, it's very difficult, right? Because they absolutely can't have 7% year-over-year inflation. That looks like they have not done their job at all. But yet they had to stimulate us through the coronavirus, and so they didn't know the right place or the right amount, and so we maybe overstimulated and not gave us inflation, and now they've got to pull that back. And you know, when you think about it, we were at 120 billion a month at the peak of stimulus between mortgage-backed securities and treasuries, and now we're slimming that down to next to zero in March, and now we're going to start running off. So we have a double whammy of going from stimulus to runoff, which we know that has a huge impact on the economy. But then we also are going to, start rate hiking potentially in March. So I think the Fed has a really difficult. They're really in a rock and a hard place, and it's really difficult. And I'll tell you, Akiko, when they are seeing these high rate, swings of volatility, it makes them probably very leery of really coming out and stating a policy that will make the market go one way or the other. But that's what they have to do. They're in this position. They're the ones that have to make the decision. And I think that, the market is, I think the market is expecting good news today because obviously we're all to the positive, but it could go really bad, really fast if we get comments we don't want to hear.
And Rebecca, it really comes down to what we've also heard from both the Fed signaling as well as some of the early banks that have gotten out there during earnings season and what they're anticipating. Some of them, as we were hearing from JP Morgan Chairman CEO Jamie Dimon, expecting perhaps upwards of 6, maybe even 7. So from your perspective, what is kind of that true expectation number of rate hikes that we should expect?
Brad, I'm really thinking 4 is going to be where we level off. I know some analysts are saying as many as 8. Jamie Dimon obviously going up to 6. It seems really difficult. Now, if we look at a macroeconomic perspective, we've had low rates really since Too Big to Fail and quantitative easing 1, 2, 3, and 2008, 9 in those timeframes. So we have never really truly normalized rates since the Great Recession back in 2008, 2009. And so I guess if you're looking to normalize rates, that you could see these major 8 rate hikes. But I think that in the short term, in the next 18 to 2 years, I don't see how this economy, absorbs 8 rate hikes. So I'm going to go with 4 for this year as the upper bound, and any more than that, I just can't see that this market will be able to sustain. And I think the Fed does care. If the Fed didn't care, we wouldn't have stimulated so much in the last 20 months with Corona.
Rebecca, in the meantime, you've got a lot of viewers who are looking at their portfolios this morning saying, what do I do if the volatility is going to continue? Do I hang tight? Do I cut my losses, rotate into some of the value names? What are you telling your clients?
Yeah, that is a huge, that is the name of the game, right? Where do we go in a period of volatility? It depends on the kind of investor we're talking. If it's a short-term investor, There probably are some trades that can always be made to, with options and all of these things to make some shorts and all these things that can make some gains. Obviously, the financials we expect to do better when the rates go up. But for the long-term investor, who maybe someone who's closer to retirement or already in retirement, and this is what their portfolio that they're living off of, they really have to go more conservative, because I do believe this is going to be a very rocky year for the market. There's going to be a lot of things that happen this year that are going to have an impact on the market outside of the Fed. The supply chain issues, what's going on with, Taiwan and China and Ukraine and Russia. We've got wars, we've got geopolitical issues, we've got, political issues at home. So we have a lot of economic factors that beyond just the Fed, beyond just the markets, that are going to impact these markets, especially the supply chain and inflation. And so I would really encourage long-term investors to seek as much conservative safety while maintaining some positions in the market as possible.
What's truly been interesting is how many CEOs are continuing to discuss the amount of impact that the supply chain and combined with the global chip shortage and the chip crisis, that both happening at the same time, as we're going to continue to discuss throughout this hour, how much that actually is a major boon to inflation, unfortunately. And so with that in mind, we're looking to see when some of those issues would be resolved. What do you think some of the necessary efforts are to push that forward, and how quickly we can even see movement on some of those resolutions, especially with regard to chips impacting the inflation as well?
Absolutely, Brad. Well, I know that we're hearing talk of a new chip manufacturing plant being made out of Ohio, which we really could use. I think it's really sad that we didn't have a little bit better foresight to see that the Internet of Things, IoT as we call it in the industry, is going to need a chip for everything. And that means that the demand just is a quantum leap in demand. And unfortunately, I think the whole world was sort of short-sighted and not seeing that actually come to fruition. And so now we actually have to make these plans. The problem, of course, Brad, is these are long-term investments. These are long-term commitments, new plants, new things. So even if we get a new plan, even if we have these things, even if we bring stuff back closer to the United States and control our manufacturing, which is obviously, difficult to do in the cost space, it's still a longer term solution. So the short term solution is, unfortunately, we're going to have shortages. We're going to have the supply chain interruptions that we're seeing. We're going to have cell phones. The new cars, the new car problem. I mean, I think dealerships could be going out of business because they can't get inventory. So this is a short term problem that we're going to have to deal with, and we need long term solutions that just can't come fast enough. And so it will have an impact, Brad. Absolutely.
Rebecca, really quickly here, you touched on what's playing out with Ukraine and Russia. I mean, how significant a risk is that really from a market perspective? Is this just about uncertainty, or could it be a bigger overhang?
Great question, Akiko. I actually expect that we will see an incursion by Russia into Ukraine. Russia seems to have the opinion that Ukraine is really still theirs, and it was really shouldn't have been, partitioned in the first place. So I'm fully expecting that. I think the market should prepare for that. And unfortunately, it looks like America might be getting into that fray again and starting another deployment, and that is a really big concern. And I think that when you couple, a new war or a new kind of military exercise that involves military with the supply chain problems, the inflation problems, the fact that we've overstimulated and now we have to pull back and go from stimulus to runoff and raise interest rates. It is just so much for this economy worldwide to handle. So I think, again, investors need to be really smart and prepare for volatility and prepare to, be a little bit more conservative on the risk profile if they can't afford to sustain short-term losses, 18 months or potentially longer. But I think people need to be prepared for, a market that isn't as friendly as what we've been used to since 2009.
Rebecca Walser, president of Walser Wealth Management, joining us here today. Thanks so much for the time and insights, Rebecca. Appreciate it here today. And everyone, we want to get you one of the trending tickers that we're watching today. Shares of DraftKings, DKNG, they are moving on up, and that is up by about 13.6% today. That is on an upgrade from Morgan Stanley. They're looking for the stock to rebound 60% here. Now, what's noteworthy is you've got even more viewership that's even taking place across sports, especially football here. CBS just coming out yesterday and saying that they're averaging 35.8 million viewers for playoff games this season. The significance there? Perhaps you have more sports bettors that are tuning in very intently to some of these games. So we're going to be keeping a close eye on shares of DKNG as we move on throughout the rest of today's trading session for sure. And coming up on the other side of this short break, we've got even more of a breakdown on Microsoft's earnings and what the company had to say on their call, even after dropping the numbers. They're up 4%. We're going to get back into that after the break. Welcome back to Yahoo Finance Live, everyone. Taking a look at shares of Microsoft here on the day as we've got big news for big tech. Microsoft reporting its fiscal Q2 earnings, beating analyst revenue expectations by almost $1 billion. The tech giant also announced its cloud services Azure revenue that jumped 46%. That's down a bit from its 50% jump in Q1. For more on this, we welcome in Piper Sandler equity research analyst Brent Bracelin joining us today. Brent, let's dive right into this because you actually believe that Microsoft Azure could double within 3 years. So where do you believe the business could continue to drive increased adoption leading up to and en route to reaching $80 billion is the number that you've got?
Yeah, I mean, so if you think about the opportunity in cloud, we see an incremental $1 trillion of revenue. The overall enterprise stack is about $2 trillion. If you take the 100 largest cloud players, we're about $290 billion. So that puts cloud penetration at about 15%, with Microsoft being the cloud king here. They have about 28% market share. That's the highest market share out of all the cloud vendors. But there's still a long runway to help these large enterprises transform their models, digitize their businesses, and really run more and more of their applications on Microsoft itself. And so, yes, the crown jewel for Microsoft is Azure. It's 20% of the business. But as we cross over that $40 billion threshold this quarter, you can see that as it becomes a bigger part of the Microsoft business, grows from 40 to 80 billion, that's going to change the growth trajectory of the business. Most importantly is that not only is Azure changing the growth trajectory of Microsoft's business overall with that mix shift to Azure, but it's also driving incremental profitability. This is a company that generated 43% operating margins, even with all of the investments they're making in the cloud.
Brent, even with that said, investors initially yesterday, when those numbers came out, weren't exactly wowed. And we're talking about Azure with, as we're showing, 46% revenue growth. And yet the expectation seemed to be that things would go even higher. Essentially, Microsoft just matched the expectations that were out there. And I wonder what you think this says about just how jittery the tech trade is. Microsoft shares didn't actually bounce back until we heard from CFO Amy Hood, who said, look, the demand is still really strong.
Yeah, I mean, listen, there's hypersensitivity to the cloud group right now. This is a group that's down about 50% since from the highs in November. We're down 20%. The whole 100, Cloud 100, it's down 20% year to date. So a lot of concern around the sustainability of cloud growth. That's why there's hypersensitivity when Azure downticked from 48% FX adjusted growth last quarter, 46% growth this quarter. There was some initial reaction and concern that that may be the beginning of a slowdown. Microsoft clarified they actually think Azure is going to re-accelerate. More importantly, leading indicators for the cloud business, their CapEx spend accelerated, their bookings accelerated. So there are other inputs that people didn't see initially that give people confidence that, hey, this cloud transition is still very, very strong. Demand signals are very strong across the whole entire stack of Microsoft products.
We're also on the screen here taking a look at Xbox content and services revenue. That was up by about 10%. And it was going to be noteworthy what the executives had to say about this most recent blockbuster acquisition of Activision Blizzard. Of course, it still needs to get through in entirety. However, as of right now, are you impressed by what the company has been signaling around what they're intending to do, how immediately accretive it could be in the future, and what type of contribution that it could make to margins in the future too, because it's margins from the cloud business that allows them to continue to make some very large strategic acquisitions such as this?
It's interesting. Most people give Microsoft a lot of credit for their commercial cloud business. That's the growth engine of the business. But Microsoft still has a pretty impressive consumer business. It's small. I look at Activision Blizzard as really a strategy around consumer and driving share gain opportunities beyond just cloud, but also now on the consumer side. That's a big content. Microsoft's generating close to $70 billion a year in free cash flow. So essentially able to pay for the entire acquisition of Activision Blizzard with 1 year of cash flow. So I think it's a better use of cash than Microsoft sitting on $120 billion of cash today. And I do think it's a really strategic asset as you think about them getting into the content side on the consumer space, particularly as you think about different ways to monetize the content that Activision Blizzard King have, be it, in gaming today or the new metaverse market. So content's king. They're getting in that consumer space, and I'm certainly constructive on the combination here.
And Brent, you've got a price target of $352 a share. We're right under that, about $300. What do you think is the biggest risk right now for the company? I mean, now that we're seeing investors sort of digest the numbers with the commentary got on the call, certainly the outlook is positive, but what's the biggest thing that could potentially derail that?
Listen, there's lots of things to be worried about as we think about external factors. But ultimately, we believe as you think out beyond some of the external factors, even going back to 2004 to 2006, this concern around FOMC rate hikes, the FOMC raised rates 17 times from 1.25% to 5.25% between 2004 and 2006. And guess what companies and stocks did really well? High growth, high tech names. So listen, I think there's a lot of concerns. There's a lot of issues about Microsoft as a large cap was up over 50% last year into basically November before the sell-off. And so I think we're going through kind of this fundamental growing into the multiple valuation is still a big risk. But as we think about large cap software names, Microsoft is one of the best names in our coverage list here that has very durable growth, irrespective of some of these external factors that are certainly going to weigh in valuation.
Brent Bracelin, Piper Sandler Equity Research Analyst, Cloud Software and Analytics. Good to get your insight today. Appreciate you stopping by. Well, coming up, the White House making another push to build back better, hosting CEOs from General Motors to Ford to discuss the president's domestic priorities. We're going to hear from Ford CEO Jim Farley, as well as Commerce Secretary Gina Raimondo on the other side. Welcome back to Yahoo Finance Live. Well, the White House hosting some big name CEOs today, from Intel to General Motors and Ford. It's all part of the president's continued push here to try and get something done on that massive spending bill, Build Back Better. And Brad, it does feel like the White House is trying to get some momentum going here. Certainly names like GM as well as Ford, certainly a part of the conversation on Build Back Better, because there's so many incentives on the climate side with the EVs in there that could be a big benefit for those companies. But no question, supply chain issues are going to come up as well. That's not necessarily something that is addressed in this spending package, but certainly we've heard from a lot of these CEOs, especially in these earnings calls and more to come, that suggest that despite what the White House says, there's still an uphill battle here in trying to get things resolved, especially with the chip sector.
Yeah, that's right. And for the Build Back Better initiatives that have been communicated thus far by the White House, there are a few things that it comes down to, but it also touts a lot of job creation. And so what that job creation looks like in actuality really hinges on how quickly many of the factories, the plants that are looking to be brought up to quell some of the concerns, major concerns around the chip sector, how quickly that can ramp up and then bring those jobs into the fold to also answer for some of the larger questions across automotive, consumer tech, and all of the different areas that those chips touch. And this comes on the same time where we've gotten even more data from the Commerce Department as well, and their study, particularly around semiconductor data, and the need for Congress to pass U.S. Innovation and Competition Act. And so with all of that in mind, we've actually been able to hear from the Ford CEO as well as from Gina Raimondo as well of the administration. And it's particularly noteworthy at the time that we are going through this particular chip shortage. It's also impacting inflation more broadly as well, as Jim Farley had spoken about too.
We have the chip crisis going on at the same time, probably the biggest supply shock I've seen in my career. So all of it is happening at the same time. But I think the real encouraging thing is that Ford can develop great products where we do really naturally well, and we're being handsomely rewarded for focusing on our strengths.
First of all, the word I heard was crisis, and I don't think that's an exaggeration. It is a crisis. Chips are unique in their importance. You know, there are chips in everything you use, phones, cars, you know, medical equipment. So it's a unique product, and the shortage is a crisis. Secondly, we need to make more chips in America.
And so just to add on to and add some context to what we just heard, from what we do know as right now, the semiconductor facilities are operating at maximum utilization, according to the Commerce Department. Demand remains up 17% since 2019. And if you think about the roadmap as well, for electric vehicles, for some of the consumer products and technology in our homes, the wearables, that demand is only going to continue to increase. And so for those bottlenecks, if they are not immediately rectified or a plan set in place and actionable, that immediately gets set into place, I should say, that is something that's going to have much more larger ranging impacts on how we're actually able to meet some of our own goals on everything from environmental sustainability to the economic growth as well in the future.
Well, in bottom line with chips, Brad, when you think about the landscape globally, it is heavily weighted towards Asia, specifically Taiwan with TSMC. And that's been a big focus for their administration to bring manufacturing back to the U.S. so that when there are these supply shortages, you're not so reliant on one region. They've been able to really get some big victories here. We were talking about Intel's announcement, that $20 billion factory they're building in Ohio. They've got one in Arizona as well. TSMC also building in Arizona. And on that front, we did see some movement over in Congress, specifically on this competition bill, talking about trying to reduce reliance on China. The House introducing the American Competes Act, $52 billion to encourage more semiconductor production in the U.S. So things are moving along. The problem is that this is not a 6-month, 1-year story. To build out this footprint, it's going to take several years. In the meantime, there is still a shortage that's led to production halts, and a lot of companies are still having to deal with it without the sources in place here in the U.S.
Certainly. Just quickly, it's about this fabrication process. And I think many of us have understood, or at least come to understand even more about what goes into place for some of the nanotechnology that's necessary for that fabrication process. And we'll see how quickly some of these new plants that are set to come online to kind of remediate the dependency that we've seen overseas, bring some of that back here and domestically, and where quickly that nano production can be ramped up as well.
Yeah, no question about that. And, we're talking about TSMC over in Asia, by the way, overtaking some of those Chinese tech names in terms of valuation. That shows you how critical they've become at a time when over the years we have seen increasingly semiconductors, at least in the U.S., go fabless. And now we're seeing a big reversal here with Intel leading the way.
Absolutely. Well, on the other side of this short break, I believe we've got much more on the worldview as well. And so we are going to take a quick break and be coming right back in a moment.
In our worldview today, Russia has launched sweeping military exercises in the face of mounting pressure from NATO and the U.S. over the Kremlin's military buildup along its border with Ukraine. More than 20 warships conducted maneuvers along with air defense in the Black Sea, while ships deployed to the Barents Sea to protect a major shipping lane in the Arctic. This comes as NATO moves its troops into the region to counter Russia's growing military presence. The U.S. has also placed soldiers on alert. Over at the White House, the president has said he would consider direct sanctions on Russian President Vladimir Putin if he attacks Ukraine. Russia has amassed 100,000 troops along its border with the country, leading to fears of an imminent attack. Denmark is looking to scrap all COVID-19 restrictions next week, despite high infection counts in the country. It reported nearly 47,000 new cases on Tuesday, just below its peak last Friday. But Denmark's health minister says it is time to go back to business as usual. That means nightclubs can reopen. Restaurants will now be allowed to serve alcohol after 10 p.m. Vaccine passes and face masks will no longer be required on buses. The changes are still subject to parliamentary approval, and it comes just days after the UK, Ireland, and the Netherlands announced similar measures. And British police have arrested 2 more people in connection with that standoff at a Texas synagogue earlier this month. The latest arrests were made in the cities of Manchester and Birmingham, bringing the total number of people in custody in the country to 4. A man claiming to have planted bombs disrupted Shabbat service on January 15th, taking 4 people hostage. That led to an 11-hour standoff with Texas police. Officials shot and killed the suspect, though the hostages survived, and the FBI has said they are treating the incident as an act of terrorism and hate crime. Coming up on the other side, we are continuing our earnings discussion with Tesla on tap. Shares they're up more than 3% in this session. We'll discuss on the other side. We'll be right back.
Welcome back to Yahoo Finance Live, everyone. TSLA, we'll see what they say today. Deliveries, though, of 936,000 vehicles took place over the course of 2021, and the electric vehicle company set to report earnings after the bell. Seth Goldstein, who is the Morningstar equity strategist, joins us now with his expectations ahead of the earnings and quarterly results. So Seth, great to have you here with us. Help us preview this. You believe the good news is already priced in based on what I know from your take. So take us into your long-term outlook and why you believe that sales growth will slow.
Yeah, thanks for having me on, Brad. So Tesla, as we saw the market reaction to the fourth quarter deliveries numbers, they had a great 2021. I'm expecting strong earnings results to be reported when they report later tonight. You know, I think it sets up momentum into 2022, but over the long term, as there's more electric vehicle manufactured by other companies and other companies are able to see their EV costs fall, bring more models out, more chargers are built and charging times fall, then I think eventually Tesla will still be the leader, but not the only company that makes the high quality EVs that consumers demand. So I think they're going to see lower long-term growth rate, but I still think they're going to be a top 10 automaker globally by the end of the decade.
There's certainly two stories to be watching here. You know, number one, what those numbers show in terms of Tesla's performance, but also about how investors are now rating this stock. We've seen a number of big tech names really getting re-rated on the back of concerns with the rate hikes coming, potential with these high growth, high debt companies. Where do you think Tesla should be? I mean, what does fair value look like in this context?
For me, the fair value is $700 a share. You know, I think Tesla will be able to ramp up their vehicle sale. They'll be able to reduce their costs of production through introducing the new batteries and getting manufacturing efficiency, economies of scale. But at the end of the day, I don't think Tesla will be selling, you know, anywhere close to the 10, 11 million number of vehicles that is closer to what the stock's currently pricing in. And so I do think the stock's a little overvalued as investors are perhaps pricing in a little too rosy scenario right now. So again, I see a $700 fair value for Tesla.
And so going forward from this point, I mean, it's clear that the mass market Model 3 and the Y, that is kind of the continued production and delivery kind of being able to put the rest of the operation into focus. You know, where do you think that there are going to be other areas that need to build up their operational presence, as well as the ability for them to bring on more manufacturing online? We do know that Elon was making trips over to Berlin recently as well to check out progress on that gigafactory.
Yeah, so those are really the two key sources of uncertainty for Tesla right now. One, how quick will they be able to ramp up their Austin and Berlin gigafactories? And then two, with the Cybertruck, when will that launch? You know, Ford is seeming to increase its capacity and expand its growth plans for the F-150. Rivian's already producing trucks. Tesla is not going to produce the Cybertruck in 2022. Maybe they produce it in 2023, but at that time, they will not be a new entrant. They will be a little late to the party. And so, you know, the Cybertruck could be a disappointment if they don't get it out there quickly and don't prove that it is the best truck compared to, say, the F-150 Lightning.
I mean, you talked about competition in EVs. I mean, this is where things have really gotten heated. Is Tesla going for the same consumer when it comes to Cybertrucks as the F-150? I mean, we've heard from Ford talking about how they've brought in a lot of new customers into the fold who didn't necessarily buy a non-EV or drive a non-EV F-150. Now they're interested because of the shift.
I think it's generally going to be a similar consumer. If you're looking at a $50,000 higher price point for a truck, that's going to be a consumer who wants a more luxury auto. So, you know, whether they don't necessarily have owned a traditional pickup truck in the past, if they've gone more with luxury SUVs or luxury sedans, I still think at the price point they're going to sell the Cybertruck and the F-150 at, it is going to be that luxury auto consumer.
Seth, while we have you, given that we've been tracking cryptocurrency and the broader downtrend over the course of 2022 for sure, but a lot of that taking place even starting prior to the new year. With that in mind, what are you going to be listening to for Tesla to give more updates around its Bitcoin holdings, particularly on?
Well, we'll see what they do. If they are still planning to accept payment from Bitcoin or Dogecoin or other cryptocurrencies, or if that was something they were considering and they're still wanting to wait to see how they can value it and if it makes economic sense to the company. So, it would be good to get an update at the earnings call on how cryptocurrency will pay into what they allow customers to pay for.
Seth Goldstein, Morningstar Equity Strategist. Good to talk to you today. Appreciate the time. Well, coming up on the other side, we're going to be diving into other big earnings on the day. Boeing shares falling as the company posts its third annual loss. The Dreamliner particularly hitting the company there. And then AT&T, another company we're watching here as shares fall there as well on the back of their results. Before we go to break, though, step up your investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and more in an ad-light experience. Check it out today at yahoofinance.com/plus. We'll be right back. Well, shares of Boeing are falling in the session, down nearly 4% as the company posts its third annual loss. Let's bring in Yahoo Finance's Inez Ferre, who's tracking that action for us today. And Inez, Boeing getting hit in a big way from their Dreamliner.
Yeah, that's right. And a lot of this has to do with the costs associated with that Dreamliner program. I'll get to that in just a second. But let's take a look at the results for the company's fourth quarter. Adjusted earnings per share coming in at $7.69. That was a miss. Revenue also coming in at $14.79 billion. That came in below estimates. Now, the headline that we have with Boeing is that the company saw a jump in deliveries led by the 737 MAX. That helped Boeing return to generating positive cash flow for the first time in almost 3 years in the fourth quarter. And that came in ahead of schedule because Boeing had said that this would occur in 2022. But this has been overshadowed by those mounting costs when it comes to the 787 Dreamliner program, which has been delayed time and time again. Those costs now expected to come in at $5.5 billion. CEO David Calhoun saying in a statement after releasing the quarterly results that 2021 was a rebuilding year for us as we overcame hurdles and reached key milestones. So that positive cash flow, but still being overshadowed by those expenses with the 787 Dreamliner program. And Kiko?
Inez, I'll take it as we have you here. We also want to check in on AT&T because this is a stock that opened up higher on the day, but has since moved lower. They also reported earnings. So what's going on there?
Yeah, that's right. And basically, you've got Wall Street analysts that are not impressed with AT&T's results, particularly adjusted EBITDA, which came in at $11.3 billion, and the estimate was for $12.53 billion. So RBC Capital, Citi noting that that miss. Looking at their adjusted earnings per share, the company came in at 78 cents, revenue coming in at $41 billion. That came in above estimates. But as you can see, the stock is under pressure because of Wall Street analysts that weren't so impressed. Now, as far as the company highlighting its subscribers, this is something that they had highlighted previously, that the company added 4.5 million wireless subscribers in 2021. Its fastest growth, actually, in 10 years. Also, AT&T noting its HBO Max and HBO subscribers, which surpassed the high end of guidance with nearly 74 million total subscribers at the end of 2021. And AT&T CEO John Stankey noting in the earnings call that its rivals have been increasing their prices above HBO Max's price, saying that HBO Max doesn't have the pricing struggles of its rivals, alluding to Netflix's recent hikes.
All right, Yahoo Finance's own Inez Ferre tracking some of the big companies that have reported earnings here today, as well as the price action taking place and ensuing thereafter. Inez, appreciate the updates there. And on the other side of this short break, everyone, we get a little bit closer to the hump of hump days, if you will. The noon hour kicks off in just a few minutes, and we're getting even closer to the Fed's decision. That's coming at 2 p.m. Eastern time. We're continuing to keep an eye on U.S. markets going into that critical decision right now, holding on to some gains. The Dow is up by about 316 points, 0.9% there. S&P 500 holding on to gains as well of about 1.5%, and the Nasdaq up 2.25% roughly. We'll continue to break this down on the other side and what to expect from the Fed at 2 p.m. Welcome back to Yahoo Finance Live, everyone. Brad Smith here with Akiko Fujita. We're continuing to break down all of the market action today, heading into a critical decision that the Fed is forthcoming with at 2 p.m., plus more commentary at 2:30 p.m. We've got a lot ahead this hour, and so here's a quick preview of what we're expecting as the markets right now are holding on to gains. The Dow, the S&P 500, and the Nasdaq all in positive territory. The Nasdaq seeing the most gains on a percentage basis. That's up by about 2.2%, while the Dow is up 300 points at this point in time. S&P 500 up by about 1.5% there. During this hour, what to expect from the FOMC as they conclude their first policy meeting of the new year. Investors on the edge of their seats awaiting that decision and tone from the Fed. Then later on, we speak to a Sun Devil from Arizona State University. As colleges and educational institutions are getting creative with new programs to prepare students and professionals for the future of career paths. And finally, the Ford CEO details the biggest supply shock he's seen of his career, all while auto manufacturers continue to navigate the chip crisis. All that and much more during this hour. But let's begin things with the markets to let you know where things stand as we come into this, the 12 noon hour. And for that, I'm going to bring in Yahoo Finance's own Jared Blickery. Jared?
You bet. And let's take a look. We just saw Europe settle in the green about 30 minutes ago. You can see the DAX in Frankfurt, CAC 40 in Paris, all up 2%. And then in London, the FTSE up just over 1%. Want to show you the Nasdaq here. It's up over 2% today, maintaining its gains at the highs. You take a look at what's happened over the last 5 days. You can see some volatility there, especially when we apply the candlesticks, but really just bumping up against this potential resistance level. I don't think anything major is going to happen for a couple of hours, but here's what could happen. And let's take a look inside the market at some of our heat maps here. And I'm in suspense too. Here's the bank. We were just looking at those in the last hour. JP Morgan down 2%, up 2%, excuse me. Morgan Stanley up 2% as well. But when you look at the sector action today, it's a nice spread. Tech is in the forefront. That's XLK over here. That's up over 2.5%. Consumer discretionary, that is up about 1.5%. Those are the two outperformers. So those house some of the mega caps. But right behind the S&P 500 is financials, energy. So really the value and also the growth trade is up today. And then you look at some of the laggards here, you notice everything's in the green, but staples, utilities, those are the laggards, those are the defensive sectors. And so that's what you want to see when you're in rally mode. But of course, everything can change when Powell takes the lectern. Now let's take a look at the travel sector. We got Airbnb up 3.5%. It had a nasty slide down about 10% earlier in the week. Avis Budget Group, that's up 5%. And then Carnival Cruise Line and Norwegian up 3% and 4% respectively. Want to get to some of the commodity action because crude oil is on fire. Brent above $90 for the first time since 2014. That's pretty impressive here. And we'll just get a look at WTI as well. That is almost up. I think it has now exceeded its prior high from a few days ago. And that would be the highest since 2014 as well. So oil really on fire here. But you look at our commodities heat map, palladium and natural gas. Palladium's up 8%. That is used as an industrial metal. And then natural gas, we all know the story behind that, the energy crisis in Europe and whatnot. But energy really on fire here. And also I want to take a look at Bitcoin. We have Bitcoin up 3.5%, Ether up 7%, but it's really all about the rejection of the 33,000 level. Now, we didn't quite hit it the other day. That was on this nasty downslide that we also got in stocks, but nice to see Bitcoin recovering a bit here. And it looks like we got a little bit of time, so I'm going to go through some of our heat maps in the tech sector because that is a leading sector today, and we can see NVIDIA up 4%. Texas Instruments up 5%, and Applied Materials up 4.5%. But now I want to send it back to Brian so he can inform us what's going to be on Chair Powell's mind today.
Excitement, so much anticipation for what's going to happen in 2 hours, but it is still 2 hours away, so get your lunch. You have some time, but I'll give you a little bit of a breakdown on what to expect so you don't lose your lunch when we do get to that announcement later on. Really, we are not expecting any sort of change to interest rates. The Federal Reserve is still in the process of expanding its balance sheet, so any new update that we're going to get is not only going to be on the front for the projections for where they want to and how they want to hike rates later this year, but also on whether or not they plan on starting to actively reduce their nearly $9 trillion balance sheet later this year. But of course, all the commentary and color is going to come from the Fed chairman's press conference, where he can offer a bit of a new outlook on inflation in terms of when they might expect to see some of these high year-over-year readings start to decline. Again, remember, the CPI reading on a year-over-year basis showing the fastest pace of price increases since 1982. Now, one other important thing to watch as we get to that 2 p.m. line is really going to be the 10-year yield. Now, the financials of all of this are going to be very interesting, and Jared has been watching this very closely as well. But the U.S. 10-year is currently floating at about 178 basis points. And what we need to look at is not just the 10-year yield, but the spread between the 10-year and the 2-year, what's colloquially referred to as the yield curve, the difference between the spreads in those two assets. And it was as high as about 90 basis points in the beginning of this month, just about 2 weeks ago. That has since declined to about 76 basis points. Now, the reason why this is important is because as the Fed messages and then eventually starts to raise short-term interest rates, which is pegged towards the 2-year yield, that could tilt the yield curve closer and closer to flatter and maybe into the negative. If it does do that, they call that a yield curve inversion. That has historically been a bellwether for a recession. So a big question for the Federal Reserve as they start to think about raising rates: how worried are you about inverting the yield curve? Would you prefer tighter financial conditions or a steeper yield curve as you start to do that? That could very much be indeed the focus of that 2:30 press conference. So take a close look at the 10-year as we do get closer to that 2:30 press conference, which we'll have the full coverage of right here on Yahoo Finance. Guys.
Brian Chung, appreciate the updates there. Yahoo Finance's own Brian Chung, as well as Jared Blickry that you heard from on the markets. Let's get back to the markets as well as we're tracking in this lower corner of your screen, as you're seeing there. Major averages still holding on to gains. We want to bring in Jason England, who's the Janus Henderson Investors Global Bonds Portfolio Manager. And Jason, just to lead us in here, I want to get your expectations for what the Fed may signal today.
Yeah, sure. Thanks for having me today. I think Brian stole a little bit of my thunder. I think our expectations are they're going to play it straight down the middle of the fairway, keeping rates on hold. And really the things that we're looking at here is the signaling of the March meeting now probably being a live meeting for liftoff, and then the deeper discussion they're having around the balance sheet and what they're going to do with that this time around, how they're going to use that as a tool in order to reduce it. Obviously, it's at a much larger level than it was post GFC. We're getting close to $9 trillion now on the balance sheet. So that's something that they're going to really, I think, use a lot more this time around and not wait as long as they did the last time.
Well, Jason, we're talking about how much expectations have run up and down in this month since that previous meeting. What do you think investors want to hear? What do they need to hear to try to calm some of the jitters we've been seeing?
Yeah, I think you really want to hear that the Fed isn't behind the curve. I think really the market thinks that, and a lot of the economists out there think the Fed has been behind the curve on inflation and they've missed the call on inflation. But there's also the concern if you push it too hard and you start removing this accommodation too quickly, then you could push us into a recession. Brian noted, inverting the yield curve. If you start hiking and you start getting the front end rate too high and the 10-year doesn't move, then you're going to invert the curve and you could signal a recession and slow growth. So I think that's kind of the key here for the Fed is threading the needle. Jay Powell's done a good job. Chair Powell has really communicated well what his intentions are. Now, maybe you're going to hear arguments that he's been behind the curve on inflation and he stuck to that transitory too long. But I think they're in a spot right now where they feel, March will be a live meeting. They can start moving that, and then they will start looking at balance shortly after, 1 or 2 hikes. They can start looking at removing some of that balance sheet accommodation.
It's interesting, especially going forward from here, where investors are going to place their own bets, if you will, or more aptly, I should say, some of their own interests moving forward from this point as they continue to try and time the Fed's decision and how quickly the Fed may make some of those increasing movements to combat inflation as well. So where are some of those sectors, those opportunities that you're seeing investors perhaps pile into even ahead of this decision coming forward?
Yeah, I think one area is, Brian pointed out the flattening of the yield curve. You can take advantage of it if they start to hike, and especially if they hike aggressively, like some have predicted in the market. The Fed's only, showing 3 hikes. The market is pricing in 4. So if they do go that aggressive, and if they do start hiking every meeting, then than the quarterly meetings. You could see the front end of the curve really move, so you can take advantage of the flattening of the yield curve. I don't think it will be long term, because at some point, the Fed's going to want a steeper yield curve. So if they start to try to adjust the balance sheet and start to run off the balance sheet, and maybe potentially even selling assets, which they didn't do the last time, that could help the back end of the curve and try to control that. Obviously, they don't have as much control over the back end as the front end, but I think they will try to make sure that they don't, push it too much where they start to invert it and we start seeing signs of recession or slowdown in growth.
Jason, we've been watching the 10-year and 30-year very closely and pushing a little higher today ahead of that Fed meeting. But how do you think that investors should be looking at the fixed income space? What are you advising your clients?
Yeah, so for our clients right now, we run a short duration product. It's global, so you wanted to be diverse around the globe and different. All of these countries went down the elevator fastly to, during COVID. Back in March of 2020, all the central banks went to the zero bound. So now you want to see how are they all coming and exiting out of this. And as a client of mine likes to say, they're coming up the escalator at different degrees. So really taking advantage of, being shorter in duration, not having a lot of duration in countries that are a little bit further ahead of maybe the US or the RBA, in Australia. And you really want to take advantage of having less duration and exposure, because if you start seeing rates move up drastically and the Fed starts to really push the needle here, then you will see, fixed income investors can get hurt if you're holding a lot of duration. So you really want to minimize that in your portfolio right now.
Certainly some good takeaways there. Jason England, Janice Henderson, Investors Global Bonds Portfolio Manager. Good to talk to you today. Appreciate the time. We want to turn to some breaking news out of Washington, and we're talking about the highest court here. The Supreme Court Justice Stephen Breyer announcing he is retiring after more than 27 years on the bench. This according to NBC News. So he himself has not confirmed it. We're going off of NBC reports. This, of course, provides a big opportunity for the Biden administration to tap a liberal justice. Of course, Justice Breyer has been facing some pressure here to retire because of the bend that we have started to see on the Supreme Court with 6 conservative justices. Remember, there were 3 justices that were nominated under President Trump. So once again, multiple outlets now reporting that Supreme Court Justice Stephen Breyer is stepping down from the highest court after more than 27 years on the bench. Let's turn our attention to one stock that is moving in a big way, and this is part of the broader upside we've seen in the chip space today. Texas Instruments getting a lift in the session, sort of joining the broader gains that we've seen on the back of a really strong quarterly, a really strong earnings report here, up nearly 5%. The chipmaker earned $2.27 a share on revenue of $4.8 billion, though both coming in well above estimates. Revenue came in at $18.3 billion on the year, and that marks a near 30% growth from the previous year. The company also issuing better than expected guidance, saying now it expects Q1 revenue to come in between $4.5 and $4.9 billion. And we've seen a lot of the other big chip names up in the session today as well, but Texas Instruments moving about 5%. Coming up on the other side, Arizona State University, I should say, launching an ambitious drive to enroll 100 million new students by the end of this decade. And they're getting big help from tech. We'll explain on the other side. Arizona State University is looking to expand its student body in a big way, launching an ambitious drive to enroll 100 million new students by the end of this decade. And they are getting a big lift from emerging technology. Let's bring in Dr. Sanjeev Kagram. He is Director General and Dean of ASU's Thunderbird School for Global Management. Doctor, it's good to talk to you today. So interesting to hear how you're planning to expand this. Artificial intelligence, a big part of it. Talk to me about the vision.
So thank you so much, Akiko. First of all, I just want to be clear that it's 100 million learners. Some people get confused, and there's a difference because we have a 5-course certificate we're launching, digital, translated into 40 different languages at no cost to the learner. For each course they take, a learner around the world, and with 40 languages, we have up to 90% of the world's population, they get a badge. They finish a badge, they finish each course. After 5 courses, they get a certificate. And if they apply after that, they can get 15 credits, which is a certified certificate that they could transfer to any university in the world, of course, to Arizona State University itself. So that's the great vision. 100 million learners taking courses that they get badges for in 40 different languages at no cost to them, that prepares them for the new global economy.
You know, when we think about what prompted this initiative, what went into it, especially after a time where we did see some of the global enrollment and international students, because of the pandemic and some of the uncertainty around it, declining to either return to some of those 4-year universities that they were on campus at or enrolled at, and what went into that decision-making process to try and re-engage with the global community of students?
Well, the Thunderbird School of Global Management has been around for 75 years. We have 50,000 alumni in 140 countries. We've touched almost 2 million people. Arizona State University has the largest online, one of the largest online programs for students around the world, everywhere on the planet. So this is not something new for us. Certainly COVID has accelerated and accentuated the need. By 2035, Brad, we have 440 million individuals around the world that are looking for higher education. That would mean building tons and tons of new university campuses, and that's not going to happen. So our charter at ASU, Arizona State University, is to judge ourselves by who we include, not who we exclude. And that we wanted to take global. So inclusion, innovation, and impact at worldwide scale required a transformative initiative. And that had to be 100% digital, very active engagement, but 100% digital, different languages so we could get it to many different people around the world and make it accessible, so no cost to the learners.
Talk to me about how you're integrating AI and machine learning in all of this. I mean, are these learners going to be engaging with a teacher? I mean, how is this course going to play out?
So think about it in stages. In the first stages, there's going to be the courses that are built out. The first course is going to be launched in the first week of April, subsequent courses through the course of this year and into next year. The first phase will also involve about translation to about 7 to 10 languages and then up to 40 languages. When we first launch, of course, it's going to be digital online. So there's going to be videos and interactive exercises and so forth and so on. There'll be faculty associates. But as we continue to grow, and with the large numbers, we're going to use modern data analytics, machine learning, AI to create chatbots, interactive capabilities with AI, so that in fact it becomes fully automated over time. We'll always have a human component. We have centers around the world with Thunderbird and Arizona State University. We have partners around the world. So there's always going to be a human component. But as we grow in size, more and more will be able to be done interactively using AI, automation, machine learning.
With hybrid learning as well, it's thrust a lot of attention on the necessary technology capabilities or components that a student has to have in order to remain connected to the experience, to that educational infrastructure, if you will, and the programs that are being put forward. So what kind of requirements are put on the students, and where does the university step in, given that this new program is free?
Well, that's an important thing. That's why we call it no cost and not free, because the students will have to have access to technology. And we'll certainly do as much as we can with our partners around the world to get them access to that. They have to get access to the internet. Of course, they could download it. There's many, changes and evolutions that have happened, innovations since the pandemic to get more students, more learners around the world access to technology and the internet, but those are prerequisites to get access. While there is no cost for the tuition side, we're investing millions and millions of dollars. We had an incredible gift from our benefactors and co-intellectual architects, Francis and Dion Najafi. Obviously, Arizona State University and Thunderbird, we're investing millions. The students have to be able to have that technology, and we'll work with partners and that internet access to make that possible.
What does ASU get out of this? I mean, sure, it's an additional revenue driver. Is that the motivation? Is it about getting the ASU name out more globally? What do you see?
No. So, Thunderbird joined ASU after being around for 70 years. We were an independent nonprofit institution, academic institution, about 8 years ago. The vision of our incredible leader, President Michael Crow, is, again, inclusion at global scale. This is our mission. We are committed to empowering and educating learners around the world for the 21st century. And the combination of Arizona State University and for Thunderbird, our vision is a world of sustainable and equitable prosperity. So this is all about, as I said, inclusion, innovation, and impact at global scale.
It's so great to have this discussion here with you today, Dr. Sanjeev Kagram, who is the ASU Thunderbird School for Global Management Director General and Dean. We appreciate the time here. We got to check back in the future to see how the program has moved forward. Also, everyone, on the other side of this short break, coming up, if you tapped your retirement savings as a financial bridge during the height of the pandemic, then you're not alone. We dive into an AARP survey quantifying how many others may have been included within that move as well. Welcome back to Yahoo Finance, everyone. For many, the pandemic has taken a financial toll to lost income, or due to lost income at least, increased medical expenses, or even taking on new risks. And we've got some research that we're going to dive into that actually shows that many have turned to their retirement funds for help. In fact, 1 in 4 Americans dipped into their retirement savings or stopped contributing to their accounts at the height of the pandemic, according to a recent survey by AARP. Now, 2 years into the pandemic, an alarming number of people have yet to get back on track. Here to break it down for us, we've got Vera Gibbons, who's the Yahoo Finance contributor, helping us really put more context around this story. So, Vera, what particularly do we know about the number of people that have taken this decision and where they are on track to trying to get back to some of their retirement savings?
Well, you mentioned that 1 in 4 Americans dipped into their retirement during the height of the pandemic, or they stopped contributing altogether. That's from AARP, and that's a survey of workers 25 and older. Then there's another survey from Kiplinger that shows an older bunch of Americans also dipped into their 401k or stopped making any kind of contribution. So the numbers are sort of startling. I mean, in 2020, it was easy because you could take up to $100,000 out of your retirement accounts penalty-free under the age of 59 and a half. So a lot of people actually took advantage of that legislation. The problem now is that a lot of people are still behind in their retirement. In fact, there was a survey from Bankrate showing 52% of Americans feel that they're behind in their retirement savings. So some people, for the pandemic was a wake-up call saying, oh, geez, I need to beef up their retirement, or I need to plan ahead, or I need an emergency account. For others, though, they just did it out of necessity because of lost wages or they lost their jobs. And now they're feeling it.
Vera, specifically, who's tapping into these accounts? Are we talking about younger workers who have decided that they want to quit their jobs, they're not happy, but they may not have the funds? Are these older workers who were hoping to be able to tap in, a little later in life, but just out of necessity have had to do it?
Well, Akiko, Bankrate says it was primarily the younger workers, but there is that survey from Kiplinger showing older workers too. So I think it was a bunch of different people, and they did so out of necessity. Like I said, they lost their job, or their wages were cut, or they just needed it, just for basic expenses. I mean, we are in an inflationary environment here, and some of the experts I spoke to said, given the fact that costs are going up for just about everything, they expect more people to actually tap into their retirement accounts or contribute less this year. Also, keep in mind that people are still quitting their jobs at a record rate, and that group may also be tapping into their retirement accounts too to cover their costs. And a number from digital.com shows that 2 out of 5 people who quit their jobs are actually going to start their businesses. And where are they going to get that money? They say there's a high probability they will tap their retirement accounts to actually fund these new ventures. And then there's also an interesting sort of disturbing trend emerging, and I discovered this over the course of reporting, where people just feel like they want to live in the here and the now. They can't plan ahead. They don't want to plan ahead. They've, come to realization that life is actually fleeting. And this group of people is going an entirely different course. I spoke to one young worker in his young 40s. He actually pulled his retirement account, closed it out after paying taxes and penalties, and bought a whole life insurance policy. And he said he did this because he realized that nothing in life is certain anymore. He wants a guarantee. And this whole life policy at least guarantees him regular payouts until he's like over 100 years old. So he wanted some certainty. He wanted more flexibility. And he said no more retirement for him. He went a totally different route. And I suspect more Americans may be thinking about going that route as well.
And so have people who rated their retirement accounts or tapped those retirement accounts for one reason or the other, have they started to replenish these accounts? Do they historically, by some of those measures, do they typically start to replenish them?
They don't. I asked Greg McBride of Bankrate that very question, because I'm like, well, when people pull, don't they eventually put money back in? And he said it becomes less of a priority because the people who do tend to tap their accounts have other debt responsibilities, other family, friends, members of their family and members they have to pay back first. They have student loans. So replenishing their retirement savings becomes sort of the lowest priority on the totem pole. And he said generally it's a one-way street. The money comes in and very, very infrequently does it go, money comes out and very infrequently does it go back in.
Vera, I have to wonder if there's a lot of people who haven't made this move just yet, but they're watching the action in the market saying, well, what's actually going to happen to my pension fund? I mean, how do you think they should be approaching that?
Yes, I mean, the market has been putting all of us on edge the past couple of days. I think people have been checking their portfolio saying, knee-jerk reaction, sell everything. Maybe I just need to get into real estate. That's the last thing you want to do is have that knee-jerk reaction. You want to keep your emotions out of it and just maintain that, all-weather diversified portfolio. It's nice to have dividend-paying stocks. It's nice to have that diversified portfolio. But I feel like so many people, especially the younger workers, have been taking a gamble on all sorts of alternative investments in crypto that they're just, not thinking ahead. They're not thinking forward to their retirement years. They're just thinking the here and the now, and they want money now.
Yeah, important to take just a deep breath. It's easy to get caught up in all the volatility. Vera Gibbons, always good to have you on, Yahoo Finance contributor. Well, coming up, Ford doubling down on software as it lays out an ambitious plan to scale Ford Pro. A conversation with CEO Jim Farley is on the other side. Well, Ford has made an ambitious push into EVs with the aim to go all electric by 2035. The company, though, now doubling down on software and services. CEO Jim Farley spoke to our very own Brian Sazzi about the company's ambitious plan to scale Ford Pro and why he says NIO and Tesla are Ford's biggest competitors.
Ford Pro is something we started about a year ago. We've been building it out. This is the first time small, medium-sized business, about 90% of all commercial customers. We're almost 50% share in this business. We'll get a full one-stop shop offer from Ford to allow them to finance their vehicle and their charging, having charging and energy management software and hardware for their new electric vehicles, telematics solution for them, and a full service, including remote service for the physical repair of the vehicle. We're going to offer that for Ford and also non-Ford customers, and it'll be the first time in the industry that anyone's ever done that.
Why the decision to open it to non-Ford customers?
Because so many of our fleets, look, we're 50% of the market. We're #1 brand in Europe as well. But still, our customers, some of their vehicles aren't Ford, but they still want telematics solutions. They still want financing products. They still want servicing. And we can do all of that. So we just want to make it easier for customers. So that's why we decided to make it not just Ford.
Your E-Transit electric vans, when do they start arriving to customers?
Soon. We're just in the final production right now, preparation. We should be launching, very soon. We have over 10,000 orders already from a lot of different customers. I think we just got over 1,000 orders from Walmart. So the demand is very high. There's a lot of focus on Lightning and, of course, the Mustang Mach-E and how sold out we are. But actually, E-Transit is strategically very important for the company because of our dominant position in commercial. A lot of Lightning customers are retail customers. Some are commercial, but an E-Transit is going to be 100% commercial. So this is our, first foray into electric and digital vans.
10,000 orders. That's a significant amount of orders, Jim. Are you still taking orders for these vehicles? I know you closed down orders recently for the Maverick pickup truck.
We're getting close. We had to close down reservations and orders for Lightning as well, not just Maverick. Mustang E is sold out for Mach-E is sold out for quite some time. We're getting close. We're not there yet. Commercial customers are a little different. They want to know if their racks fit, if their equipment fits. They want to test out the vehicle. They want to make sure the operators feel comfortable. And then you have to install charging equipment, both in the operators, maybe home sometimes, or even depot charging. So they take a little bit more time to get the orders correct. But I wouldn't be surprised if we're sold out on E-Transit.
You've been around this industry for some time, Jim. Did you ever think we would get to a day where you're essentially telling folks, well, we can't take any more orders for one of these vehicles we're selling?
No, I never thought we'd be in that position. A lot of people said about Ford's strategy to get out of sedans. Why are you doing that? The Fusion's very popular, but they didn't see that we could invest it in Maverick and the Bronco Sport, the Lightning, the E-Transit. These products are so exciting. But we have the chip crisis going on at the same time, probably the biggest supply shock I've seen in my career. So all of it is happening at the same time. But I think the real encouraging thing is that Ford can develop great products where we do really naturally well, and we're being handsomely rewarded for focusing on our strengths.
Definitely want to talk about the supply shortage. It's something you and I have talked about. You and I have talked about in the past. But just on the Lightning, how many orders do you now have for that?
We have about 200,000 reservations. Now we're converting those into orders where people have to physically order the vehicle. Almost very few of them are falling out. And, our original capacity was like 40,000. We went to 80. Now we're at 150,000. So, we actually, it's incredible how nimble the company's been in upping our capacity. But it's really encouraging to see.
In terms of capacity, I know Ford has moved very quickly in adding extra capacity for electric vehicles with an eye towards really 2025. But just given the demand you're seeing for these electric vehicles and even hybrids, what's the next move by Ford? Are you looking at now a new series of electric vehicle investments?
Well, I think the first thing for us is to scale. A lot of people have come out with electric vehicles, but our ambition is to get to 600,000 units of scale for our electric vehicles in 22 months. That means sometime later next year in the third or fourth quarter, we'll have a production of about 50 to 60,000 units a month. That is a huge scaling by the company. It requires us to more than double our capacity we had planned on already. So this is a huge scramble by the company. That's our first milestone, to get to 600,000. We think that'll put us, probably number 2 on electric. We were number 2 in the U.S. in sales this year. We now want to be number 2 with our scaling of our electric production globally. And that's before Tennessee comes online, which is hundreds and hundreds of thousands of incremental products in 3 years from now. We're breaking ground on Tennessee right now and the Kentucky battery plants. So that'll give us even more capacity. So right now we're just busy scaling. We have hits on our hands. We just need to make more of these.
Does it feel like an arms race inside the auto industry? Every day there's a new announcement of new EV vehicles, new EV capacity. What does it feel like to you right now?
I think everyone's really excited. I wouldn't be surprised if some of them have seen the response by Lightning and Mach-E and very encouraged. but I wouldn't treat them all the same. I think what we found is sticking in our wheelbase on F-150, Mustang, Transit, and really executing very emotional products, even commercial vehicles, very emotional products, and giving them a lot of data capability and digital capability is work for us. I think we're scaling before a lot of competitors. Yes, a lot of people are investing. Yes, there are a lot of investments in manufacturing. What I'm encouraged is that in this first inning, our vehicles are sold out. And we're not going to generic small cars. We're really focusing on what we do well, which are those three vehicles.
You're a competitive guy, Jim. You race cars. This is well known about you. I mean, who do you think is your biggest competitor in the EV market? That person where you sit in your office, wherever it might be, and say, hey, I really want to beat them, and I really want to beat them bad.
Well, the companies that I think about that I admire because of their commitment and, frankly, the hard work they did to earn their reputation, companies like NIO and Tesla, they've been at this a long time. They engineer their vehicles differently. I'm most respectful of Tesla's profitability. They're now making more than $10,000 a vehicle in their second quarter earnings. But I think Ford has a real chance here. We're not going to be in the same segments as them. We're really doubling down on the customers and the segments we know really well. F-150 has been the best-selling vehicle in America for 40 years. And now we're electrifying it. We're just getting started. So I love those companies, but I think we have a wonderful opportunity at Ford. Maybe one we haven't had since the Model T.
Ford CEO Jim Farley speaking to our very own Brian Sozzi. There are some interesting notes there, Brad, talking specifically about the incredible demand that Ford has seen on the F-150 Lightning. You talked about 200,000 reservations so far. And this is a story that's so important to watch, especially Ford and GM, because the thinking is with EVs, if you want to get to full adoption here, you've got to have the biggest car makers in on this. And it's interesting to see that competition between Ford and GM, not just on the cars, but also building out the manufacturing and those supplies that go into those vehicles.
Yeah, not speaking his competitors by name, especially in that pickup space, knowing that GM is going to be moving forward with their own Silverado EV, as well as the new player on the block in Rivian, which has been getting a lot of fanfare and has already seen some orders. Now it just shifts towards production. And for all of these companies, getting the battery right on a larger type of model than what we've seen in the mass market models that Tesla has put out there, popularly the Model 3, and even prior to that on the sedan front. I think the battery, that's going to continue to be the challenge, and we'll see how quickly and swiftly the production is able to be ramped up and where they find some of those operational overlaps as they do try to overhaul their overall their plants and their ability to produce a lot of these electric vehicles as well. But not speaking GM or Rivian by name, so we'll see how that particular competition in the pickup space revs up from here too.
Yeah, NIO, an interesting one. Tesla seems like an obvious one to mention, just given their leadership in the space, but interesting for him to point out NIO as well. You talk about battery production. I mean, we had that announcement yesterday from GM about the big investment in battery production. So it's certainly, I mean, everything going full speed ahead on the EV space, particularly with manufacturing building out here in the U.S.
Yeah, absolutely. You're taking a look at the comparisons between Ford, Tesla, and NIO on your screen as of right now, two of the companies that the Ford CEO admires. As we are continuing to keep tabs on the markets as well today, you're seeing the Dow, the Nasdaq, and the S&P 500 all holding on to gains on the other side of this short break. We are going to tee up how you can expect that market activity to continue to move forward, perhaps, especially as we get closer towards the 2 p.m. hour when we've got that Fed decision. Our own Jared Blickery is standing by on the other side of this short break. We're inside of 75 minutes until the Fed's decision here. And as we're awaiting that decision, we're keeping a close eye on the markets here. Major averages holding on to gains here. And we want to bring in Jared Blickery, who is standing by with more of a breakdown of exactly what we're watching going into that key decision. Jared, I'll toss it on over to you.
I'll tell you what, we get Fomc Drift most of the time. This is an Fomc surge, pretty rare event, but par for the course given the recent volatility. And today it's to the upside, just hitting session highs just minutes ago. The Nasdaq up about 2.75%, as you can see there. S&P 500 up about 1% less than that, and the Dow holding on to gains of about 350, 360 points right there. But it's really about the growth stocks today, and that's what I kind of want to focus in on. Here's going to be, there we go, here are the meme stocks. This is a pretty good sentiment indicator of where we are with the markets. If I put a year-to-date view on this, it's going to be 16 days. You can see all the dark red in the space. GameStop down 25%. Hertz reclaiming its ticker after bankruptcy. That's down 20%, and you can get the picture there. But today, we are seeing a lot of risk on, and we're also seeing that in some of my sentiment leaders here. You see at the forefront, that is SOX. That is the chip index, followed by ARK Innovation Fund. Those components doing well. Then we have solar energy, IPOs, gambling, software, momentum, all of those taking the top spot here. What's not working today? Well, it looks like KWEB, that's the Chinese Internet ETF, and also regional banks, and then low volatility. You wouldn't expect much from that. Just looking at the sector action here, we do have tech in the forefront. That's up over 3%, followed by consumer discretionary. That's where Amazon sits, and those are the two outperformers of the day. As I noted a little bit ago, nice to see energy and financials on that top row too. That means the value trade and the growth trade are working out today.
I mean, speaking of some of those growth names, Jared, EV startups especially getting hit hard recently in the sell-off. We're seeing Rivian up in a big way. What's happening there?
Well, we just got some breaking news. This is a Bloomberg report saying they're going to ramp up production to 200 vehicles. I believe it's per quarter, per year. Maybe it's a month. I'll have to check on that. But nevertheless, we can see stock was already up about 5%, and now it's up 10% on that news. Rivian has been going through some difficulties because of Omicron. They had already been ramping up or trying to ramp up. I think they were doing 50 trucks per month, something along that line, so a very small amount. But finally getting in gear, putting Omicron behind them, and we can see the stock is up 10% today. But you take a look at year-to-date, still down 36%. I'm going to put the year-to-date on this heat map here so we can see it. And yeah, a lot of carnage here. But it's interesting to see the outperformers, Toyota Motors and also Volkswagen. Those are two stocks that are in the green, guys.
Okay, Jared Blickery with a wrap-up of the market moves so far. Coming up on the other side, one big bank going to great lengths to try and retain their employees. A lucrative stock option package is on the table. We're going to be discussing that on the other side. We'll be right back. Well, the competition for workers are leading to some hefty payouts, at least for one big bank. Bank of America reportedly offering a pool of $1 billion in restricted stock to boost compensation. Brad, we've been talking a lot about the challenges in retaining workers. No question, this is part of that move. When you think about the fact that this would apply to about 90% of the global workforce for Bank of America. How do you feel about this one? I mean, we're talking about employees who earn up to $500,000.
Right. And out of the total 200,000 employees that they have, I mean, you mentioned that 90% employee figure. At the end of the day, I think for the banking sector particularly, there has been a lot of pushback on just what the workforce has had to navigate for within that financial services part of the financial services industry for Bank of America and many of their employees. For some of them, the burnouts that they've cited as a reason to leave their positions. For some of them, just looking at what they're making and having competitive offers elsewhere. And so retention very much in focus, especially within the financial services industry, as well as other sectors for sure. But considering this is going to go to staff that make as much as $500,000 a year, as you mentioned, and it's, I think, up to 97% of the global workforce actually being eligible, and the fifth year as well that we've seen some of these compensation awards as well. So for Bank of America, it comes at a time of that increased competition in trying to retain that talent and not having them go off somewhere else, perhaps in DeFi or in crypto or even into other areas where you're seeing a lot of investment, even in the tech space, and bringing over some of that financial services industry talent, as many of those startups even try to chart a path towards perhaps making a public splash and debut. There's a lot of overlaps between that deal making and the VC space. And so we'll see if this retention effort works.
Well, I mean, the tech space has been quite successful over the years in luring some of these big names from financial services sector. So that's one. I mean, there's enough competition among the big banks, but you add to that mix the fact that you don't necessarily have to live in the city or that the company that you work for is located in. That really opens things up for a lot of these workers who are potentially or perhaps working at the big banks saying, I want a bit of a change here and move out of the sector altogether. There's a lot of money to be had on the other side, especially in tech. And we're talking about worker retention, but here's another headline that I thought was kind of interesting coming out of Amazon, reportedly announcing, or reportedly, according to the information, halting their pay to quit program. This is a program that Amazon has had in place since 2014. Remember, we see the company ramp up in a big way during the holidays. And in the past, they've paid out about $5,000 for workers to quit. I mean, essentially, it was the company saying, well, we don't necessarily need you anymore, but in a way to say, I think Jeff Bezos put it, this is a time to think about whether you want to make that next move. Well, Amazon, according to the information, is scrapping that. And that to me is an interesting one because we've heard about the challenges, especially around COVID and keeping workers on the job with so many people calling out sick. And you have to wonder if Amazon is facing that as well at a time when they are continuing to see big demand, especially on the e-commerce side.
Yeah, and it's particularly noteworthy on the fulfillment center side. Some of the horror stories that we've seen come out of those particular on-premise jobs. And for retention within Amazon, it also comes at a time where we do know that there have been unionization efforts. Even if they were failed in Alabama, in Bessemer, Alabama, that doesn't mean that there won't be learnings from that particular instance where they might see some of those instances pop up once again in other fulfillment centers. And so the name of the game here today in our hot takes, retention for sure, and two very different companies trying to navigate that.
Yeah, certainly a tale of two stories here, but really pointing back to the challenges in the labor market overall. That does it for us in these 2 hours. Of course, we've got just one more hour to go until we get that statement from the FOMC. No question, a lot of investors focused on that one. We are seeing all three major indices in the green right now. A big bounce back in tech. The Nasdaq up about almost 3% there. Much more to come here on Yahoo Finance Live. Keep it right here.
It's decision day. Wall Street awaits the Federal Reserve's announcement on how it plans to beat back high inflation. Will investors get the clarity they're looking for? We'll bring you the Fed's decision live 1 hour from now, followed by Chair Jay Powell's press conference. Bitten by the EV bug, Bentley will invest $3 billion over the next decade to become a fully electric vehicle brand. We speak with the CEO of the luxury British automaker about their ambitious timeline. And thinking about launching a side business? Well, we've got some tips on how to juggle your side hustle without jeopardizing your 9-to-5 job. Hello, everyone. Welcome to Yahoo Finance Live on a busy day. I'm Alexis Christoforous, along with my co-host Karina Mitchell. And Karina, looking at the market right now, stocks staging a strong rally as we head into that Fed decision. And it's the tech stocks recouping some of those steep losses from the past few days.
Oh, you are so right, Alexis. And it's so nice to see some green on the screen for a change. And Microsoft, a big reason why it reported strong earnings. And the stock is up about now 5% last I looked, all on a nice earnings beat and better than expected, just under 5% now. All on a strong earnings beat, however, and better than expected cloud guidelines. Let's get you over to the benchmarks now and see what's happening there. Everything is in the green, as of course the Fed is in the spotlight, expected to signal the first rate hike since 2018 in March. And looking at the major benchmarks, you see the Dow is now up by about 300 points, 309 points now. The S&P also up by 66, and the Nasdaq there, the outperformer, up at about session highs. It is up 336 points. Helping it is Tesla, which is rising higher ahead of earnings after the bell. Sector-wise, everything in the green. Tech, the biggest winner. Consumer staples is the laggard. And want to head you over now to the bond markets ahead of that Fed update that we get in just over an hour. And looking at the 10-year yield, it is flat, unchanged. 30-year yield is down slightly, as you see there. But of course, all eyes on what the Fed reveals in its latest update. As I said, that comes in just about an hour from now. And here with a preview is Yahoo Finance's Brian Chung. And Brian, after its quiet period, everyone's so anxious to hear if the Fed has any shift in tone or policy coming up.
Absolutely, Karina. It's been about 9 days since we've heard from any Fed official. That's part of the customary blackout period headed into any policy setting meeting, but the time is almost here. You can see on the clock, I think it's this direction. There we go. 56 minutes left until we finally get that long awaited decision. But I want to caution, not much is going to happen immediately today. And that's because the Fed is expected to hold interest rates steady at near zero. And the reason why is because the Fed still has some work to do on its balance sheet. Keep in mind, the Fed is still snatching up U.S. Treasuries and agency mortgage-backed securities to the tune of many billions of dollars per month. The Fed plans on slowing that to a full stop by mid-March, after which the Fed says it can begin tightening the process by implementing these interest rate increases. The Fed didn't want to do interest rate increases at the same time that they're buying assets in the open market, because those two things are kind of in contrast to one another. Now, of course, the Federal Reserve will have some commentary with regards to the outlook on inflation and the possibility of how many rate hikes we should expect to see later this year, perhaps starting as early as March from the Fed chairman's press conference, which will be happening at 2:30. The Fed chairman, despite the fact that there might be no immediate movement in today's meeting, might offer a little bit more color and offer a little bit of guidance in terms of what markets should expect in terms of the aggressiveness by which they want to tighten their spigot on their pandemic era easy money policies. Now, of course, that statement, which is going to come from the FOMC, will come out at 2 p.m., followed by the press conference at 2:30. And of course, we'll have the full coverage of all of that right here on Yahoo Finance.
As we always do. That's right, Brian. And I guess for a lot of investors, they want to know that timeline of when the Fed is going to start to reduce its balance sheet. But I wonder if Jay Powell is going to give any color on whether they view rate hikes and balance sheet reductions as complements or substitutions for each other.
Yeah, absolutely. And that's a big reason why, despite the fact that no action is really expected today, there's so many eyes on that press conference and ears on that press conference, rather, because of how the Fed is going to tee up that process. Here's the general way that we're hearing it could happen. The balance sheet expansion will end in mid-March. At that point in time, the Fed might begin raising interest rates. And then somewhere after that point, perhaps 25, 50, 75 basis points into the process, the Fed can start the process of actually actively allowing its balance sheet to shrink. It's getting really close to $9 trillion. You can see it's still on the uptrend, though. So does the Fed start to allow that trend line to go down? Well, the likes of Goldman Sachs are speculating that could happen sometime in July. Others are saying maybe that announcement comes in the Fed's Jackson Hole meeting in August. Regardless, it will be later this year. And the reason why that's so important is because if the Fed can allow U.S. Treasuries to roll off of its balance sheet, that might have the effect of tilting longer-term rates like the U.S. 10-year a bit higher. If the curve steepens a little bit, maybe that allows the Fed to hike interest rates and quell inflation with fewer 25 basis point hikes than they would have otherwise if they were not shrinking their balance sheet. Very inside baseball, but very important as we get to the second half of this year.
So much to consider and so much for the market to react to. Brian Chung, we'll see you at the top of the hour. Thank you. Let's stick with the markets and the Fed and bring in Daniel Morris, Chief Market Strategist and Co-Head Investment at Insight Center for BNP Paribas Asset Management. Daniel, big day here for Wall Street. We've seen all the volatility this week heading into the Fed decision. I'm curious what you're going to be listening for in particular during today's Powell press conference.
Well, it really is for us. It's crucial what's going to happen with the balance sheet as the Fed hikes. I mean, clearly the markets have priced in 5 hikes, frankly, for next year. So if you got any indication that you're going to get 5 hikes, really that shouldn't have too much impact, given that that's what is priced in at this point. There's much more uncertainty, though, around what we're going to see on the balance sheet runoff, the timing, the speed. And if we look at what's happening, particularly with growth shares, with tech stocks, we think really that's the key variable that's driving the downturn we've had in growth stocks is the balance sheet, because we really think that's what's boosted valuations over the last couple of years. And to the degree you unwind that boost from QE and you move to QT, you may see a reduction in those valuations.
And in terms of our earnings season, another big driver for the market recently, it's sort of been a mixed bag. We got some better than expected results from some big names this week, namely IBM and Microsoft. Apple still to come. We've got Tesla after the bell today. But how would you characterize earnings season so far?
Well, perhaps we got a little bit spoiled last year. We had pretty much every quarter with significant earnings beats, very positive surprises. In addition to that, you had very positive earnings guidance. Now, that was biased a bit because you had a lot of companies that stopped providing guidance because there was so much uncertainty around the pandemic. But those that did provide guidance tended to be optimistic. And probably the story of if you've got something good to say, you're more likely to say it. Now, in fact, with this earnings season, the actual results that are coming in are not bad. You still have positive surprises, even if they're lower than you had for the previous quarters. What's really changed, though, is that earnings guidance. It's picked up a bit recently. It's moved up to about 20% of the companies are providing positive guidance, which is actually the long run average. So from that point of view, it's a quite normal earnings season. But we had gotten used to positive guidance of 50, 60, 70%. And so from that point of view, it's disappointing. And if you add that coming on top of this anticipation of tighter monetary policy from the Fed, that's really been a double negative whammy for the markets.
When you think about what the Fed may be planning to do, rolling off the balance sheet, really at the same time it's looking to hike interest rates, are you concerned that that combination could force the economy into a recession later this year or into 23?
Well, that's probably quite low on our list of worries that we have right now. And I think what's different this time about this hiking cycle versus previous ones where you have seen that phenomenon where the central banks act too late, they then have to hike more, and you end up going into a recession in order to get inflation down, is we're starting from a point where growth is significantly above trend. So even if we do get more slowing in economic growth than we anticipate, you're probably still going to be above that long rate trend of growth. Whereas previously, if you were starting from a point that you were near trend, you don't have so far to go to get to a recession. But at this point, to get from what we're going to have for the next few quarters to actually negative growth, we think that's going to be way too much. And we don't really have significant worries about that.
I want to get back to the market action for a minute and specifically take a look at the Nasdaq, because we know that tech stocks have had a really rocky start to 2022. But when you look at valuations for a lot of those mega tech stocks, they're still above pre-pandemic levels. So are we at a point where you would feel comfortable being a major buyer of some of those large cap tech stocks at this point?
We haven't made that change to our allocations yet. We're currently underweight the U.S., so kind of implicitly underweight those mega cap tech stocks. Our overweights currently are to EM, to Japan, and to Europe. When you mentioned the valuation, so we've fallen from over 30 times when you had a peak last summer to 28 or so times forward earnings on the NASDAQ currently. So that's quite a bit lower, and we've seen that in the price declines. But before we had the pandemic and the most recent round of quantitative easing, multiples were around 22 times, which even then actually was quite high. So depending on where you think the Fed's balance sheet ends up, how quickly it gets there, there's at least a reasonable chance that those valuations need to revert back to that 22 times. You've got to remember, though, we are going to have earnings growth. So from a total return point of view, potentially compression in valuations offset by earnings growth. And it's the net effect of those two that essentially tells you what your total return is going to be over the next few years.
So if you are underweight U.S. equities at the moment and you're concentrating on places like Europe and Japan, how do you view the potential conflict between Russia and Ukraine right now?
Well, that's probably the key risk for European equities currently. There's a lot of reasons to be optimistic about Europe. Generally speaking, we're looking towards value markets to do well. And Europe is certainly more value oriented than the US is. But in the short term, without question, you have the risk of some increase in tensions between Ukraine and Russia. that leading to a rally in government bonds and potentially sell off in European equities, as at a minimum, you'd anticipate higher energy costs, which has already been a drag for several months. So that's a near-term risk. We don't anticipate it being a medium-term concern. And if it actually did materialize, if anything, we might look at that as a buying opportunity.
All right, lots of question marks hanging over investors' heads. Daniel Morris of BNP Paribas Asset Management, thanks so much.
Alexis, it is a big market day, of course, but there is other news to discuss. So we're going to take a break, and on the other side of it, turn your attention to COVID. Mask mandates in parts of the country just keep getting more confusing. We'll ask a medical expert to weigh in after the break. And welcome back. Well, U.S. data show daily average deaths from Omicron exceeding the peak reached during the Delta surge. Here with more is Dr. Elizabeth Claiborne, Adjunct Assistant Professor of Emergency Medicine at the University of Maryland School of Medicine and Emergency Physician at Capital Regional Medical Center. Doctor, thank you so much for being here with us today. I want to ask you, what are you seeing on the ground in Maryland? Because they just hit a record as far as deaths due to COVID.
Yes, everyone needs to remember that although there has been some chatter about the cases of COVID actually peaking and starting to go down in some places in the country, usually our death rates lag behind that peak a few weeks. And so we still see quite a few places that are having a number of COVID-related deaths. In my particular facility, we still are very busy. I would say that we have seen a decline in the sheer number of people who are having COVID-related problems, but we still see a number of people who are acutely ill and in those higher risk groups, specifically those who are unvaccinated or older or have immune compromise who are struggling. And the main issue that we're battling in my facility and several hospitals across the country is just a staffing shortage. My family and I actually recently just recovered from COVID, so it is not an uncommon story that a lot of our facilities that are trying to take care of COVID patients are struggling because they do not have the staff to deal with the numbers that are still coming in.
And then do you feel that you're getting enough local and federal support in that respect?
I certainly think that we always could use more support. To the credit of our Governor Hogan, he did actually enact a couple of resources that were very helpful to emergency physicians like myself, specifically some testing resources that gave people an option to do drive-through testing, and that helps to offload the amount of people who come to the ED looking for that testing when they have very mild symptoms. And so that was like a really key, I think, factor in helping to decompress the emergency department in particular, so we could focus taking care of sick patients, because so many people were showing up with mild symptoms who really just wanted a test, and those numbers of people were overwhelming the staff and resources that we have. So when they can be outsourced to other testing facilities, that's very helpful. That said, I still think we have critical nursing shortages across the country, and that is something that needs to be addressed, not just in Maryland, but in several states, and I see that being a problem for several months to come.
Now, Doctor, there's a great debate brewing over masks. New York State's masking policy just got reinstated after a judge granted a stay. I'm wondering, what is your prescription? What should people be doing?
You know, I've said since the beginning of this pandemic that, masking and doing some social distancing or basic public health measures that help to keep you and your community safe is a very small ask when you're considering something that is killing thousands of people every day. I always wear a mask, as a medical provider. And even before this pandemic, wearing a mask was something that wasn't foreign to me. And so I understand that it's probably a little easier for me to adapt to do that. But we're now 2 years into this pandemic, and I wish that people would consider the mask less of a nuisance and more as a very useful tool that can continue to keep their children safe in schools and people safe, so that they can engage and go back to doing activities that we have not had as much access to do. I don't see a way out of this pandemic if we're not all willing to come together and do what it takes to get these infections under control. And right now, that to me means continuing to mask.
Doctor, I'm wondering, 2 years into this pandemic now, we're hearing a lot more about long COVID. What are you seeing as far as cases?
I do see a subset of patients that are having, long COVID symptoms. A lot of this is going to require some ongoing research, because we don't really truly understand, what the reason is for long COVID. But I use it in those patients who are experiencing these symptoms as examples to others of why it is so important to vaccinate. I know a lot of people like to kind of focus on the fact that Omicron seems less severe, but I'll emphasize that those who do have severe symptoms and those who often develop long COVID symptoms are those who are unvaccinated. So this should really just the fear of long COVID and the kind of unforeseen complications from getting a COVID infection, especially while unvaccinated, should encourage people who are still not vaccinated and boosted to go out and do so, because we don't know how long these symptoms will last and how they can continue to impact the lives of individuals long after their initial infection.
I'm wondering, how do we get people to understand the urgency of vaccination even at this point? Someone told me yesterday they received all of their vaccinations. They got boosted in November. They got Omicron in December, and then again got hit with COVID in January. It makes you wonder, all of these vaccinations, all of these boosters, Pfizer is now working on a clinical trial for an Omicron-specific vaccine. Sort of how do you make people understand that vaccines actually help when there's all of this reinfections that seem to be taking place at the moment?
Right. I know there's a lot of data that has been coming out of the UK in particular that was showing that, up to 2/3 of individuals in a particular study were COVID reinfections with Omicron. So people who had had prior COVID infections and then got reinfected with the Omicron variant. And I don't think that's an uncommon story. I think what you have to pay attention to is the other side of that data is showing that although we have seen, a huge number of COVID cases that are related to this Omicron variant, deaths in a lot of other parts of the country the world, especially countries who are well vaccinated, such as in Portugal, are significantly lower than they have been a year ago. So that shows that these vaccines work for the things that are most important, which is preventing hospitalizations and preventing death. So yes, maybe you will get another COVID infection and you're not 100% protected from being infected with the coronavirus by being vaccinated, but you are protected from dying from the coronavirus. And I think that's the name of the game, and that's what people should pay attention to, to is, do I want to take a risk in the future by not being vaccinated and putting myself in a position where I may be hospitalized, have long COVID, or potentially die from something that is preventable at this point?
Yeah, it is all about downplaying that risk. All right, we will have to leave it there, but thank you so much, Dr. Elizabeth Claiborne, Adjunct Assistant Professor of Emergency Medicine at the University of Maryland School of Medicine and Emergency Physician at Capital Region Medical Center. Thank you and your colleagues for everything you are doing to help keep us safe. We are going to take a break, but shift gears after that. Tesla's announcing earnings after the bell, but could the automaker be getting some competition for its luxury model from Bentley? Details ahead. Welcome back. Well, ultra-luxury British automaker Bentley just announced plans to invest more than $3 billion over the next decade to become a fully electric vehicle brand. Yahoo Finance's Pras Subramaniam just spoke with Bentley's CEO Adrian Hallmark earlier today about that plan, and Pras joins us now. Pras, fully EV by 2030, that is an ambitious goal.
Yeah, it is, Karina, for a very storied brand like Bentley. They're going to invest $3.5 billion, like you said, into their factory in Crude, England, to build these EVs. The first of which that will come out in 2025. Earlier, I spoke to CEO Adrian Hallmark about that and about the brand's transformation into that EV future. Let's take a listen.
First of all, the announcement that we will build the first of our new BEV family here in Crewe is the news for colleagues. And that's really important because it's not just about the first car. It's about transforming the factory to be able to build subsequent battery electric vehicles. So the $2.5 billion investment that we've committed is for both transformation of this 75-year-old site, as well as full transformation of 5 products over 5 years, from combustion engine through to full battery electric vehicle. It's probably the most bold, radical plan that the company's ever had since the company was started.
I know many of the workers there and the team at Crewe are very excited about this transformation. You also mentioned that the the new EV will be built there starting in 2025. What can you tell us about that vehicle? And will it be based on that stunning EXP 100 GT concept we saw a couple of years back?
So I can't give too much information away about the car yet for competitive reasons. What I can say, though, is the following. We aim to create a product that is first and foremost a Bentley. It's strong, it's proud, it's thoroughbred, it covers long distances in refinement and comfort, and it's fast. That's the essence of the Bentley brand. And of course, the craftsmanship and inspiration you get when you see our products will be built into those new family of battery electric vehicles, together with even more digital content than we've ever had before. So it will be another step change in our craftsmanship, technology, and performance, just like we've delivered with the current range of cars. As far as what it will look like and what it will, where it will fit in the marketplace, I can't comment yet on the body style, the number of doors, the ride height, the width, or the whole description of the car. That's competitive, and we'll do that a bit closer to the launch. But believe me, it's a game changer, it's exciting, and it's a real Bentley.
So you talk about real Bentleys. What are your clients telling you about EVs? Do they want their Flying Spur sedans and their Bentayga SUVs to be all electric? Do you think the current order book is affected at all by EV demand?
It's interesting if it is, because we started the year in the best position in 2021, best position we'd ever been in as a company in terms of forward orders. When we started 2022, we were some 30% higher orders than we started the year with. Now, it's a lot of math, but if you think we grew 31% last year, but the order bank also grew by another 30%, it means that whatever we've said about sustainability has resonated. It definitely hasn't damaged the current demand and current performance. And a good indicator is the only car that we had available with electrified powertrains in 2021 was the Bentayga hybrid. And that went from 0 in the year to 20% of the Bentayga mix without any push. So this year we've launched the Flying Spur hybrid, and we're confident that the mix will be similar. And finally, 4 years ago, we looked at research in our customer world, both existing buyers, but also people that buy other luxury vehicles of the same price bracket. And around 30% of people 4 years ago in our segment said that they were thinking of an electric car in the next 5 years. That figure has now doubled to more than 60% of luxury buyers and intenders wanting to seek an electric car in the next 5 years. So we think the timing of 25 for the first and to fully convert to battery electric by 2030, we think we've caught the inflection point, we've caught the technology wave, and we've certainly responded slightly in advance of customer demands, but they're coming with us.
You know, we talk about this green tidal wave for EV, not just from the demand from customers, but also from automakers like Bentley and others. You guys have committed to an EV future, full EV future by 2030, and so has your rival Rolls-Royce. What do you think sets Bentley apart from them and another in the high-end space where Aston operates, and so will Ferrari soon?
It's quite interesting because there are 6 pure luxury players out there. There's other companies that do cars that are more expensive than their base cars, but if you look at the 6 luxury players in the world, 4 of them are based in the UK and 2 are based in Italy. Lamborghini, Ferrari, Aston, Rolls, McLaren, and Bentley. And the interesting thing is that our differentiation compared with any other mix of 2 of those is probably the strongest. We're not a high performance car company with loud exhaust systems. We're not a pure luxury business in the super luxury segment. Our customers drive our cars pretty much every day of the week. It's everyday quality and excellence that they seek. And Bentley as a brand is slightly more understated than some of our more extroverted competitors, and that works for us. And I think when you combine that with a level of quality that we achieve, and I don't just mean aesthetic quality, but I mean functional quality in the market, which is on par with the best of the premium brands, which is rare for a luxury car company, I think we're a unique proposition. And electrification fits perfectly with what Bentley stands for. Effortless acceleration, long distance touring capability, silence when you want it, and fun when you need it.
I was surprised at how fast Bentley's current and prospective customers are looking to switch to EV. To me, that was a big kind of headline right there. So I guess for Bentley, it was the right time to do this changeover, guys.
You know, Pras, great interview, good insights there from him. But I know the average age of a Bentley buyer is like 53. And I imagine, or he sounds pretty confident that those high-end buyers are ready to fully embrace EV.
Yeah, I mean, look, you only need to look forward to tonight when Tesla reports and how they've changed the game in terms of what's acceptable for driving a car, an engine powered by gas or by electric. I'm not surprised that they're seeing this change from their clientele. I'm surprised at how many want to do it right away. But you know, we talked to Rolls-Royce's CEO a few weeks ago, and he said that not only is it customers wanting electric cars, it's actually younger customers that want that, and younger customers are spending a lot of money on their vehicles, even to the tune of upwards of hundreds of thousands of dollars, even $1 million for certain cars that Bentley offers.
Wow, they pay big for them, and then of course you have to maintain them, and it's not cheap. Pras Subramanian, thanks so much. Coming up, tips on how to start that side hustle without putting your full-time job in jeopardy. Welcome back. If you're thinking about starting a side hustle, you're not alone. Nearly 1 in 3 Americans already have one. But how do you juggle that side business without putting your main job in jeopardy? Here with some tips is Mandy Woodruff Santos. She is Yahoo Finance contributor and co-host of Brown Ambition podcast. Mandy, always good to see you. So talk to us about how you can toe the line between pursuing your side gig and keeping your current boss happy.
Oh, absolutely. I mean, I've come a long way since I was sneaking around Yahoo headquarters when I first launched Brown Ambition 7 years ago. I feel safe admitting that now. One time, Katie Couric walked in on me. We'll touch that story another time. Anyway,
that's for another day, Mandy.
Another day. So side hustles, yes. The first thing that I think everyone should do is check your employee handbook. Even if you don't think that your business interferes with your day-to-day work, it just may be a simple policy that your company has that you need to declare your business ventures outside of the company or even any conflicts of interest. I mean, that could be, something like sitting on the board of a nonprofit. So definitely check that handbook to be sure that you're not overlooking some kind of policy.
Yeah. Also, I mean, a conflict could also be one of those non-competes, right? Sometimes you're asked to sign a non-compete clause as part of a work contract. Talk to us about that consideration.
Absolutely. It's becoming increasingly common. And you may think of this more often when you think about leaving your company. Some non-competes say that you can't go work for a competitor for a certain number of months or years after leaving our employ. But what about when you're currently with the company? They may have a clause in there that says that you are not supposed to even moonlight for a company or offer consulting services to a company that could be considered a competitor. With non-competes, because it is a legal document, I recommend that people reach out to an employment law attorney, especially if you have a hunch that your job may have an issue and you want to be sure that you're safe.
Yeah, good idea. Better to be safe. Now let's talk about time commitment and being realistic. Can you really give of yourself fully to your current boss? And if you think that is the case, how do you communicate that effectively? Because if I were a boss, I think that'd be my first thought. Okay, is this person now going to be distracted with their side hustle?
Absolutely. And I think that, if you're someone who wants to start a side hustle and you're going to be transparent with your employer, I mean, you have to expect a certain level of extra scrutiny into your performance, into your productivity. And they certainly may be comparing your productivity levels to prior when you opened up about, having that side hustle, which I actually think is more than fair. If you're paying someone a full-time job, you want to be sure that you're getting all those hours out of them. So that's why I say I think it's good to have a clean break, wait to start your side hustle if you can after those business hours. And I think you should honestly, use a different computer, create as many, create a kind of a Chinese wall between your day job and your side hustle so that no one can even accuse you of letting those two worlds, overlap too much.
Yeah, make sure you keep your business expenses separate as well. Really important with all that paperwork to keep that in mind. And I know for a lot of people, doing a side hustle is not just all about the extra money. But if money is the main factor, maybe should you ask your boss for a raise? Do you explain, look, I wouldn't necessarily have to do this side hustle if I were making more money with you?
I think that people have side hustles for many different reasons. And certainly in the wake of the pandemic, a lot of people were doing it as a means of survival. A lot of people, if they had their choice, would not be out there doing DoorDash deliveries or Uber driving, on their time off. Of course, they would want more pay. So absolutely, if you feel like you're not being paid enough to sustain, a reasonable lifestyle, then yes, ask for a raise. And if you don't get the raise, look for higher earning full-time work elsewhere. But I will speak to those passionate entrepreneurs, people like myself who created a side hustle just born out of a creative interest. When I started Brown Ambition podcast, that wasn't something that my employer at the time could actually let me do full time, nor did I even want that. I just wanted something of my own that I could feel proud of. And I think that actually will help if employers are open to having, workers be able to pursue those creative interests through even through a business sense outside of their work. And if they're supportive of that, then you may actually be able to retain people a lot longer.
I like that. An intrapreneur, not an entrepreneur. And I like the idea of transparency, right? You don't have to keep track of, who you said to what. Yahoo Finance contributor Mandy Woodruff Santos, thanks as always.
And Alexis, I've got to tell you, on that note, don't tell our boss, but I've got a couple of side gigs myself. Cook, cleaning lady, lending institution. I don't get paid very well for any of those, but they're really useful tips there, right? All right, we are going to take a break. And on the other side of it, in our Funding Our Future segment, we take a look at debt refinancing. Is now the time to do it ahead of those rate hikes we know are coming? Stay with us. Welcome back to Yahoo Finance. Well, inflation is starting to eat into the savings cushions created by pandemic relief for many Americans. A new report highlights ways to free up vital additional monthly funds for low and moderate income households. Here to help break that down is Tim Flock, a Commonwealth co-founder and executive director. Tim, thanks so much for joining us. You say one way to save more money is by refinancing debt. The total debt in the U.S. grew to about $15 trillion in the third quarter of 2021. It was led by mortgages, auto loans, student debts, as well as an increase in credit card debt as well. So broadly speaking, is now the best time to think about refinancing and getting better debt options ahead of all the rate hikes that we know are to come?
Yeah, well, you're absolutely right. If we think there's reason to believe that our debt is going to get more expensive, which of course rate hikes, would suggest, then it's a natural time to think about refinancing that debt, and just more broadly to be cognizant of our debt and what role it plays in our financial lives. And I think you already made the point, we have a lot of debt, a lot of consumer debt in this country. We also know that we don't have a lot of savings. A widely publicized figure from the Federal Reserve makes that point that really only about a third of us would have $400, or I should say that the other way, wouldn't have $400 to manage an emergency. And somewhere north of 50% of us report that we live paycheck to paycheck. So we, in our work, are always looking for those moments that might allow for building financial security. And I think debt refinancing, we have some new research suggests may be one of those moments.
Yeah, and you launched a pilot program focusing on low and moderate income households. For that group, higher inflation is definitely outpacing any sort of wage growth. In fact, the other statistic I have is 40% of those earning less than $50,000 don't have enough for a month of emergency savings. So then how vital is it for that particular group, particularly to reduce debt payments?
Well, I think you're absolutely right that those people who are living in that under $50,000 range, or the paycheck to paycheck description I alluded to a moment ago, every dollar matters. And just to say a word about this pilot study that we conducted together with the Hebrew Free Loan Society in New York, we had a chance to actually take people who were in debt and making payments. And for 200 of them, we cut those payments in half and doubled the repayment time. And what we were interested in was, would that create an opportunity for households to build up some savings and more broadly to be more financially secure? And we were very excited to find that, in fact, the rate of people who were saving money, and we mean saving for the short term, for emergencies, for the most part, actually doubled among that group that we were able to cut their repayment in half. So we think this is actually really exciting for the lenders who stand behind that $15 trillion that you described, to say, if you are trying to work with your customers to help them be more financially secure, which we hope you are, and we think is a sound business strategy, thinking about restructuring those debt payments, if done carefully and on favorable terms, may provide a real window of opportunity to help your customers build up their savings and build up their financial security. And just one more point, interestingly, we think that's an opportunity for lenders also. The people that we interviewed who participated in this study told us that they were more likely to make regular payments, they were more interested in hearing about other financial products and services from their lender, and crucially, they reported significantly higher financial well-being. It just stands to reason that we all feel good about the providers, the companies that are helping us find our way to that greater financial well-being and less financial stress.
Yeah, your report says it leads to a lot of psychological well-being as well as being, financially better off and in a better position. My question is, why should a lending institute go out and try and get you a better loan repayment option? Because aren't they then losing out on net income? What's in it for the lenders themselves?
Yeah, of course, it's a great question. Obviously, lenders need to be repaid, and it is their business, after all, to lend. And I think it's what I started to say a moment ago, that rates of repayment appear to be higher and more consistent among those who have this more longer extended repayment period, which stands to reason, but we now have data to back that up. And beyond that, the goodwill that seems to come from lenders who are able to make this sort of change and the openness that we heard from the people we interviewed to hear about other products and services from those lenders create opportunity. And just to take it a level up, I think for many financial service firms and financial service providers, increasingly we see a movement towards the outcome that you're trying to help your customers achieve. And perhaps the most important one for those of us who are living, close to the edge is that greater feeling of financial security. So in a slightly bigger picture, it's a real opportunity for lenders to step up and say, we can offer you something concrete that our evidence suggests will allow your customers to build up that crucial short-term savings, to pay down some of the even more expensive debt, and therefore to have that greater financial well-being and build a much stronger bond with your customers.
Yeah, absolutely. And it is very motivational to be able to get a handle on those finances and know you're able to make those payments. So debt consolidation and reduction, a very good thing to be focusing on. Okay, we will leave it there. Tim Flocka, Commonwealth co-founder and executive director. Thank you so much for stopping by today. Alexis?
All right. Thanks, Karina. Coming up next, we're about 10 minutes away now from the Fed's highly anticipated decision on interest rates. We'll bring it to you live at the top of the hour, and then we're going to break down what it means for the stock market, for your portfolio, with our panel of experts. We'll get a check of the markets for you, though, right after this. All right, we're less than 10 minutes away from the big Fed decision. Jared Blickery standing by at the charts. And Jared, we've been rallying all day long heading up to this Fed decision. What is leading the advance today?
It's all about tech, and for one day, it's not energy. So let's check out the Nasdaq 100, or the Nasdaq Composite, excuse me. You can see we've kind of stalled out, but still maintaining the day's gains up 2.5% Also taking a look at the S&P 500, up about 1.5%, and the Dow up about 280 points. That is the laggard of the day. I do want to take a look at the sector action. Pretty interesting. As I said, XLK, that is the number one sector in the S&P 500 right now. That's up about 3%. You can see almost there right now. XLY is the consumer discretionary, and that houses Amazon. So some of the mega caps really benefiting here from this price action today. Also notable, energy, financials, industrials, those value and cyclical sectors, those are rounding out the tops. Now, I also want to take a look at some of the sentiment leaders. We're still seeing SOX, that is a chip index, that is a big leader here. It's up 4.5%. ARC Innovation Fund, that's up over 3.5%. So is solar energy, gambling, IPO momentum, and software. A lot of these names were beaten down this year, along with everything else for that matter. Let's take a look at those semiconductors because we have NVIDIA, up 6% today. We have Applied Materials up 5%. Let me just give you an idea of what's happened recently with NVIDIA. Over the last year, it's going to be maintaining some decent gains, but you can see now 76% is nice, but over the last month, it's given up about 20% of that, even more from the top if you were to go back there. Also want to check in on the travel sector. Here we are seeing Airbnb as a leader, that's up 4%. Also the cruise lines doing nice, Royal Caribbean, also Carnival Cruise Lines, those are up 3%. Delta Airlines up 2%, so is Southwest. So a lot of risk on flavor in the markets today. And here, we got to check out the bond market. A lot of times, this is where the volatility is. Speaking of volatility, look at that, the VIX is below 30 once again, but as promised, here is the bond market up 1.5%, up to 1.57%. That's up 1 basis point in the 5-year T-note. 10-year is flat right now, and the 30-year down just a little bit. So really want to focus on the bond market today. Just a few minutes, we're going to see what happens.
All right, Jared Lickery, thank you so much. You've got your sleeves rolled up as well, so you definitely mean business there. And we will check back with you in just a little while after the decision comes out. But for right now, we are going to take a break. But coming up, that much anticipated Fed decision just moments away, and we'll break it down for you in real time and get you analysis from our panel of experts. It's Fed Decision Day on Yahoo Finance.
It's the moment Wall Street's been waiting for. In less than 2 minutes, the Fed will release its decision on monetary policy. Welcome back, everyone, to Yahoo Finance Live. I'm Alexis Christoforous, here with my colleagues Karina Mitchell and Adam Shapiro. We have got a panel of experts standing by to dissect the Fed's decision as we lead you up to Fed Chair Jay Powell's press conference, which will begin at 2:30 Eastern Time. Quick check of the market shows the market higher as we head closer to that Fed decision. It's been higher all day long, of course, following two very volatile sessions for the market. And Adam, of course, no rate hike expected today, but investors hoping for more clarity from Fed policymakers in terms of those interest rate hikes, yes, but also in terms of that balance sheet roll-off. What will you be listening for in particular today?
The tone of Chair Powell during the press conference afterward. Is he going to put a tone that sounds more hawkish in order to let markets know it's coming down? Or is he going to convey, something that might be considered dovish or a slower pace of raising interest rates? Look, he said back on January 11th to that issue you just brought up about the roll-off, he said on the details of the balance sheet roll-off, we tend to take 2, 3, 4 meetings to work those things through. It'll be part of the things that we're discussing and doing this year. But this week, this FOMC statement, perhaps we won't get quite the aggressive language, but you should know we have James Bullard, voting member. He said he's ready for liftoff at March and is open to raising rates 4 times this year. You have Loretta Mester, who said that if the economy in March looks like it does today, quote, I would support moving the funds rate up at the March meeting.
All right, we've got that Fed decision. Our Brian Chung standing by. Brian, what can you tell us?
Opting to hold interest rates at near zero in the meeting. The announcement just crossing the wires now. The Federal Reserve describing economic conditions very similarly to the way that they described it in December. In fact, very little changes in terms of the actual language describing the economic activity. They noted that the sectors most adversely affected by the pandemic have improved in recent months, but are being affected by the recent sharp rise in COVID-19 cases, of course, referring to the Omicron variant. But they did continue to note that job gains have remained solid. And the real money quote in the new statement is, quote, with inflation being well above 2%, the committee expects it will soon be appropriate to raise the target range for the federal funds rate. So again, the Fed not raising interest rates today, but that language seems to suggest that they are teeing up an interest rate increase very soon, perhaps as soon as the March meeting. Everything else in the statement is pretty much the same. The Federal Reserve is continuing to march on their path with regards to the asset purchase program, which they hope to bring to a full stop by early March. That is untouched in the decision today. But what is interesting is the Federal Reserve released a statement alongside the regular policy statement explaining their principles for reducing the size of their balance sheet, again, which is getting close to $9 trillion as you see the chart ahead of you. Now, again, the Fed is not doing that today. Down the line, however, the Fed says through this document, after they begin raising interest rates, they will start to think about how they can actively allow their balance sheet to start to shrink. So how will they do that? Well, the principles as detailed in this document note that they'll really allow this to happen in the same way that they did in the lead up to the COVID-19 pandemic, in addition to the U.S.-China trade war, where they were allowing the balance sheet to shrink by allowing maturing assets to simply fall off of their balance sheet and not reinvesting them into new U.S. treasuries or agency mortgage-backed securities in replacement of those that mature. They just simply let them roll off, and then the balance sheet shrinks. Now, what's interesting about that is there was chatter before this meeting that maybe the Federal Reserve would start to get more aggressive with its balance sheet roll-off by actively selling its assets into the open market in the same way that they were openly buying them through the quantitative easing process. The statements based off of what I'm reading doesn't appear to lean towards that direction. It would be a little bit more of a passive process than an active process in terms of letting those assets shrink. So very inside baseball stuff, but something that could be very consequential after the Fed eventually raises interest rates, which might be a conversation for perhaps the summer or the fall of later this year. But again, the actual FOMC policy statement itself, not much new in there beyond the very quick and important sentence that they will be ready to start raising interest rates sometime soon. By the way, guys, this decision was unanimously agreed to by all of the voting members of the FOMC, including some of the more hawkish members that we had been talking about ahead of this decision. We'll see if the Fed Chairman Jay Powell has any interesting color to add in addition to this commentary later at 2:30.
Yeah, absolutely. And then, Brian, how carefully measured does Powell have to be in his comments today at that presser?
Yeah, very careful because it seems like markets could be particularly sensitive. Now, I'm looking at what's going on in the bond market right now. That's going to be really important because the Fed wants to pay attention to the shape of the curve as they start to tighten policy. But the 10-year not really moving too much. I'm taking a look at the 10-year at still around 179 basis points. Of course, this could be moving very quickly. But when it comes to the Fed chairman, he is very aware of the fact that financial conditions are going to be particularly important as the Fed starts to continue to messaging it's a commitment to really tightening its policy. Again, the pandemic era easy money indeed may have been a contributor to the large inflationary increases that we've seen, which have spurred the Fed to go into this more tightening mode. But the Fed chairman wants to balance not making sure that they're so aggressive where it could put an abrupt stop to the recovery and perhaps launch us into another recession via an inverted yield curve. But at the same time, messaging they're serious enough about tightening that inflationary pressures and inflation expectations will go down because of higher borrowing costs, at least from the Federal Reserve's interest rate hikes. So that balance is indeed going to be an interesting challenge, which we'll see him tightrope walk in a few minutes.
All right, Brian Chung, thank you so much for that report. We're going to stay on all of the market action and tied to the Fed and bring in our guest, Greg Dacko from EY Parthenon, the chief economist there. Thank you so much, Greg, for being
My
here
pleasure.
on Decision Day and wondering what your thoughts are. Was this the sort of policy response that the Fed needed to put out? Does it restore its credibility?
Well, I think it's a policy statement that's in line with expectations. We were expecting the Fed to come out with a statement that inflation remains elevated, that the labor market is strong, that there will be disruptions in the short run from the Omicron variant, but at the same time that the Fed has made that hawkish pivot towards a rate liftoff in March, which was communicated with the soon appropriate statement, and that it will probably proceed with a total of 4 rate hikes this year. Now, that will be up to Fed Chair Powell in the press conference to detail how aggressive the Fed wants to be in terms of tightening monetary policy, how many rate hikes are likely in the coming months, as well as how rapidly and how the Fed will proceed with the balance sheet runoff. I think Fed Chair Powell will likely want to stay off of details as to how much they will want to tighten monetary policy, retaining some form of policy optionality by doing so.
Do you think we'll get any kind of commitment or hint at whether it's going to be 50 basis points or just 25 basis points at the March meeting?
Yeah, I don't think there will be any indication that this will be a 50 basis point rate liftoff. There's no need for that type of strong liftoff at this point. We have markets and investors that are pricing in 4 rate hikes this year with liftoff in March. That's in line with the statement. I think that's in line with where the Fed feels it's comfortable. It does not need to jolt the markets further with any signs that will lift off with a 50 basis point increase. So I think there will not be any signal as such, and the Fed will want to stay fairly careful because it has to navigate this delicate rebalancing act of monetary policy in an environment where we're starting to see financial conditions tighten. So this will be a very delicate exercise for Fed Chair Powell. I think he will want to stay off of any details as to how strongly the Fed wants to navigate its monetary policy tightening because markets are probably well priced at this point.
You know, Greg, if the balance sheet roll-off is successful, do you see the Fed perhaps pulling back on how many rate hikes it might have to institute this year?
There's a potential for that. We know from the Fed minutes that Fed policymakers have discussed the option of using the runoff of the balance sheet as an alternative to raising rates. But I think in the current context, the Fed is likely to proceed with an approach that is likely gradual in terms of rate increases, probably 3 to 4 rate hikes this year, depending on, again, economic conditions, on how inflation evolves over the coming months, whether it comes down and how fast it comes down, and then consider the balance sheet runoff in the second half of this year with a gradual approach, probably a cap system with redemptions gradually increasing over time. But it won't want to necessarily rush into this runoff of the balance sheet. It will likely want to take its time and retain optionality to react as economic conditions evolve.
Can the Fed deliver a soft landing, do you think? Because inflation is red hot. 7% is a handle, but in parts of the country, you know, in the South and in the Midwest, it's up to 9%. The IMF has revised down growth for this year as well.
Yeah, we have what we've previously described as a messy inflation environment where we have moderating growth, but still persistent inflation. And that's really tricky to navigate from a Fed's perspective. We know that that inflation is likely to peak around the first quarter of this year, although increasing energy prices may actually delay that peak. But we also know that economic momentum is likely to cool over the course of this year, and the labor market remains fairly hot and fairly tight. So it's a delicate rebalancing act that we'll have to observe over the course of this year. It's always very difficult for any Fed policymaker to engineer a soft landing when it comes to monetary policy. So this will be a challenge. It will not be easy, and it will not be easy in an environment where we have still this COVID situation that lurks in the background, and we have a number of unknowns as to how the health situation will evolve, because we know that the health situation is the most important element at this point driving economic activity.
It's a little wonky, but help us understand when we talk about roll-off. In the real world, what does that look like when 8.8 trillion starts to fall and get, where do we on the street actually feel it or see it?
Well, the balance sheet roll-off is likely to be a fairly passive one. So essentially, the Fed will allow assets to mature, both in terms of treasuries and in terms of mortgage-backed securities. What effect that has on the real economy is largely via financial conditions. Essentially, it's via the interest rate channel where, excuse me, you start to see potential increases in long-term bonds, long-term yields. That tends to be the direct effect on the real economy because that then influences the borrowing costs for businesses. It influences the borrowing costs for potential home buyers. So that's generally the direct channel through which you see that runoff affecting the real economy.
All right, Greg Dacko of EY Parthenon, chief economist there. Thanks so much for sharing your thoughts. So want to hand it over now to Tom Hayes, Great Hill Capital's chairman and managing director. Tom, do you believe the Fed was transparent enough? And did they say what Wall Street needed to hear in order to put this bull market back on track?
Well, so far, so good, Alexis. We still have the press conference, and that's where the crazy things can happen. But, you know, the market is expecting 3 to 4 hikes this year. They're currently priced in. He may signal that 25 basis points looks to happen in March, which the market anticipates. The whole key to this meeting is going to be the balance sheet roll-off timeline. If you look back at January 5th, you can trace basically the top of the market to the day that they put out the Fed minutes from December. And the Fed minutes from December absolutely spooked the market because for the first time they said, well, maybe we could do balance sheet runoff in line with our first rate hike, which everyone was anticipating is as soon as March. And that was completely unexpected. And since then, we saw a 12% intraday sell-off in the S&P 500, 18% intraday on Monday in the Nasdaq. And that's just too much tightening too quickly. If you look at the last round of quantitative tightening, they waited a year and a half after the first rate hike to start the quantitative tightening. As soon as they started the quantitative tightening, within a year and a half, they inverted the yield curve and we got a serious recession, obviously compounded by COVID, et cetera. So we just really need to see them back off of that. So far, the market is anticipating, we're looking at the S&P up 70 points, that they will do that. And they need to keep that in mind because all of the actions that they take, whether it's loosening policy or tightening policy, they're felt in the real economy on a lagged basis, 6 to 9 months down the road. So start with the rate hikes, do 1, 2, 3 hike, see how the economy absorbs that, see what employment looks like, see what inflation looks like, et cetera. And then from there, you can start the balance sheet runoff at a slow, gradual pace. And I do think they can navigate a soft landing, provided they don't try to do too much at once.
But when we talk about all of this and doing too much at once, we just asked the previous guest, what does roll-off look like? Since that's now going to be, you know, they've solidified what they will do in the second half of this year, as opposed to what you said, spooking the markets in December. And yet, we hit market highs after everyone got all riled. And then this week, we've seen all kinds of fear, panic, whatever you want to call it, knowing what's about to happen. So as we get toward March, now expecting liftoff, are we going to go through another volatility, another cycle of, you know, hair on fire when we know we've been told, here's what's coming?
Yeah, I don't think so. You know, we did see some level of capitulation on Monday. We'll talk about that. But the key distinction is the event happened in December, but the notes came out in January. So until the market got wind that they were considering accelerating the quantitative tightening, the market acted fine. The minute that information got into the market on January 5th is when the market completely rolled over. So provided they walk that back and they say, look, let's start with the hikes, let's do a few hikes, see how things go, and then we'll start quantitative tightening and balance sheet roll off, then we should be fine. If they get back to this language of let's start it all at once and see what happens, we've never done it before, why not try now? Obviously, you're going to see the type of results that we've seen. But going back to that level of capitulation, you know, we saw the AAII sentiment survey for individual investors. It hit 21% bullish last week, 47% bearish. So that was at an extreme that you normally see around inflection points. You saw the put call ratio on Monday at 1.26. Everyone was buying home insurance when the house was already on fire. You want to buy that insurance well before the fire starts. So that was a sign of inflection and capitulation. And the VIX got up to 38. I think now it's down below 28 just 2 days later. So I think we're through the worst, provided the press conference goes smoothly. They kind of ease off on that quantitative tightening talk and timeline. The market is really set here. Earnings have generally been positive. We need to see a continuation of positive tech earnings in particular, because that group has been hit the hardest, down 18% intraday as of Monday. We saw it with IBM crushing the top line and following through the next day. We saw it with Microsoft, Azure, and cloud up 46% year on year. And then the key thing was the good guidance in the earnings call. So we got follow through on that today. And we're seeing the whole group follow through on the back of that news. And then we have Apple tomorrow, which is going to play a critical role, kind of the trifecta in proving out that the earnings power is still there.
All right, we will have to leave it there. Tom Hayes, Great Hill Capital Chairman and Managing Director, thank you for that insight. Want to check in now on how markets are reacting to the Fed decision. The major benchmarks have been up all session long. Here with more on the market moves is Jared Blickery. Jared, what are you seeing?
Well, we had a spike up and then a little bit of a spike down in the S&P 500, but you can still see maintaining gains of over 1%. So here's what happened. We got to new session highs on the announcement, and now we're selling off. But in the context of the prior 5 days move here, look at that range. This is a drop in the bucket basis what we've been seeing lately. So really, we're going to see the fireworks probably in a few minutes when Powell takes the lectern. Now, also want to check out the Nasdaq 100. That got an even bigger jolt on the announcement. You can see it's given back those FOMC gains as well. But I think we're going to see some movement when Powell answers questions about the balance sheet. And I agree with Tom Hayes. It's really all about the balance sheet roll-off. If we remember 2018, when the Fed was hiking 4 times, it was when Powell finally said the QT program is on autopilot. That was a quote that the markets really tanked. The markets like that flow. So this is where Powell has that wiggle room. He doesn't have to commit to anything today. I think this is his game to lose. So let's check out the 5-year. You can see that's up about 2 basis points after spiking up. It's now back down. 10-year T-note yield. A lot of these movements just kind of look like what we've seen with stocks. Also want to check out the US dollar index. You can see it is surging on the news here, but in the context of some of the bigger movements, not really the big movement that it looks like. Also want to check out gold futures. Gold is down. We can see it was already down about 1% or so. It has climbed back and recaptured its FOMC loss here, but really we're going to have to wait and see what the market thinks about Powell's statements. So let me just end here with our sector look. Tech still in the forefront, followed by consumer discretionary. Guys.
All right, thanks a lot, Jared Blickery. Want to bring in now Ottoman Özildirim, the Conference Board's Senior Director of Economics. Ottoman, what do you make of the Fed's tone, at least in their statement? We know the press conference is still to come, but a little less hawkish, you might say.
Well, overall, it seems like it's pretty consistent with what they've been signaling, and that is they'll be following a more or less sequential phased approach to, in effect, taking away the punch bowl, as they say. The monetary conditions, liquidity is going to be slowly taken away. I think it's really, signaling to the market that what they expect is, in fact, going to play out.
going to play out, but the volatility that we see, I mean, it's very fickle because the Fed has been pretty clear, if you go back to the statements and the December meeting, that this was all coming. We saw ups, we then saw the volatility that took us down this week, and just watching today's trading action, exuberance, you might call it, irrational, as a former Fed chair once said. We shot up after the statement came out, and now we're pulling back. You know, what does it take from the Fed to calm markets? We know the Fed doesn't play to the markets, but they don't ignore them.
Yeah. Well, certainly market volatility is something that they're going to be watching. But as you said, it's not the sort of primary factor in how they're making those decisions. I think giving clear, transparent indications of what monetary policy is going to be for the rest of the year is going to help to calm some of the volatility and the jitters in the markets. It's not too surprising to see that kind of volatility during these periods of inflection. But the underlying sort of dynamics of the business cycle are pointing to continuing growth, but with labor markets getting tightening, and the high growth that we've seen is helping to kind of push up inflation prices, above and beyond all the disruptions that we've seen in supply chains and so on. So I think, signaling to the markets where they're going to be going and not creating surprises is going to be pretty important in how they maintain that consistent policy going forward to, bring the economy to a soft landing, as one of your previous guests said.
And then, sir, how important was a quiet period that the Fed just had in basically gauging market reaction? We now know that there are 4 hikes, pressed into the economy. What do we think about how they reacted to see what was happening in markets?
Yeah. I think they've kind of signaled that they're going to be watching the developments as they unfold. And looking at outcomes, as we say in the market, in terms of what's happening with growth, what's happening with prices and labor markets. And I think they'll continue to do that while holding a steady steady anchor and going forward in the rest of the year. In terms of taking that phased approach with 3 or 4 interest rate hikes, and then gradually taking away the monetary accommodation in terms of the quantitative easing, which they will likely start that in March as well.
All right, we will have to leave it there. Thank you so much for that perspective, Ataman Ozuldirim, the Conference Board Senior Director of Economics. Thank you so much. I want to bring in our next guest, Jeanette Garrity from Robertson Stephens, Wealth Management Chief Economist there, and Zach Griffiths, Wells Fargo Senior Macro Strategist. Thank you both for being here today on Decision Day. I want to start with you, Jeanette. What are you most wanting to hear from Powell at the conference?
I am most wanting to hear him getting a grip on the communication that's being delivered to the market. And I feel bad saying that. All the previous speakers here have been talking a great deal about how this is being communicated. And the reason I feel bad is because I think they have been careful about communicating, as a number of people have said. There's no surprises in this statement. Many of these things were signaled to the markets in December. And in the last 2 weeks, the market just went off into the wild blue yonder, worrying about everything, including a 50 basis point increase in March, which I don't think was ever in the cards. And the sense was that somehow this decision on monetary policy was being done in absence of looking at the economic conditions. And when I look at the statement today, there's a great deal of emphasis on the uncertainty of the economic conditions. I do think they're going to continue to look at this. They desperately want a soft landing. It's going to be terribly hard to do given how much uncertainty is there. So I think Chairman Powell in the press conference needs to take back control of the narrative from the emotions that have been running in the markets in the last few weeks.
Yeah, he's definitely walking the tightrope there. Zach, we didn't get any specific timeline as to when the Fed will start to reduce its bond holdings. Were you hoping for some clarity there? And do you think the markets can sort of regain their footing without knowing for sure?
Yeah, it seems like there was some concern that they could be a bit more specific with respect to balance sheet policy, which I think would indicate the runoff beginning sooner. And they leave it pretty ambiguous, just saying that it'll start after rate hikes. I think everyone expected that going in. So they're definitely preserving optionality. I think Adam pointed out at the start of the segment here that Chairman Powell said something like 2, 3, maybe even 4 meetings to sort through those details. So I'd say it's a discussion they're going to continue having. I think it's going to have a big impact on the market, and that's definitely something that I'm focused on at the press conference. I'm sure he'll get a question on it. I'd imagine he'll try to be as vague as possible, but any indication of how he's leaning with respect to policy, they've made it clear they're going to be more aggressive this time around than they were last time, but the economy is in a much different place. So that makes sense from our standpoint, and we look for them to announce the runoff in September, having it begin in October of this year.
Jeanette, if Zach is correct and the runoff begins in October of this year, will that add volatility as we get toward the end of the year, or would that be a stabilizing situation?
I think probably it adds some volatility, if only because nobody is really sure how that is going to play out, and how's it going to be executed, and what is really going to be the fundamental impact on the economy. This is all sort of new stuff. And I think that's why in the previous time, in 2018, when they talked about it, the reaction was, we don't really know, so we're going to assume the worst. They may do the same thing at that point.
Zach, I want to ask you, what data points do you think the Fed is looking most closely at this point? And then what do they say about labor conditions?
Well, I was going to say, I think they're really focused on the labor market, and their tone has changed quite a bit lately, indicating that we're much closer to maximum employment over the past couple months than they had been indicating. And of course, we've made substantial further progress on the labor market front. So we're looking at a broad array of indicators. It's going to be interesting over the next couple months, seeing how Omicron has impacted the labor market. We think that whatever impact we see in the data near term is going to be just that, a near term implication, and doesn't really change our outlook for the labor market. You have an unemployment rate below 4%, and you have signals everywhere that slack in the labor market has evaporated or is non-existent at this point. So I think that's something that the Fed is clearly focused on when they're well above their inflation goal. We have headline CPI above 7%. That's certainly well above where I think they'd like it to be. Now you have the supply chain issues making it difficult for them to use their policy tools to address it, but we're already starting to see them look to remove policy. I'd say the statement today is a green light for a March hike. I agree that 50 basis points is off the table, but they're clearly responding. And I'd say to the degree that they tighten even more quickly than the market expects, that's going to come down to what happens with the labor market.
Jeanette, for regular folks hearing this and hearing all this talk about interest rates going up in March, talk to us about the relationship between those interest rates and perhaps someone looking to buy a home, because they're not directly related, although it could certainly impact what happens with mortgage rates.
It can, it will, but the direct relationship, you're quite right, the direct relationship is not there. I think this is often something of a mystery to the average person. Nevertheless, we heard Chairman Powell in testimony to Congress say that he thought that the usual 9 to 12 months of transmission of these kind of actions into the real economy comes much quicker. He gave 6 months as the element there. So it's primarily going to come to the average person in terms of other interest rates. That will be where they will see it. I think the other effect is, to the extent that there is an impact on raising borrowing costs for companies, does that impact their hiring plans, their spending plans, and ultimately, does that show up in some actions that the average person can experience? I do want to emphasize they're very worried about, they're very focused on the labor market. There's something that's left out here a little bit, which is they do want to get that labor force expanded. They do want people to come back into the labor force. Raising interest rates aggressively potentially is a negative for that. So I think that's some of the tightrope that they're walking on.
Zach, you talked about vagueness when the Fed speaks, and yet Jerome Powell wrote papers before he became chair about the need for the Fed to be more transparent and direct in its communications. Do you expect him to be that at the press conference in a minute or two, truly signaling and giving us timelines for what's going to happen, or is he going to play the old cat and mouse game of being vague?
I think there's going to be some more of the cat and mouse, and it really comes down to them wanting to preserve optionality and have the ability to, I'd say, shift in a more dovish direction if they need to. Over the past couple months, it's really been the hawkish party, and maybe it comes down to that huge inflation print in October really waking people up. But at the end of the day, they do want to have that optionality. I think having that vagueness gives them that ability. And if he were to lay out a fairly specific timeline now for 4, 5, 6 months down the range, down the road from here, and the economy were to change significantly, if the virus were to change significantly, then that creates a very difficult communication problem for them, and that's something they want to avoid.
All right, we want to thank our panel and Fed Chair Powell giving his press conference right now. We're going to go to it live.
Maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept its policy interest rate near zero and stated its expectation that an increase in this rate would soon be appropriate. The committee also agreed to continue reducing its net asset purchases on the schedule we announced in December, bringing them to an end in early March. As I will explain, against a backdrop of elevated inflation and a strong labor market, our policy has been adapting to the evolving economic environment, and it will continue to do so. Economic activity expanded at a robust pace last year, reflecting progress on vaccinations and the reopening of the economy. Fiscal and monetary policy support and the healthy financial positions of households and businesses. Indeed, the economy has shown great strength and resilience in the face of the ongoing pandemic. The recent sharp rise in COVID cases associated with the Omicron variant will surely weigh on economic growth this quarter. High-frequency indicators point to reduced spending in COVID-sensitive sectors, such as travel and restaurants. And activity more broadly may also be affected as many workers are unable to report for work because of illness, quarantines, or caregiving needs. Fortunately, health experts are finding that the Omicron variant has not been as virulent as previous strains of the virus, and they expect that cases will drop off rapidly. If the wave passes quickly, the economic effects should as well, and we would see a return to strong growth. That said, the implications for the economy remain uncertain, and we have not lost sight of the fact that for many afflicted individuals and families, and for the healthcare workers on the front lines, the virus continues to cause great hardship. The labor market has made remarkable progress, and by many measures is very strong. Job gains have been solid in recent months, averaging 365,000 per month over the past 3 months. Over the past year, payroll employment has risen by 6.4 million jobs. The unemployment rate has declined sharply, falling 2 percentage points over the past 6 months to reach 3.9% in December. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand remains historically strong. With constraints on labor supply, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. While labor force participation has edged up, it remains subdued, in part reflecting the aging of the population and retirements. In addition, some who would otherwise be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. The current wave of the virus may well prolong these effects. Over time, there are good reasons to expect some further improvements in participation and employment. Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline over the course of the year. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability. We're committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. And we'll be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. As I noted, the committee left the target range for the federal funds rate unchanged and reaffirmed our plan, announced in December, to end asset purchases in early March. In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer-run goal, the economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. We'll need to be nimble so that we can respond to the full range of plausible outcomes. With this in mind, we will remain attentive to risks, including the risk that high inflation is more persistent than expected, and are prepared to respond as appropriate to achieve our goals. To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments, so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework, and in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet, and we will discuss these matters in upcoming meetings and provide additional information at the appropriate time. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. For the first question, we'll go to Chris Rugaber at the Associated Press.
Thanks, Michelle, and thank you, Chair Powell. So it's expected that the Fed will hike rates perhaps every other meeting, but certainly in the past, the Fed has hiked at every meeting. So I just wanted to ask, are rate hikes at consecutive meetings on the table this year, is every meeting a live meeting? And on that note, would the Fed consider front-loading some of its rate hikes, even if it doesn't raise every meeting? Thank you.
Thanks. So as I referred to in my opening statement, it is not possible to predict with much confidence exactly what path for our policy rate is going to prove appropriate. And so at this time, we haven't made any decisions about the path of policy. And I stress again that we'll be humble and nimble. We're going to have to navigate cross currents and actually two-sided risks now. And I'll say also that we're going to be guided by the data. In fact, what I'll say is that we're going to be led by the incoming data and the evolving outlook. We'll try to communicate as clearly as possible, moving steadily and transparently. So, more to your question. We know that the economy is in a very different place than it was when we began raising rates in 2015. Specifically, the economy is now much stronger. The labor market is far stronger. Inflation is running well above our 2% target, much higher than it was at that time. And these differences are likely to have important implications for the appropriate pace of policy adjustments. Beyond that, we haven't made any decisions.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to ask, you were talking about the health of the labor market, and I'm curious whether you would characterize where we're at right now as maximum employment, and also along those same lines, obviously rate hikes on the table this year. Do you think that the Fed can raise rates, bring inflation under control without hurting jobs and wages?
Sorry, just getting both parts of your question written down. So I would say, and this view is widely held on the committee, that both sides of the mandate are calling for us to move steadily away from the very highly accommodative policies we put in place during the challenging economic conditions that the economy faced earlier in the pandemic. And I would say that most FOMC participants agree that labor market conditions are consistent with maximum employment in the sense of the highest level of employment that is consistent with price stability. And that is my personal view. And again, very broad support on the committee for the judgment that it will soon be appropriate to raise the target range for the federal funds rate. The other thing is maximum employment will evolve over time and through the course of the business cycle. In the particular situation we're in now, it may well increase. The level of maximum of employment that's consistent with stable prices may increase, and we hope that it will as more people come back into the labor market, as participation gradually rises. And the policy path that we're broadly contemplating would be supportive of that outcome as well. So the thing about the labor market right now is that there are many millions of more job openings than there are unemployed people. So you ask whether we can raise rates and move to less accommodative and even tight financial conditions without hurting the labor market. I think there's quite a bit of room to raise interest rates without threatening the labor market. This is, by so many measures, a historically tight labor market. Record levels of job openings, of quits. Wages are moving up at the highest pace they have in decades. If you look at surveys of workers, they find jobs plentiful. Look at surveys of companies, they find workers scarce. And all of those readings are at levels really that we haven't seen in a long time, and in some cases ever. So this is a very, very strong labor market. And my strong sense is that we can move rates up without having to severely undermine it. I also would point out that there are other forces at work this year which should also help bring down inflation. We hope, including improvement on the supply side, which will ultimately come. The timing and pace of that are uncertain. And also, fiscal policy is going to be less supportive of growth this year, not of the level of economic activity, but the fiscal impulse to growth will be significantly lower. So there are multiple forces which should be working over the course of the year for inflation to come down. We do realize that the timing and pace of that are highly uncertain, and that inflation has persisted longer than we thought. And of course, we're prepared to use our tools to assure that higher inflation does not become entrenched.
Thank you. Let's go to Nick Timrose at the Wall Street Journal.
Good afternoon, Chair Powell. Nick Timmerhouse of the Wall Street Journal. I have a couple of questions on the balance sheet. The statement on the balance sheet today calls for significantly reducing your holdings. What does that mean? And then apart from moving sooner and faster to shrink the holdings, are there any other ways in which you and your colleagues are seriously thinking about recalibrating this process? And finally, how much disagreement is there around how you should use this tool, including active sales rather than passive sales or changes in the composition of reinvestments? Thank you.
So I'm afraid to tell you that those are all great questions, and they're questions that the committee is just turning to now. So we had a discussion, as you know, at the last meeting, an introductory discussion of the balance sheet and a teeing up of the issues. At this meeting, we've gone through and carefully put together a set of principles at a high level, and those are meant to guide the actual decisions we'll make about the pace and about all of the questions that you're asking. And I expect that this process will be something that we spend time on in coming meetings. I can't tell you how many, I can't tell you how long it will take, and then, at the appropriate time, we'll provide additional information. So the last cycle when we went through balance sheet issues, we did find that over the course of 2 or 3 meetings, for example, we did come to interesting and better answers, we thought. So we're just in that process now, and at the next meeting, we'll be turning to more of the details that you're asking about. I would say this: the balance sheet is much bigger. It has a shorter duration than the last time, and the economy is much stronger, and inflation is much higher. So, and I think that leads you to, and I've said this, being willing to move sooner than we did in the last time, and also perhaps faster. But beyond that, it's really not appropriate for me to speculate exactly what that would be. But I would point you to principle number 1, which is the committee views changes in the target rate for the federal funds rate as its primary means of adjusting the stance of monetary policy. So we do want the federal funds rate, we want to operationalize that, and we want the balance sheet to be declining in a predictable manner, and we want it to be declining primarily by adjusting reinvestments.
So if I could follow on that, raising rates and reducing the balance sheet both restrain the economy, both tighten monetary policy. How should we think about the relationship between the two? For example, how much passive runoff is equal to every 0.25 percentage point increase in your benchmark rate?
So again, we think of the balance sheet as moving in a predictable manner, sort of in the background, and that the active tool meeting to meeting is not both of them, it's the federal funds rate. There are rules of thumbs, I'm reluctant to land on one of them that equate this, and there's also an element of uncertainty around the balance sheet. I think we have a much better sense, frankly, of how rate increases affect financial conditions and hence economic conditions. Balance sheet is still a relatively new thing for the markets and for us, so we're less certain about that. So again, I think the pattern we'll follow is to arrive at a timing and a pace and composition and all those things, and then announce that with advance notice, and it will start in the background, and then we'll look to have that just running in the background and have the interest rates again be the active tool of monetary policy. That's at least the plan. I can't tell you much more about any of the very good issues about size, pace, composition, those sorts of things. We'll be turning to all of those at coming meetings.
Thank you.
Thanks. Now we'll go to Neil Irwin.
Thank you, Chair Powell. It's Neil Irwin from Axios. Glad to be back. Sir, I was wondering if the volatility we've seen in financial markets in the last few weeks strikes you as anything alarming or that might affect the trajectory of policy. Conversely, to the degree that financial conditions have tightened some, might that be desirable in some ways in achieving your tightening goals?
So, as you know, the ultimate focus that we have is on the real economy, maximum employment and price stability, and financial conditions matter to the extent that they have implications for achieving the dual mandate. And you also know that we look at broader financial conditions, not one or two things, one or two markets. And what we're always asking ourselves is, are we seeing changes that are both persistent and material enough that of a change in financial conditions that they are inconsistent with the achievement of our goals. So that's how we're looking at that. And I don't want to comment on today's financial conditions broadly, but we're not looking at any one market or so. So that's how we're thinking. In terms of what we've seen, I would say this. We said at our last meeting, we published a summary of economic projections, the median participant expected 3 rate increases this year. And, it's 6 weeks, 7 weeks later now. And you have seen that our communication channel with the markets is working. Markets are now pricing in a number of rate increases. Surveys show that market participants are expecting a balance sheet runoff to begin, at the appropriate time, sometime later this year, perhaps. We haven't made that decision yet. So we feel like the communications we have with market participants and with the general public are working, and that financial conditions are reflecting in advance the decisions that we make. And monetary policy works significantly through expectations. So that in and of itself is appropriate.
Thank you. Let's go to Howard Schneider.
For a year or hi, thanks, Chair Powell. Howard Schneider with Reuters. So for a year now, the statements reference the benchmarks for this initial interest rate increase. Now that we're approaching that moment, what are the benchmarks going to be for subsequent rate increases? I know you can't stipulate the path, but how should we think about the criteria for the next step and the next step?
Well, you're right. We haven't gotten to that point yet. We haven't made a decision yet, and we'll make that decision at the March meeting. We'll make a decision whether to raise the federal funds rate. I would say that the committee is of a mind to raise the federal funds rate at the March meeting, assuming that conditions are appropriate for doing so. We have our eyes on the risks, particularly around the world, but we do expect some softening in the economy from Omicron, but we think that should be temporary, and we think that the underlying strength of the economy should show through fairly quickly after that.
If I could follow, just on a related question, the December SEPs had this copacetic sort of set of circumstances where inflation comes down without the federal funds rate ever getting over the estimate of neutral. Given developments since then, do you still think that's a credible narrative for the ultimate path of policy?
The path is highly uncertain, and that we're committed to using our tools to make sure that inflation, high inflation that we're seeing, does not become entrenched. So a number of factors would be, it's not just monetary policy. A number of factors are supporting a decline in inflation, as I mentioned. Fiscal policy will providing significantly less of an impulse to growth. We do expect this year, although we do expect now that it will come slower than we had expected and hoped, that there will be relief on the supply side. So that too should lower these supply side barriers, which are a big part of the story why inflation is high. In addition, monetary policy will be becoming significantly less accommodative. So the question is, we'll be asking this question all year long, and that will be, are things turning out as we expect? There's a case that for whatever reason, the economy slows more and inflation slows more than expected. We'll react to that. If instead we see inflation at a higher level or a more persistent level, then we'll react to that. And again, we're well aware that this is a different economy than existed during the last tightening cycle, and our policy is going to reflect those differences.
Thank you.
Thank you. Let's go to Gina Smialek. Let's go to Gina. Okay, let's go to Steve Leisman.
Thank you, Mr. Thank you, Mr. Chairman. Mr. Chairman, I have one sort of technical question and one question on principle. The technical question is, if you're going to discuss balance sheet at next upcoming meetings and you won't begin balance sheet reduction until after you begin rate hikes. It seems to technically mean that you won't or can't begin balance sheet reduction until the summer. Is that correct? That's the first thing. Second of all, you suggested that the with balance sheet running in the background, that you would possibly be raising rates and running off the balance sheet at the same time. That's sort of the technical question part of it. The principal question I have is, you said it's going to be running in the background, but the statement on balance sheet principles says the committee is prepared to adjust any of the details of its approach based on economic and financial developments, which suggests there's something of a reaction function associated to the balance sheet, and it won't be running in the background. So could you give us any a sense of the discussion or staff presentation on what is the reaction function surrounding the balance sheet? Thanks.
So let me start by talking about that last paragraph. So you'll remember during the last cycle that this process of building up and then shrinking the balance sheet is a complicated one, and it involves inevitably surprises. And so during the prior cycle, we amended our balance sheet principles a number of times. Now, we didn't intend to do that. Events required us to do so. So we got a pretty robust paragraph there that says we're free to do this at any time. And it doesn't mean we're going to, but if the situation turns out to be different than we had thought, we're not going to stick with something that isn't working. That's all that's saying. It's meant to be quite a general statement rather than a hint. So, I mean, I like to think that our philosophy of the balance sheet is embodied in these principles. So, the idea that, for example, the federal funds rate is the primary means of adjusting the stance of policy, that will determine the timing and pace of reducing the size of the balance sheet to foster the dual mandate, that will begin to reduce the size after we begin the process of raising rates, and on like that. I mean, those are all the things that try to describe how we will proceed. But it may be at a higher level, to try to get at your question. Asset purchases were enormously important at the beginning of the recovery in terms of restoring market function, as they were right after in the critical phase of the global financial crisis. And then after, they were a macroeconomic tool to support demand. And now the economy no longer needs this highly accommodative policy that we put in place. So it's time to stop asset purchases first, and then at the appropriate time, start to shrink the balance sheet. Now, the balance sheet is substantially larger than it needs to be. We've identified the end state as in amounts needed to implement monetary policy efficiently, effectively in the ample reserves regime. So there's a substantial amount of shrinkage in the balance sheet to be done. That's going to take some time. We want that process to be orderly and predictable. And so those are some of the ways I would think this lays out our, the way we're thinking about this. In terms of the timing, I can't really help you. It just says after we get underway. So I would say we're going to have another discussion at the next meeting, and my guess is we'll have at least one other discussion at the meeting after that, and we'll tell you as we make progress, and we'll start the process of allowing runoff and shrinking the balance sheet at what we find to be the appropriate time. I wish I could say more, but honestly, we haven't made those decisions, and we actually haven't even really had the important discussions on a lot of the details that we will have at coming meetings.
Thank you. Let's go to Craig Torres.
Chair Powell. Chair Powell, good afternoon, Michelle and Chair Powell. Craig Torres from Bloomberg. Chair Powell, at the beginning of the conversation, you said risks are two-sided. And I'm wondering if you can elaborate on what are the risks to the elusive soft landing? Is Fed policy a risk, over tightening, or what are the risks? And then second, Chair Powell, I have a quick administrative question. Robert Kaplan's disclosure of his securities transactions. In a couple months, Chair Powell, or maybe sooner, you and I will file our tax returns and we'll list transactions and all kinds of things. And next to those transactions, we'll put dates. Bloomberg asked for the dates of Mr. Kaplan's transactions. The Dallas Fed is not giving us the dates, and I don't see why this is a matter for the Inspector General or anybody else. I mean, why can't he give us the dates? Will you help us get the dates of those transactions? Thanks.
So you asked about the risks first. So the one risk is that inflation risks are still to the upside in the views of most FOMC participants, and certainly in my view as well. There's a risk that the high inflation we're seeing will be prolonged, and there's a risk that it will move even higher. So, and we don't think that's the base case, but you ask what the risks are, and we have to be in a position with our monetary policy to address all of the plausible outcomes, and that calls for us to be in position. We have an expectation about the way the economy is going to be evolved, but we've got to be in a position to address different outcomes, including the one where inflation remains higher. And of course, that is a risk to the expansion. We've been saying that what we need here is another long expansion, which is the kind of thing we saw over the last, which is the record long expansion. We saw labor force participation rise. We saw wages persistently higher for people at the lower end, and there really was no obvious imbalance in the economy that threatened that expansion. It could have gone on for years were it not hit by the pandemic. So we'd love to find a way to get back to that. That's going to require price stability, and that's going to require the Fed to tighten interest rate policy and do our part in getting inflation back down to our 2% goal. So I mentioned two-sided risks. A couple things. One, the COVID is not over, and COVID can continue to evolve, and it's just we have to accept that it's not over, and the risks to it can slow down growth, and that's sort of a downside risk from a growth standpoint. I would point to another risk is just further problems in the supply chains, which could slow down activity. And you see the situation in China as a situation there where that's their no COVID policy may cause more lockdowns, is likely to, and that may play into more problems in supply chains. In addition, there's what's going on in Eastern Europe and things like that. So there's plenty of risk out there, and we can't forget that there are risks on both sides. So that's there. That's what I would say. I know you've been all over this issue with my colleagues, Craig, on the issue of information. We don't have that information at the board, and I asked the Inspector General to do an investigation, and that is out of my hands. I am playing no role in it. I seek to play no role in it, and I can't help you here today on this issue, and I'm sorry I can't.
Okay.
Thank you. We'll go to Gina now.
Thanks for taking our questions, Chair Powell, and sorry for my tech issues. I wonder if you could tell us a little bit about where your thinking on inflation stands today. The last time we saw an SEP back in September, we saw that you and your colleagues were projecting that inflation would sort of sink back down quite close to target by the end of the year. And I wonder if you still think that projection from December is a reasonable one, and if your thinking has changed at all, I wonder how you're thinking about that. And I also wonder if you could talk a little bit about the pathway to getting to that deceleration. Like how do we get from here, 7% CPI, to where you expect to be at the end of the year?
So I'd say, since the December meeting, I would say that the inflation situation is about the same, but probably slightly worse. I'd be inclined to raise my own estimate of 2022 core PCE inflation, let's just go with that, by a few tenths today. But we're not writing down an SEP at this meeting, but I think it hasn't gotten better. It's probably gotten just a bit worse, and that's been the pattern. So I think if you look at the FOMC participants, there's a range there, and that range has been moving to the right for a year now, and by the way, if you look at other forecasters, essentially all other macro forecasters who do this for a living, you've seen the same pattern. So what do we think about that? Well, I think we wrote down rate increases in the December meetings, each of us individually. And I think to the extent the situation deteriorates further, our policy will have to address that. If it deteriorates meaningfully further, either in the time dimension or in the size of the inflation dimension. So that's how we're thinking about it. As I mentioned, though, I think it's part of this will be that the Fed moving away from a very highly accommodative policy to a substantially less accommodative policy, and then over time to a policy that's not accommodative in time. I don't know when that will be. Those are the things that we're thinking about. That's part of it. Another part of it is that fiscal policy provided an impulse to growth over the last 2 years. That impulse will be less. In fact, will be negative this year. And so that's another thing. The other one is we will eventually get relief on the supply side. And the ports will be cleared up, and there will be semiconductors and things like that. Now, what we're learning is it's just taking much longer. So I think longer than expected. And that, I think, does raise the risk that high inflation will be more persistent. I do think we'll come off of the highs that we saw in the early part of this episode in the spring last year. But really, the question is going to be what is inflation running at, and so we'll be watching that. And our objective is to get inflation back down to 2%. It's also to provide enough support to keep the labor market healthy. The labor market is very, very strong right now. And I think that strength will continue. There's really a shortage of workers. We see it particularly among production and non-supervisory workers and people in the lowest quartile. You see very large wage increases. I mentioned some of the other indicators. So I think that's what we're looking at. And we're also, we realize, I think, as everyone does, that this outlook is quite uncertain and that we're going to have to adapt. And we're going to communicate as clearly as we can, but we're going to have to be adaptable and move as appropriate.
Great, thank you.
Thank you. Let's go to Colby Smith.
Thank you, Michelle. Chair Powell, when you talk about being humble and nimble about the path forward for monetary policy, does that also include the possibility of raising interest rates by larger increments and, say, doing a 50 basis points hike at some point if inflation does not moderate sufficiently? And should we interpret this approach as a departure from the gradual pace that we saw during the last hiking cycle?
So, as I mentioned, we have not made these decisions. We really haven't. And what I can tell you now, though, is that we fully appreciate that this is a different situation. If you look back to where we were in 2015, 16, 17, 18, when we were raising rates, inflation was very close to 2%, even below 2%. Unemployment was not at our estimates of the natural rate, and growth was in the 2 to 3% range. Right now, we have inflation running substantially above 2%, and more persistently than we would like. We have growth even in forecasts, even in the somewhat reduced forecasts for 2022. We still see growth substantially higher than what we estimate to be the potential growth rate. And we see a labor market where, by so many measures, it is historically tight. I think in a way, the least tight aspect of it is looking at the unemployment rate, which is still below our median estimate of maximum employment. If you look at things like quits and job openings, as I mentioned earlier, and wages, you're seeing, and just the ratio of job openings to unemployed, you're seeing a very, very tight labor market. Now, we also know that labor force participation is significantly lower. It's 1.5 percentage points lower than it was in February of 2020. Maybe 1 percentage point of that is retirements. Some part of those retirements are related to COVID rather than just regular retirements. So we think there is a pool of people out there who could come back into the labor force, but it's not happening very quickly, and it may continue to not happen very quickly as long as the pandemic is on. So that's how we think about that. We haven't made, to your specific question, we really have not addressed those questions, and we'll begin to address them as we move into the March meeting and meetings after that.
Let's go to Rachel.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can talk to us about any metrics that the Fed uses to assess how inflation affects different groups of Americans, especially lower income earners. And are you worried that the Fed underestimates or can't effectively measure the impact of inflation on some of the most vulnerable households? Thank you.
So it's more a matter of, I think the problem that we're talking about here is really that people are on fixed incomes who are living paycheck to paycheck. They're spending most or all of their of what they're earning on food, gasoline, rent, heating, things like that, basic necessities. And so inflation right away forces people like that to make very difficult decisions. So that's really the point. I'm not aware of inflation literally falling more on different socioeconomic groups. That's not the point. The point is some people are just really in prone to suffer more. I mean, for people who are economically well off, inflation isn't good. It's bad. High inflation is bad, but they're going to be able to continue to eat and keep their homes and drive their cars and things like that. It's more so that's really how I think of it. And we have to control inflation for the benefit of all Americans, but part of it is just that it's particularly hard on people with fixed incomes and low incomes who spend most of their income on necessities, which are experiencing high inflation now.
Thank you. Let's go to Edward Lawrence.
Thanks, Michelle, and thank you, Mr. Chairman, for taking the question here. So year over year, inflation's at a 40-year high. The input costs for producer price index for all of 2021 was the highest on record. Some investors fear that the Fed might be moving too late. Now, you said no decisions were made on the path of rate hikes, but was a rate hike more than 25 basis points discussed today? And as a follow to that, because I have problems with the mute button, as a follow to that, you testified that the supply chain issues could be worked out by the end of the year. You talked about that today. The CEO of Ford, though, told Fox Business today that the chip shortage will last into 2023. So today you said inflation will start to ease this year. I want to drill down and get a timeline that you see as to when we could see that relief. Thank you.
So I would not say that I would expect the supply chain issues to be completely worked out by the end of this year. I do not expect them, and I have not expected them. What I would say, and I have been saying, is that I expect progress to be made in the second half of this year, mainly. Progress, because we're not making much progress. If you look at a ton of metrics, you can find some that suggest that delivery times are shorter and inventories in some industries moving up, but overall, we're not making progress. And things like the semiconductor issue they're going to be quite a long time. I would think they'll go more than through 2023. In terms of being too late, I would just say this: our policy needs to be positioned to address the full range of plausible outcomes, as I said, and particularly the possibility that inflation will continue to run higher more persistently than we'd expected. And we think we are positioned to make the changes in our policy to do that, and we're committed to doing that. And that's really where we are. In terms of your question about the size of rate increases, we haven't faced those decisions. We haven't made them. It isn't possible to sit down here today and tell you with any confidence what the precise path will be. But as we work our way through this meeting by meeting, we are aware that this is a very different expansion, as I've said a couple times, with higher inflation, higher growth, a much stronger economy. And I think those differences are likely to be reflected in the policy that we implement.
Thank you. Let's go to Mike McKee.
Thank you, Mr. Chairman.
I'd like to sort of weave some of the strands of your answers together and ask you, as you start to reverse policy, what your goal is. Are you going to be raising interest rates until you get inflation to 2%? Do you want to go below 2% so that on average you get a 2% inflation rate? And because you said we have to protect the employment part of your mandate, is there some sort of circuit breaker that would stop you from raising interest rates on the employment side?
So no, there's nothing in our framework about having inflation run below 2%. So that we would do that, try to achieve that outcome. So the answer to that is no. What we're trying to do is keep inflation expectations well anchored at 2%. That's always the ultimate goal, and we do that in the service of having inflation. We get to that goal by having inflation average 2% over time. And if inflation doesn't average 2% over time, then it's not clear why inflation expectations would be anchored at 2%. So that's the way we think about that. What was the last part of your question?
I was asking if you're protecting the employment side of the mandate, whether there's some sort of circuit breaker there.
Nothing like that. I mean, I would say you have a tremendously strong labor market, and you have growth this year at forecast to be well above potential. I mean, people are forecasting growth. If you think potential growth is around 2, most forecasts are significantly above that for 2022, and that's even with policy becoming substantially less accommodative. So the labor market's going to be strong for some time. Ideally, what we're trying to achieve is inflation getting back down to 2%, and we're trying to do that in a process that accomplishes that will also leave the labor market in a very strong position. And no one really knows what that will take. Again, I would say that it isn't just monetary policy that's helping inflation get down. It'll be supply side improvements, and it'll be less fiscal impulse in all likelihood. So, but monetary policy will do our job. It is our job to get inflation down to 2%, and a situation where the two goals can be in tension is a difficult one. But I don't really think they are here, though, because I think a really significant threat to further strengthening in the labor market in the form of higher participation over time is high inflation. And also, high inflation is taking away the benefits of some of these large wage increases that we're seeing now. So we do hope to achieve, and our plan is to achieve both of those goals.
If I could follow up, does the danger of tightening too much as policy works its way into the economy with a lag mean that you should go back to being more forecast dependent in making decisions rather than the state dependency you've been using as a framework for the last year and a half or so?
State dependency was particularly around the thought that if we saw a very strong labor market, we would wait to see actual inflation before we tightened. And so that was a very state-dependent thought, because for a long time we'd been tightening on the expectation of high inflation, which never appeared. And that was the case for a number of years. So in this particular situation, we will be clearly monitoring incoming data as well as the evolving outlook.
Let's go to Michael Derby.
Thank you for taking my question. I want to ask you, with the benefit of hindsight, and I realize, I mean, that is what it is, but do you feel that, monetary policy and fiscal policy maybe did too much to react to the crisis, and that part of the inflation problem that we're having right now is because the government response, collectively was more than what the economy ended up needing?
So I think it's too soon to write that history, really. But what I would say is this. If you remember what it felt like at the beginning of the pandemic, literally the global economy shutting down in large part, including our own economy, and people going to their homes for weeks on end in masks, and there are no vaccines, and it could be a really long time to get them, and then you have economic activity drops by a shocking amount in one quarter. So there was a real risk of lasting damage. And I think Congress responded remarkably with the CARES Act, incredibly timely, very powerful. There'll always be flaws in these things, but in real time, it was a remarkable achievement. And we responded, and what we were able to do was, stave off a collapse of the financial system at the beginning and make time for what really needed to happen, which was the income replacement and then the recovery that Congress enabled with the CARES Act. So now that was a lot. And what we did was a lot. And now, what we have now is we have the strongest recovery of any country, and we have a recovery that looks completely unlike other recoveries that we've had because we've put so much support behind the recovery. And we're managing the relatively high-class problems that come with that, which are high inflation and a labor shortage. So, and these are serious problems, very serious problems that we're working as hard as we can on. Was it too much? Again, I'm going to leave that to the historians. But in 25 years, we'll look back at this incident, which will be a 2, 3, 4, 5-year period, and we'll say, we'll have a much better basis to make a judgment about the actions that people took. But it was all founded, though, in a very strong reaction to a unique historical event. And I guess I'll have to leave it at that. I hope I'll be around to see how that looks in 25 years.
Fair enough. Thank you.
Thank you. Let's go to Jean Young.
Thanks, Michelle. Chair Powell, some investors are expecting the yield curve could flatten or even invert after rate hikes begin. Would that worry you? And how important is that risk in the Fed's consideration for adjusting policy?
So we do monitor the slope of the yield curve, but we don't control the slope of the yield curve. Many factors influence longer-term interest rates. But it is something that we watch, and you will know that from when we had this issue a few years ago. And we take it into account along with many other financial conditions as we try to assess the implications of all those conditions for the economic outlook. So that's one thing I would say. Another is currently you've got a slope, if you think about 2s to 10s, two-year Treasury to 10-year Treasury, I think that's around 75 basis points. That's well within the range of a normal yield curve slope. So it's something we're monitoring. We don't think of it as, I don't think of it as some kind of an iron law, but we do look at it and try to understand the implications and what it's telling us. But it's one of many things that we monitor.
Can I follow up real quick and ask if it did invert, would you tie it to U.S. fundamentals, or would it be driven by a much broader set of factors?
That's a good question in real time. Obviously, U.S. long-term sovereign debt is an important global asset, and the fact that our rates are so much higher than other risk-free sovereign rates around the world may put something of a ceiling on our rates. I don't know, but it would really depend on the facts and circumstances at that time.
Thank you. Let's go to Brian Chung for the last question.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Within the context of just the broad effort to normalize rates, would you describe what you want to do as a gradual hiking? And then secondly, within the context of hiking cycles, it's often the talking point for financial stability and wanting to make sure that asset bubbles don't merge. Is that something that has also factored into the conversation as you start to think about hiking rates? Thanks.
I would describe what we're doing along these lines. This is going to be a year in which we move steadily away from the very highly accommodative monetary policy that we put in place to deal with the economic effects of the pandemic. And that's going to involve a number of things. It's going to involve, and it does involve, finishing asset purchases. It's going to involve lifting off, and it's going to involve additional rate increases as appropriate. And we're going to write down in March our next assessment of what that might be. It's going to continue to evolve as the data evolve. We need to be quite adaptable, I think, in our understanding of this. The last thing we're going to do is we're going to have a couple more meetings, I think, to talk about allowing the balance sheet to begin to run off and do so in a predictable manner. And that's something that we will also be doing as appropriate. And I wouldn't, I don't think it's possible to say exactly how this is going to go. And we're going to need to be, as I've mentioned, nimble about this. And the economy is quite different this time. I've said this several times now. The economy is quite different. It's stronger. Inflation is higher. The labor market is much stronger than it was. And growth is above trend, even this year, let alone last year. So all of those things are going to go into our thinking as we make monetary policy. And you asked about financials to have concerns. In connection with our policy, was that your question?
Yeah, within the context of other hiking cycles, it seems like worries about asset bubbles emerging as a result of easy rates has been part of that. I didn't know if that was part of the discussion today.
I would just say this. We of course have a financial stability framework. And what it shows is a number of positive aspects of financial stability. But you mentioned really asset prices is one of the four. So asset prices are somewhat elevated and they reflect a high risk appetite and that sort of thing. I don't really think asset prices themselves represent a significant threat to financial stability, and that's because households are in good shape financially than they have been. Businesses are in good shape financially. Defaults on business loans are low and that kind of thing. The banks are highly capitalized with high liquidity and quite resilient and strong. There are some concerns in the non-bank financial sector still around money market funds, although the SEC is has made some very positive proposals there. And we also saw some things in the Treasury market during the acute phase of the crisis, which we're looking at ways to address. But overall, the financial stability vulnerabilities are manageable, I would say.
Thank you very much.
Thank you.
All right, welcome to Yahoo Finance Live. I'm Adam Shapiro along with Emily McCormick, and we've been listening to Federal Reserve Chair Jay Powell talk about the statement from the FOMC, preparing all of us, investors on Wall Street and the rest of the nation, for liftoff interest rate increases, but not till March, nothing today. And we watched the markets react to this, especially when he said, because we'd been in the green for most of the trading session, but then when he said we may move sooner and faster on balance sheet than they had the last time, also that the FOMC is in mind to raise rates at the March meeting, we saw things go south. The Dow now trading down more than 384 points, the S&P 500 off 44 points, and the Nasdaq off 123 points. Emily, was there any one thing that jumped out to you that the chair was saying and that you might attribute this sell-off to?
Well, Adam, there were actually three things that I was really keeping an eye on, and that was the three big questions that I think Fed Chair Jerome Powell left unanswered. And it seems like those points of uncertainty are really what have market participants and equity investors especially a little bit jittery during today's session. Now, one of the questions that I have, and of course that was left unaddressed, was whether every meeting this year is going to be a live one with interest rate hikes, or whether it's going to actually be every other meeting that we get these rate hikes, how much each interest rate hike is going to be, whether it's going to be a quarter point or a 50 basis point rate hike. And also Fed Chair Powell also said that he can't say much at this point on the size, composition, or pace of the balance sheet reduction process. So again, I think these lingering uncertainties are things that markets are definitely focusing on today, and potentially why we're getting a little bit of the selling action here, Adam.
All right, the last question at the press conference was asked by our very own Yahoo Finance Fed correspondent, Brian Chung. And Brian, you were you were asking him for some clarity on these rate increases. Tell us more.
Yeah, well, my question to him at the very end, last but certainly not least, was really about the idea of whether or not the Fed wanted to be gradual with its moves this year. And the Fed chairman shying away from wanting to describe it as any one or singular adjective. And the reason for that is because the Fed wants to give itself optionality. And I think that's the word I would use to describe most of what the Fed's been trying to do over the course of this meeting. And that's because of two things. First of all, optionality on rate hikes themselves. Obviously, the Federal Reserve had messaged in December that it was intent on raising interest rates rates probably around 3 times over the course of 2022. But the Fed chairman said that inflationary pressures got slightly worse since that meeting. So if anything, directionally, we know the Fed would probably opt to do more interest rate hikes, but he didn't want to say or commit to 50 basis point hikes versus 25 basis point hikes or hikes in consecutive meetings. Keep in mind the Fed has meetings every 6 weeks. So it remains to be seen exactly how the Fed is going to do this on the interest rate front. But I would say optionality was also the theme on the balance sheet side of things as well. In that answer that he had to me, he was kind of emphasizing what he had told previous questioners over the course of the press conference, which is, look, at the end of the day, they released these principles for how the Fed after March would start to think about perhaps allowing its $9 trillion balance sheet to start to shrink. Now, the Fed said, for example, that it would primarily want to do this and favor treasuries over agency mortgage-backed securities, that they would want to do this by not reinvesting the principal for maturing securities that will simply roll off of the balance sheet. That's got a lot of questions as to whether or not the Fed would want to, for example, actively sell its agency mortgage-backed securities in the open market if it wanted to roll down the balance sheet quicker. Now, the Fed chairman didn't say they were going to do that. He just merely said that the principles that they published today, which were fairly boilerplate, were just a beginning and a starting point for that. But if you read the very first sentence of that statement, it says the Federal Reserve wants to significantly reduce its balance sheet. So make of that what you will. Maybe the Fed at some point later down the line will opt to get more aggressive by, instead of passively, maybe more actively allowing its balance sheet to shrink. So all very interesting things within the context of what's going on here.
Brian, I'm wondering, as you listened to Fed Chair Jerome Powell's press conference, what was your big takeaway on how the Fed and how Powell specifically is thinking about inflation? Because I think one thing that really stood out to me was when he said he was inclined to raise his own core PCE estimate for inflation for 2022 by a few tenths of a percentage point. So what were your big takeaways?
Yeah, well, I think obviously inflation is the big thing that the Fed chairman is trying to look at, because that is the onus for the Fed wanting to tighten its policy, right? On the labor market side of things, which is the other side of its dual mandate, the Fed chairman said that essentially most of the members of the FOMC feel like they're at maximum employment, which is the green light trigger for them to start normalizing policy. Now, on the inflationary front, what's interesting and going to be a very difficult question for the Fed is there's a lag to monetary policy. Even after the Fed starts to raise interest rates, it shouldn't be expected that in the first consumer price index report or PCE report that we'll get after that, that we'll start to see inflationary numbers start to fall. Now, that's important because the Fed needs to know that it could be a few months after they start to tighten rates that you'll start to see the impact on inflation, which means the Fed could perhaps over tighten, but then it could also work in the other way. If the inflationary numbers continue to remain high and the Fed is only going in a slower increment, the Fed might not realize that it's actually tightening too slow until many months into the process. So for the Fed chairman, he emphasized pretty much in that last answer to me that this is going to be a very interesting year, 2022, for the Fed to assess the way by which it's going to tighten and the interaction of that between their monetary policy and ultimately where prices go, which I think is a reason why thematically, as I just explained, optionality is really going to be the key for the Fed on both interest rates and their balance sheet.
But wait, there's more, as Ron Popeil would say, Brian Chung, before we let you go. You got a very important interview coming up on Friday. You're going to sit down with the Federal Reserve Bank President of Minneapolis, Neel Kashkari. This is going to be live, 10 a.m. right here on Yahoo Finance. You're going to discuss the Fed's latest decision. You're going to discuss inflation. But for some people who may have forgotten, Kashkari was front and center back in 2008, 2007, during the financial crisis and the collapse, part of the Paulson Treasury Department. And he has experience in not only the expansion of QE, but maybe some insight that Brian will get out of him on the contraction of what we have witnessed not only during the pandemic, but the last almost 20 years. All right, Brian Chung, thank you so much. Let's bring in the panel because we need to talk about what's going on. Tom Graff from Brown Advisory, head of fixed income, along with Gregory Farinello, Amerivest Securities U.S. Rates Group head. It's good to have both of you here. And I want to start with Tom. When you point out that the key for the Fed chair today was to have a tone, and he has to walk a kind of Johnny Cash fine line. He can either be hawkish or he can be dovish. And I'm curious, did he achieve what you think would be appropriate, or watching a bit of a sell-off, did we get a Powell plop?
Well, thanks for having me. I think he communicated a hawkish tone, to be sure. I think bringing in, talking repeatedly about how this time the economy is much stronger than it was in 2015, when there was sort of a very slow and halting rate hiking cycle. And then also sort of not answering some of the questions that Emily mentioned in the beginning, not committing to either hiking or not hiking at every single meeting or whatnot. All of that kind of pointed to, and then as you also mentioned, I think him saying that his own core PCE forecast would be up since just 6 weeks ago. I think all that's delivering a hawkish message. So I think, and I think he does that on purpose. So I think what he's trying to say is maybe the market hasn't priced in as much action as they see coming, and he doesn't want the market to be surprised down the road.
Gregory, I'm wondering, during the press conference today, Fed Chair Jerome Powell really said 5 times that this is not going to be the same cycle that we saw back in 2015 when the first interest rate hike was at the end of that year, and the next one didn't happen until a whole year later. I'm wondering, what do you think that sort of historical reference point signals to markets here about what we should expect, given the lingering uncertainties that Powell did leave in this press conference about what to expect this year?
Sure. Thank you for having me. I mean, we don't really have we have a playbook, but we only have one playbook, and certainly not through a pandemic. So, what we've emphasized to our clients is it's relatively the same playbook, but it's quicker, right? So if you look at really what the Fed has done since late last year, you look at what markets have done, financial conditions, and they do need financial conditions to tighten, to slow down the economy, but they need it done in an orderly fashion. So I thought the chairman had a good look today in terms of how markets have been reacting here. But certainly, I think the Fed is ready for March. I think the chair is ready to lift off in March. We think it's going to be 25, but certainly I don't think he ruled anything out today. And then with use of a balance sheet, the balance sheet's a lot bigger. If you look at the duration of the balance sheet, it's shorter, right? So the runoff can certainly be quicker, and we think that's going to come sooner. We think the signaling today, what I heard from the chairman today is, look, we're still working on it. We're not going to give you an exact timeline. So let's assume they lift off in March. Whether they go 25 and then another 25 in May, potentially in June. He said they're going to need another couple of meetings to get through this. So they're trying to manage, I think, markets and expectations in terms of when they will get to a game plan, which certainly will be, I think, definitive, and then to make that announcement and start to roll off the balance sheet middle of this year into the later part of 2022.
Gregory, to follow up on that, though, because you used the word expectations, as did the Fed chair, because as we all know, at least when it comes to inflation, it's the expectation that they're trying to control so that that doesn't get out of hand. Now we've got the roll-off, and we've seen just the volatility in the past 2 or 3 weeks, and we knew everything that was coming down the pike today, essentially. So not much has changed, but it seems what I'm hearing you say is this volatility doesn't end until they actually begin the roll-off, or we're going to get some stabilization very quickly?
I think we need to get past, it's a great question. I think we need to get past the next couple of months. We still expect volatility in the markets here in the coming months as we get closer to liftoff. Certainly I think the data is going to matter between here and March. We expect the inflationary readings to still be hot here short term. The Fed has very little flexibility around that. So I think the volatility that we're seeing in the marketplace right now is here to stay. We're not really going to get clarity, I think more clarity, until we get some Fed speak, I think, between now and the March meeting, some more data between now and the March meeting, get past that first rate hike, and get a better sense for what that pathway looks like, not only for rate hikes, but the balance sheet. So we're still in the camp here that markets are adjusting to this dramatic transition that the Fed has really thrown a lot at markets when you look at it within a short period of time. We're going to end asset purchases in March. We're going to lift off, and then we're talking aggressively about the balance sheet running off. I think that's within a short period of time. I think the Fed has thrown a lot at the markets.
Tom, one of the things that Powell clarified during his press conference was that he doesn't necessarily expect supply chain issues to be completely worked out by the end of this year, but that progress will be made in the second half of the year. I'm wondering, how do you think that informs investors on how the Fed and how Powell is thinking about inflation and inflation expectations and where they're being anchored by consumers?
Yeah, well, I think there's
All right, I think we actually lost Tom for a moment there. Do you want to kick that same question over to you, Greg, if you do have thoughts on that as well?
Can you share that one with me again? Yeah.
Absolutely. So one of the things that Powell was clarifying during his press conference was that he doesn't expect supply chain issues to be completely worked out by the end of this year, but that progress is going to be made in the second half of the year. I'm wondering how you think that is going to inform how investors should be thinking about the Fed's views on inflation and where consumers' inflation expectations are being anchored.
Sure, and that's really important. So the here and now, I think, is what the chairman is telling you. I don't think the Fed has a lot of flexibility. If you look at 2021, certainly the Fed was off base with regard to transitory. So they've got some work to do here short term, I think, to regain some credibility. So for investors, I think that's phase one here. Now, the second half of this year, inflation may very well come down. Our own forecast is for the economy to slow. But the reality is what we're seeing now, what we're seeing in the second half, that could very well impact, how the Fed guides rates as or if inflation does come down and those supply chain issues do alleviate. But that's really not the here and now is what I would say. But in the end, look, it's a long year. We're 1 month into the year. We still think this could be a good year for risk assets and for markets. We need to get through this transition. We need to get more clarity on the pathway of inflation. I think we need to get that first rate hike under our belt, and then we'll have a little bit more clarity, I think, in terms of how the second quarter, third quarter looks, where the Fed's cards are in terms of how many rate hikes. But certainly, look, this is a very strong economy in general. It's going to slow from extreme levels, but the reality is there's no reason why this economy can't handle 1, 2, 3 rate hikes and a little balance sheet runoff. There's plenty of liquidity still in the system.
That what you've just said is calming. Didn't quite hear that perhaps from the chair, but this is more of a personal question because he's gone from inflation is transitory to now very concerned about inflation and perhaps being persistent. I got to ask you, we're told, a lot of us are told that the Fed doesn't really let the markets influence its decision. They pay attention, nor do they let politics. But it sure sounds like the chair is covering his tush when he switches so drastically on inflation. What do you think?
You weren't going to let me off easy, Adam. I knew it. So look, if you look at, we wrote this morning in our morning piece, if you look at the dynamics from the prior administration in 2018, we had then President Trump that was screaming at the Fed to stop raising interest rates. Ultimately, they did, and they brought interest rates back down. Now, you look at the dynamics, they really couldn't be polar to what they were back then. We have inflation that's obviously impacting all Americans across the board, but politically, we also have a dynamic where it's impacting the political dynamics for the current president, right? So I think Powell is in a little bit of a tough spot right here. He's going to get renominated, but in the end, what he put forward today, I think, is the pathway that we're seeing right now, which is we're on our game. We're going to fight inflation. How successful they're going to be in the short term, I think we're going to have to see. And then I think the bigger risk really for markets over the longer term is if inflation doesn't come down, the Fed's going to have to get more aggressive, but we're not quite there yet.
Tom, I'm wondering, one thing that Powell also noted was that there was quite a bit of room to raise rates without hurting jobs. Do you think the Fed is actually going to be able to achieve the soft landing that it appears to be gearing towards right now?
Yeah, so that's a great question in terms of soft landing. I mean, if you look back historically, unfortunately, the Fed generally, they moved to a position at some point. We saw this back in 2018, although we don't think this is 2018. If you look at the balance sheet, it's far bigger. If you look at reserves in the banking system, they're far greater. So the Fed has, I think, a little bit more flexibility here. But the question is, yes, can they orchestrate a soft landing? And I think we're going to have to see the answer to that. I think what the Fed is saying, and we've been a little critical in saying they've been slow in removing some of these emergency measures, the balance sheet included. I mean, they're still going to buy through March. So that is the question. Can we orchestrate a soft landing here? And I think it's going to be a trial and error. And I think that's why even with the balance sheet, you didn't really hear, and there were some really good questions, you didn't really hear a totally definitive answer from the chairman in terms of a reaction function with the balance sheet, because I do think it's going to be a trial and error. And I think case in point is if you look at the markets here right now, over the last month, you look at some of the Fed's actions, you look at some of these market reactions, they will pay attention to how markets react. We don't think the reactions that we've seen in markets right now is enough to change the Fed stance. But, keep in mind, like I said before, they're throwing a lot at this market within a very short period of time. So this is not going to be a straight line. It's going to be touch and feel. They're going to get going here with some rate hikes. They'll put a plan in place for the balance sheet, but it's not going to be full speed ahead without taking a look at what financial conditions are doing and how quickly they're moving.
Greg, just got to say, trial and error. Markets don't seem to be afraid of trial. It's the error they fear. And so let's hope they get this right. Thank you so much for being with us. Gregory Farinello is Amerivet Securities U.S. Rates Group Head. Also want to let everybody know we had some technical difficulty, but we always appreciate Tom Graff, who is Brown Advisory's Head of Fixed Income, joining us, and we promise to get the tech issues fixed so that Tom can join us once again real soon. When we come back, we are going to talk about crypto.
Welcome back. During this afternoon's press conference, Federal Reserve Chair Jerome Powell wasn't asked directly about cryptocurrencies, but we did still see a reaction in crypto markets to this latest Fed decision. Now, Bitcoin prices paired gains from earlier today, and those are now trading around $37,000. And that price action is similar to what we saw in equities as well. For more, we're welcoming in Nick Day, CoinDesk Managing Editor of Global Policy and Regulation. And Nick, given that the fact that Bitcoin's correlation with stocks recently has increased, the fact that we've been hearing that tighter monetary policy could weigh on speculative assets like Bitcoin, should crypto investors be paying more attention to what's been coming out from the Fed?
Hey, good afternoon. Yeah, I think crypto investors should always really be paying attention, especially given that the Fed has at least recently started making actual announcements related to how it's approaching at least central bank digital currencies, if not Bitcoin and other digital assets directly. But yeah, there's definitely a lot to pay attention to. And as you noted, crypto has been, if not directly correlating with equities and more traditional securities, it has been, some pretty similar trends recently.
Help us understand what it would look like. Let's plan a year into the future. The Fed says, or somehow we're going to get some kind of digital central bank digital coin. What's the impact on Bitcoin and other crypto assets, or would there be an impact?
Honestly, I don't think there really would be. right now, the way the Fed, seems to be approaching this idea of a central bank digital currency or a digital dollar is, just kind of a, potentially blockchain-based equivalent to the existing dollar. So, in a report published last week, the Fed kind of outlined how it, is looking at the necessary, policy goals, and none of them really kind of address the, role that Bitcoin or other cryptocurrencies are playing right now. It's more just, they want a digital version, or potentially would want a digital version of the dollar that could be used for international policy, or to further any of the existing goals for the dollar as it stands. So Bitcoin, whatever happens with Bitcoin and Ether and other digital assets, I think that will continue on its own trend regardless.
So just to follow up with what you just said, and it helps us understand the impact. If we get this central bank digital whatever in a year, it doesn't impact what we call currencies, cryptocurrencies, which are really assets. But doesn't it kind of pull the curtain back, from the Wizard of Oz and say, look, these have value? But it's kind of like gold. I mean, I'm watching the mayor of New York get paid in Bitcoin, but he might as well just get paid in gold, because Bitcoin, in the world you've just perhaps laid out for us, works in the same way, right?
Yeah, I mean, my interpretation of that report is that if the Fed receives authorization from Congress and the president to launch a central bank digital currency, and it actually does so, then they're not going to be looking to, rewrite the global financial, system here. They're just trying to do what they've always been doing. And so in that sense, it's, a little bit of a conservative, description even, you could say. Whereas, yeah, Bitcoin is going to, it's currently being looked at as, this sort of, potential inflation hedge, potential, chaos hedge. And I don't see that changing, especially from those who are, true believers in Bitcoin. They're not going to be looking to a Fed digital dollar as, a either, vindication of digital assets or as the end of digital assets.
I want to shift gears and ask about something on the state level, because the New York State Senate just confirmed Adrienne Harris, who is a former federal official and professor, to lead the New York Department of Financial Services. I'm wondering, what do you think this means for the outlook for cryptocurrency regulation and policies in New York State specifically?
So Adrienne Harris actually had a confirmation hearing before the Senate Finance Committee in New York on Monday. And she actually did kind of describe her approach to crypto in saying that she wants to give more resources to the team that reviews BitLicense applications. So New York's virtual currency license. There's been, apparently a backlog of applications. Companies want to do business, but have not had permission to do so. And she suggested that she would, support giving that team more personnel or whatever they need to do so. She also expressed support for a Senate bill that would allow NYDFS to collect assessments off of off of the companies it regulates. So, the New York Department of Financial Services does not get, funding directly from the state itself. It's funded partly by, assessments and, whatnot it collects from the companies it's overseeing. So it could, give it a bit more, some more resources to oversee crypto and crypto companies, but it could also mean crypto companies have to, maybe factor that into whether or not they want to do business in the state to begin with.
All right, we'll leave it there for now. Nick Day is CoinDesk Managing Editor of Global Policy and Regulation. Thank you so much for your time. Coming up, we'll have more reaction to the Fed's latest monetary policy decision on the other side of this break.
So markets were trading to the upside even after we got the FOMC statement. It was during Jay Powell's presser when investors got a little worried and we started selling off a bit. Let's bring in our editor-in-chief, Andy Serwer, for his take on what we're witnessing and what may be worrying people who invest in all kinds of assets. Andy?
Yeah, Adam, it kind of reminds me back during the Trump administration when the president, then President Trump, would complain about Jay Powell saying the statement was fine, but then when he started talking, the market would go down, if you remember that. But, I think that there's probably certainly no intent on Chair Powell's part to do that. And I don't even really know if there's any sort of correlation, as the former president suggested there was. I think if you want to sort of take a big step back, the Fed and the Fed chair have been all about telegraphing these rate hikes, and you have to be hiding under a rock on another planet to not know they're coming. And if you think about it, you guys were talking about a landing a little while ago on the program, and I think that's kind of what we're getting here. I mean, it may not seem like a soft landing because it's been very bumpy this year, but in fact, if you look back, a couple of years from now, this is very much of a soft landing. And of course, it remains to be seen where we go from here, you guys.
Well, and Andy, I think one of the big takeaways that I had from this press conference was that taking together, it seems like the Fed is going to be more willing to raise interest rates if we get data pointing to higher and longer lasting inflation, rather than continuing accommodative monetary policies in the face of potentially downside employment surprises. And I'm wondering, how much more explicit do you think Powell could have been, if at all, to potentially assuage some of these markets? Because it does seem some of these lingering uncertainties about the extent of interest rate hikes, the timing of the balance sheet reduction is what's really concerning market participants right now.
Yeah, but I mean, maybe as you're suggesting, Emily, hello, right? I mean, he is really making it very, very clear. And it's sort of like he really means it. They're really going to do this in March. I mean, of course, unless everything falls off a cliff between now and then. So I think that there's little doubt. And, to the extent that that means that people need to continue selling growth stocks off, I think that's, a definite reality, or certainly a possibility going forward. And the reason why, of course, is these growth stocks are all about a future stream of earnings, say $100,000 in the future. Well, those $100,000 that you would be getting paid in the future are worth a lot more when interest rates are zero than when, say, interest rates are 7%, if you think about it. So that's exactly what's going on. You'll read all kinds of things that say, oh, actually, growth stocks do okay. But it really is a wind specifically in growth investors' faces. Having said that, it's kind of encouraging this afternoon to see some of those big names still trading on fundamentals. Microsoft is up still because of last night's earnings, which were robust. Intel got a nice bump today as well because of a settlement in Europe, and NVIDIA with the breakup of the ARM deal. So those big tech names are up, and Google's even up. So, all is not lost here, but, this is a time of reckoning potentially. Now, the real question is this still, we know it's not transitory. No one's talking about that anymore, but is it really all COVID related? And if COVID goes away, we're still going to have some friction with China when it comes to supply chain, but it could turn around fairly quickly. How systemic has it become, or has COVID triggered systemic inflation?
It's the question that if we could answer it today, we'd all be wealthy people tomorrow. Andy Serwer is our editor-in-chief. Thank you for joining us. When we come back, we're going to count down to the closing bell.
Welcome back. Let's bring in our market panel now to discuss more on the Fed's latest monetary policy decision and the market reaction that we're seeing with the Nasdaq Composite now trading in slightly positive territory, though the S&P 500 and Dow are still in the red. And for that, we have Chris Constantinos, Riverfront Investment Group Chief Investment Strategist, and Sean Cruz, TD Ameritrade Senior Market Strategist. But before we turn it over to you both, do you want to get one final check of the markets as we head into this closing bell? Definitely getting quite a bit of a swing here as we had the Federal Reserve's monetary policy statement coming out at 2 p.m. Eastern. Just after that, we did see stocks trading in sharply positive territory. The S&P 500 had risen by more than 2% to reach session highs, but is now trading just slightly below the flat line. And the Dow Jones Industrial Average likewise also down by about 100 points, or about 0.3 percentage points. We're definitely seeing a bit of a reversal on that front as well. With all that in mind, here's the closing bell.
Can you hear me? Great. The S&P 500 is going to be off about 6 points, and then the Nasdaq actually pulled up 2.82 points. There you go. Let's get to the panel. Let's talk about what we're witnessing here. And Andy Serwer, our editor-in-chief, pointed out that really the only perhaps new thing we got today was the increased speed with which roll-off will take place. So let me start, Chris. From your viewpoint, what do we as investors do with that? Because we may speed it up, but they're not doing it yet.
Yeah, I think it's a classic case of the Fed being as transparent as they think they can be, which is, of course, not maybe quite as transparent as we'd all like them to be, but they sort of have to walk the line between giving us the information we need without TMI, I suppose. I think that, when we sat down and wrote our 2022 outlook here at Riverfront back in November, early December, we did highlight that a more hawkish than expected Fed is the number one risk to stock markets in 22. Having said that, you mentioned earlier on the program about inflation. We're of the view that there's still a pretty good chance inflation moderates here in the first half of 22. And so even if the Fed starts down a relatively hawkish path, which as per today sounds like they're going to, there's no reason that they have to continue that path. And they don't have to be quite as aggressive as maybe they sounded today, should inflation really back off, because I think inflation has been the key reason that they've done this sort of body language about face in the last month and a half.
Sean, this isn't necessarily something that Powell gave any clarity on, but do you think the Fed is going to need to implement a 50 basis point rate hike at some point this year in order to get ahead of inflation?
Yeah, it was interesting. In his press conference, he was asked specifically about that, and his response was that they're going to discuss that when they approach that March meeting. So he didn't completely rule it out. Another thing he said that I think if you really are trying to fish for some sort of hawkish commentary or hints he gave in the press conference, was he mentioned that they really felt they had a lot of room to hike rates without disrupting the labor market. And when you think about the Fed's dual mandate, it's price stability and low levels of unemployment. So if they feel that they can achieve that price stability without raising unemployment, I think that gives them a lot of room to hike rates if they do really feel like that is the case.
And yet, Sean, just to follow up with that, when the Fed chair talked about expectations, because that's what they're afraid of, is that the expectation that we're all going to have to pay more tomorrow for the stuff that we're buying today, and therefore we pull those sales forward. Controlling that expectation, even in a full employment environment, the people in the bottom two quintiles are not keeping up with inflation. And how does that play into this decision they're going to make?
I think that's going to probably play out in the way I would view that is really just thinking about some of the wealth effects in the economy, and we usually talk about asset prices when we're thinking of that. But I also think looking at real wages, that is going to be a major concern. And if you look at what the market's done since the Fed really came out earlier on this month, before they went in their quiet period and gave some discussion, the market has really done a little bit of the tightening for them in some regards. already. So I'm going to be curious to see what the market is already priced in, and in the weeks to come, what we get that could price in a little bit more. But that certainly does create some issues for some of those companies. Think of like a Dollar General, a company that really caters to that audience. That does create some risk for them just in terms of revenue if their customers do really start getting hit in terms of their real income.
Chris, over the past couple of weeks, we've seen this massive, really, repricing of stocks and especially highly valued growth stocks. And I'm wondering, did you hear anything in today's press conference or in today's statement that you think warrants a shift to this sort of repricing that we've seen on valuations?
Well, I was actually just having this conversation with a colleague a couple of minutes before I came on your program. And if anyone was looking for Jay Powell to sound like a white knight for long duration assets, that definitely didn't happen today. And I do want to take a step back, though. If you look at where the carnage has been really concentrated, it's in a bunch of stocks that, when you look at it through a broader lens, the fundamentals really aren't all that strong relative to their valuation. These have, by and large, been stocks that have been in somewhat like bubble territory here for, let's call it 3 or 4 quarters plus. And so some of this is maybe just healthy in terms of it, reorienting all of us around fundamentals a little bit more in the market. Now, of course, there's been some probably babies thrown out with the bathwater. You mentioned earlier on the program some of the really good results from some of the mega cap tech names, which I think the fundamentals there are very strong, and they don't really trade at a huge premium. Some of those names, particularly in the software space, they don't really trade at a premium per se to the S&P 500, despite the fact they're growing dividends faster. They pay dividends, which a lot of high-flying tech doesn't. So part of this, I think, is healthy and just a correct, if you will, repricing of some assets that probably got a couple years ahead of their skis in terms of pricing in really aggressive forward growth. Having said that, I do think that long duration assets could continue to be under some pressure here in the near term because when you're selling tech, a lot of investors are selling tech indiscriminately, and they're just trying to trim equity risk, trimming equity beta, and some really good companies I think are getting thrown out in the bathwater. So if you're a long-term investor, I look for periods of volatility like what we're seeing today to maybe be more discerning, and that's what we're trying to do here at Riverfront. We're being more granular in our security selection. A couple years ago, it was all about making sure you had enough. Your stock to bond ratio was properly calibrated. Now, I think going forward, it's going to be a lot more about individual company and sector fundamentals.
Chris, I think some of us, and I want to follow up to what you just said, we use folk like you to help us make the decisions. And I'm going to use Tesla as the example. You don't have to comment on a specific stock if you don't want to, but we're awaiting their earnings report. And you're looking as an investor for those kinds of issues you've just talked about, and yet you look at the price of a Tesla and you think, where's my growth going to come from, regardless of all these other issues going on? How do you calm your clients, those of us who are investors, into making the decision of yay or nay on a stock like that?
Sure. So first of all, my compliance department gets very nervous when I talk about individual stocks, so I'll speak broadly. But there's growth rate imputed ways to value corporate equity, and if you back into the growth rate expected for some of these companies, you're realizing that their current market caps, even after the recent sell-off, are baking in really, really aggressive or really maybe unrealistic expectations about what the future state holds. Those are not the kind of names that my firm tends to focus on because we just don't think we're smart enough to figure out growth that far in the future. We'd rather look for dividend streams and cash flows in the near term that we think have more certainty. But at just a more general level too, I think the best way to approach periods like this for investors writ large is make sure you have a risk management discipline. Understand that risk management it's not a holy grail. You're going to get some things wrong. You're going to sell some stuff, and then 6 months later, you're going to wish that you still owned it. You're going to feel silly. But just having some sort of unemotional way to set stops in the market, we think is a really good strategy for an investor. But make sure you also have similar types of disciplines to stop you back into owning equities as well. Because what we see a lot with investors is that they're quick to get out of stock when things seem really weird. They're not so quick to get back in when the fundamentals have turned back around. And that's usually where we see the biggest mistakes being made in equities, not at the sell point, but rather having that discipline to get back in as well. So just being honest with yourself, being unemotional about equities, you can sell them and buy them right back. And, stocks won't hold it against you, is what I always like to say. And that, generally speaking, has served us well as asset allocators.
And we want to pause this conversation really quickly and head over to Yahoo Finance's Pras Subramanian, who's standing by with earnings results from Tesla. Pras, break these down for us.
Yeah, Emily, stock lower here. I'm going to go through some of these numbers here. A beat on both the top and bottom line. Revenue coming in at 17.7 billion, topping estimate 16.64 billion. That's a record right there. Q4 adjusted EPS 254, topping estimates 237. That highly watched GAAP net income, Emily, that you were talking about before, a record 2.3 billion. Third time it's passed 1 billion in net income, GAAP net income for the quarter. So another big beat there. Automotive gross margin above 30.6%, again beating estimates, and they have 17.6 billion cash on hand and cash equivalents. No change to deliveries. They also see capacity and volume staying at 50% compound annual growth rate. That's something they've been saying for quite a few quarters now. We also don't see a change in annual capacity at the three plants. California Fremont factory still at 600,000. Shanghai at 450,000. I want to note one thing in their product outlook. At the end of their shareholder deck, they mentioned this could be knocking the stock a little bit. The pace of production ramps in Austin and Berlin will be influenced by the successful introduction of many new products and manufacturing technologies in new locations, ongoing supply chain related challenges, regional permitting. We are making progress on the industrialization of the Cybertruck, which is currently planned for Austin production subsequent to Model Y. So we don't know if that's going to be end of this year or even possibly the beginning of 2023. On the call, Elon Musk will return to the call after a few quarters off. He's going to talk about a product roadmap, so maybe we'll get an update on that, in addition to any new news on that Cybertruck date. We're also hoping to hear about FSD and investigations with NHTSA, anything new on that front. And also, lastly, many investors and also customers are asking about customer service improvements. Are they going to invest in those areas where Tesla's sold so many trucks and cars, SUVs and cars over the past year? People are having problems servicing them. So that's another issue that's a paramount concern on the call later today.
All right, Pras Subramanian, thank you very much. Got to get to, we've got Jared standing by. He's got Intel earnings. What have they got?
That's right. It was a beat on the top line and a miss on the bottom line. You can see the stock's down 2%. In after hours trading was down as much as 4%. Here are the numbers. We have revenue for the quarter coming in at this is a projection for their first quarter revenue. They expect it to be $18.3 billion. That's higher than the estimate for $17.67 billion. They're seeing first quarter adjusted EPS at 80 cents, but that was lower than the estimate of 86 cents. Now for the reporting quarter, fourth quarter revenue came in at $20.5 billion. The estimate was for lower $18.33 billion. And also their fourth quarter adjusted EPS, $1.09. The estimate was for lower at 90 cents. So originally I misspoke. It was their outlook where we had that bottom line number that was missing expectations. So the board has also declared a quarterly dividend of 36.5 cents per share. That's a 5% boost to that quarterly cash dividend. They're also seeing their first quarter EPS at 80 cents. That's that number once again. And also going down the line here, their Mobileye revenue, this is a unit that they're considering offloading. They've already made that decision as part of Pat Gelsinger's turnaround strategy. That came in at $356 million. Estimate was for $366.6 million, but it's really their PC revenue. That came in at $10 billion. 0.16. So a lot of attention on this. Here's a number that might catch investors' attention. The gross margin for the fourth quarter coming in at 53.6%, and their projection for the first quarter revenue, that's the current quarter, 49%. And that used to be a number that was in the 60s, but not now during their turnaround strategy. Also, investors are noting that on the call today, their guidance might be a little bit light because they are having an investor day about 3 weeks in the future, February 17th, so might be a little bit light on the color as they execute their plan here, guys. So it was a beat on both the top and bottom lines, but the stock here under a little bit of pressure given the outlook.
Yahoo Finance's Jared Blickery, thank you so much. Sean, I want to turn this next question back over to you. And when we zoom out and think about corporate earnings so far, of course, Tesla and Intel are trading lower after their own results. But do you expect earnings and what we'll be seeing for the rest of fourth quarter season to help support stocks this year, even against a backdrop of the Fed hiking rates and rolling off its balance sheet?
Yeah, well, I think it's going to turn to an environment where being a stock picker can be rewarded, because there is going to be a little bit of a divergence here between companies that are executing well and able to navigate these waters and companies that just frankly can't. And if you are a company that has a little bit of a stretched valuation, particularly in that tech space, and you aren't delivering on either bringing more customers in, you're not delivering on your ability to maintain or grow margin, or you just have guidance that spooks investors a little bit. If you're a company that's a little bit stretched on the valuation and the investors don't get the sense you're firing on all cylinders, I think those are companies that are going to get hit pretty hard. But there will be some opportunity created with these broad market sell-offs where you maybe can get entry into a company ahead of a decent earnings report. And I use Microsoft as a good example of a company like that.
All right, Sean Cruz is TD Ameritrade Senior Market Strategist, and Chris Constantinos is Riverfront Investment Group Chief Investment Strategist as well. Coming up, we're going to dive deeper into those earnings results from Tesla. Stick with us.
All right, when we talk about Tesla earnings, sometimes you got to know when to hold them, know when to fold them. When is a bluff a bluff? The reason I set that up is our next guest, Dan Ives, understands Tesla much better than the rest of us. And Dan, you've pointed out that Tesla, in fact, the EV market by 2030 is a $5 trillion market, $2.5 trillion of which is going to be Tesla. And yet, we're watching it sell off right now. So help us understand what some people may miss with this earnings report.
I think these are just knee-jerk reactions, just like I saw last night with Microsoft. I mean, if you look at underlying growth for this year, I think they're up probably closer to 60-70% in terms of units. Supply continues to be constrained. They'll be a little conservative on that, which I think we fully expected. We're only in the second inning of what's going to be a $5 trillion green tidal wave. So any, the stock selling off here, we just view as an opportunity to own this more.
Dan, great to see you. I'm pulling a quote here from this fourth quarter earnings release. Tesla saying, quote, in Q4, we saw a continuation of global supply chain, transportation, labor, and other manufacturing challenges, limiting our ability to run our factories at full capacity. Now, you alluded to this, but how big of a concern are supply chain snarls, chip shortages going to be for Tesla relative to other automakers throughout the course of 2022?
Yeah, I mean, so let's just put it in perspective. They had about 309,000. In terms of vehicles sold in the quarter, that would have been about 35,000 higher if not for chip shortage. So there, if you look right now, it's about a 10 to 15% headwind in terms of where numbers could truly be. Right now you have 5 to 6 month reservations. You got China ramping capacity. Austin, we think pre-production's already started. That'll be a big focus in the call. They don't have a demand issue. They got a supply issue. And again, I view that as a high-class problem, and that's something that Musk will talk about on the call.
What do you want to hear him say? I'm looking at the deck where they talk about the Model Ys being built at the Gigafactory in Texas, and then they talk about Fremont with the capacity for more than 600,000 per year. So what does he have to say to make sure that they're not going to lose control of this, even with the supply constraints?
Yeah, so let's walk through 3 things you need to hear that are key. 1, given a timetable in Austin, pre-production started, what does the ramp look like in Austin? That's going to be key. 2, in terms of how they're going to be increasing capacity, both in Shanghai as well as Fremont. And then the 3rd is giving some sort of sense from a timetable into what we could see from a unit demand, what they're seeing out of China in particular. I think that continues to be a big source of strength. And overall, it's giving investors confidence that we could be at 2 million in terms of capacity by the end of the year, whereas today that's 1 million. Double capacity, that happens. This is a stock in the green tomorrow.
Dan, we saw in this earnings release as well that there's been an increase in the number of Tesla owners who are participating in this full self-driving beta software test, with nearly 60,000 vehicles in the US currently enrolled. How big of a growth driver do you think this software and other rollouts from Tesla are going to be to this overall story?
I mean, FSD ultimately over time is worth $300-400 a share to the story. So as they continue to sort of execute there, but you need more data points, more and more drivers to be participating in the FSD program. And that's going to be a focus of the street, over the coming years. I think near term, a big focus is the 4680 battery technology. It's a big part of their moat, big part of the cost of an average EV, and I think any sort of timetable on 4680, what's happening there. But FSD, I mean, that's sort of the cherry on top of the sundae. That's really, from a bull perspective, a big part of the Tesla story. And that's why for any core bull in Tesla, that's been through all the battles over the last few years, they're just in a position of strength here, especially when it comes to distribution, that moat.
As we're talking, we saw this, as you pointed out, with Microsoft yesterday, despite the strong cloud performance, and then, of course, it turned around. But it hasn't turned around yet for Tesla. Is this just a case of perhaps, less experienced investors just see the stock price and they're not looking at what we're talking about? I mean, as you just said, position for growth and the pace of production ramps in Austin and Berlin, influenced by the successful introduction of new product and manufacturing technologies in new locations. I mean, their whole story is one of future growth.
Look, it is a nerve-wracking environment, and I view it as the biggest overall disruptive tech earnings season in the last decade. So you're going to see a lot of knee-jerk reactions, a lot of volatility, Fed here, Fed there, valuation scrutiny, but that's why you look at core fundamentals. And if you look at the fundamentals and the profitability and the story at Tesla, I think the golden goose for them continues to be going after the EV market and gaining more and more of that advantage, and that's what's happening. But you're going to see a lot of the volatility, the hand-holding period. That's why Musk is going to be on the call, laying it out.
Dan, I'm wondering, as we look at these fourth quarter automotive gross margins, those coming in at 30.6%, the street had 29.9% at consensus, according to Bloomberg. Where do you think the next incremental improvement is going to come in terms of profitability? Is it going to be from cost cutting, operational efficiencies, or really just letting these supply chain challenges run their course?
Yeah, I mean, it's really, you made a great point on the last point, because supply chain right now, that's probably a 200 to 300 bip headwind from a cost perspective. To have auto gross margins above 30 continues to almost be defying gravity, but that's what Tesla is ultimately doing. It's more software driven. An average car sold in China versus the US, manufactured and sold in China, is 25 to 30% more profitable. You're seeing more of the cars come out of China. Once they got Giga Berlin, that's going to be key to what we're seeing in terms of European scale. And then, of course, Austin. And right now, Tesla's flexing their muscles. Stock will be volatile. We continue to think this ultimately is a name that continues to go toward 4 digits. You know, we have a $1,400 base target, and there's nothing we see here that in any way changes our bull thesis.
Dan Ives, you had us at 5 trillion by 2030, the EV market. Thank you so much. And Dan is Wedbush Securities Managing Director. When we come back, we're going to break down the Intel earnings report.
Welcome back. Intel reported quarterly results after market close just a few moments ago earlier today, and that stock is down in the after-hours session. For more, we have John Vinh, KeyBanc Capital Markets Managing Director and Senior Research Analyst here with us to discuss. John, just taking a look at these results, it looks like Intel's weaker than expected earnings forecast is what investors are reacting to with the stock down now. But what was your biggest takeaway from these results?
Yeah, a little bit of a mixed bag here. For sure, the quarter was really strong, be it on top and bottom line. Client computing and data center group were both above expectations, but certainly kind of the miss on the outlook was a little bit weaker. Revenues were a little bit higher. EPS was a little bit lower. Gross margins was also a little bit lower. I would say that one of the other kind of key takeaways from the results was that the cloud data center outlook was a little bit weaker. Yesterday, we've seen Microsoft Azure up over 40% growth, but Intel's cloud data center group revenues are only down 5%. Seems to suggest to me that they're potentially still losing share to AMD at this point.
So how do they change that around? I mean, this is what they're going to be asked. But if that's the case, I mean, you've got these investors right now who are concerned about, not only this first quarter, but I don't want to use the word losing the race, but how do they catch up?
It's unfortunately going to just take a lot of time, right? Pat Gelsinger, the CEO, has put forth a very ambitious roadmap to kind of get back to parity with AMD and regain share. But unfortunately, it's going to take them at least over a year. They do have a new chip, Sapphire Rapids, that's supposed to ramp at the end of the year, but that's not really going to be in meaningful volume production until the first half of 2023. So it's going to take quite a bit of time for them to turn things around. And I think there's still some uncertainty whether that's actually going to happen, because AMD is not going to sit on its laurels and they're going to continue to innovate as well.
Do you think Intel is spending too much relative to the share it may gain through these efforts to regain share from AMD?
I actually do not. As a former bull, last year for most of the year, we had an overweight rating. And as a former bull, I think Pat and the new management team is doing everything you'd want. You'd want them to invest aggressively at this point in time. You do want them to kind of invest heavily in CapEx and demonstrate that they've got a commitment to not only get to parity with AMD, but to regain share. Obviously near term, the optics aren't going to look good. The margins are going to be lower. The increase in CapEx is going to hit the gross margins. But from an investment perspective, I think Intel is doing all the right things. It's just going to take time to turn things around.
From the standpoint of the company, though, there were analysts who were critical of their build out plans. And if I'm understanding correctly, if I'm not correct, so that we do get a good picture of this, it's almost as if they're damned if they do, damned if they don't, because they do have to, as you point out, catch up to their competitor. But yet analysts get very upset when they spend as aggressively as they are to try and do that.
Yeah, I think that's why we're at a sector weight rating. This is going to be a long-term investment. Many investors, and especially many analysts on the sell side, are really focused on kind of near-term optics, right? If you can't get the quarter right, you can't manage margins, and you can't manage profitability while turning things around, you're typically not going to get rewarded for some of these longer-term investments. But if you do have a much longer-term horizon, I think you're going to be aligned with what management's doing here.
I'm wondering, you of course cover a number of companies in the semiconductor space. I'm wondering, with the sell-off that we've seen recently across tech stocks and across semiconductors underperforming the broader market, do you think this has been overdone?
I certainly think so, and I understand it, right? If you look at the stocks over a longer period of time, right, we've had 3 years of significant appreciation in the stocks. It's up over 200% over the last 3 years. Never in the history of the stocks have we had 4 years of appreciation. And if 2022 is an up year for the stocks, that would be a 4th year, right? So obviously investors are getting really nervous in terms of where we are in the semi cycle at this point in time. However, we're still very constructive at this point in time. We think, this cycle is different. I think the demand creation that the pandemic has created with kind of the work from home, cloud data center growth, 5G infrastructure, I think these are, secular drivers that we've never had. So we still are looking for a really strong year of growth. And certainly we think things are a little bit overdone here.
All right, we'll leave it there for now. John Vinh is KeyBank Capital Markets Managing Director and Senior Research Analyst, and we thank you so much for your time. Coming up, we'll discuss a company investing in your home equity. That's on the other side of this break.
So we've all watched the price of a home just about anywhere in the United States skyrocket over the last 2 years. So what if we were to say you can not only make money if you own the home, the equity involved in it, but if you're the neighbor and you want to make money on your neighbor's house, there's a way to invest now in the equity of your neighbor's house. Let's talk about all of this with the Unlocking Finance's what we'll call Final Frontier. Let's bring in Eddie Lim. He is Point CEO and founder. And the platform, do I get this correctly? If I've got, let's say, $100,000 in equity in my residence, I can now bring in, use that. Well, how does it work? I can bring in outside investors to join in the game?
Yeah, Adam, great to see you again. And Emily, nice to meet you. Yeah, that's absolutely right. We're making investments in homes today. On average, that's a lump sum of $100,000, and now in many cases up to $500,000. And because it's an investment, that's what's really compelling here for our homeowners is there's no monthly payment for up to 30 years. And given everything that's going on right now with stock market volatility, affordability in housing, impending rate hikes, that's a great, very, very compelling feature.
So I'm wondering, given the way that your business model is structured, are there situations where the value of the home depreciates since a homeowner actually partners with you and the amount that is paid back to Point is then actually less than what you paid to the homeowner? And if so, is that very common?
It has happened a few times. That's a great question. With the last few years, we've seen unprecedented home price appreciation. In those scenarios where that's happened, it's a really interesting kind of alignment because it's lose-lose for everybody, right? If the value for the investor has gone down, and so the homeowner pays us back or pays the investor back less than they actually received up front, but it's actually not good for the homeowner either because that means their home's gone down in value. So everyone is aligned here to really maximize the property health and the value of the home.
The part, if I've got it right, though, that intrigued me about this is, okay, the homeowner can do well here, but then I'm the neighbor. I've got no skin in this game, and yet I can do well through what you're securitizing, correct?
That's right. Yeah, and we actually did our very first securitization just at the end of last year. And no, you've absolutely nailed it, right? Investors can also get the diversification benefits and alignment benefits that that homeowners get here by being able to take money out of their home and put into home improvement, put into an investment property, or just to pay off some of that expensive credit card debt.
So for those who actually participate in this securitization, as Adam was talking about, if you're the neighbor and wants to invest in this as well, how do you foresee this being a part of a portfolio? Is this something where you could invest in a number of different properties and have a number of pieces of home equity? Or how do you see that working from the individual investor standpoint?
Yeah, investors definitely think about this from a broader portfolio and diversification perspective. That you absolutely kind of nailed that. So what's really great about this is with the securitization, it's really an inflection point for Point and the entire industry. That's really kind of the beginning of a new asset class for investors. And so with broader market acceptance and more ways to get access to these investments and more liquidity, you can now see a path to not just billions of dollars, but really hundreds of billions of dollars being deployed into this asset class over the coming decade. And the great thing about this is it's actually the homeowners who ultimately stand to benefit the most, right? As the markets become more efficient, as the cost of the homeowners will come down. And we're already starting to see that just a few months after this first securitization.
So if I, again, because I love the idea, but as an investor, not the homeowner, but the investor, I have two paths to liquidity here is I could sell whatever I've purchased in the investment, or when that house or a block of these houses get sold, there's a payout to the maturity of the security, correct?
That's right. And in fact, many homeowners pay us back through refinances as well. So refinances, selling their home. But yes, to your point also, the underlying security also has regular payments on it.
How does your business benefit or perhaps not benefit and is impacted by a rising interest rate environment? Is that something you're keeping an eye on and that investors should be thinking about as well this year?
Absolutely. For us, Point stands to benefit significantly from rate hikes. And it's for the simple reason that as new refinances and HELOCs become more expensive, our no monthly payment product becomes even more compelling for homeowners.
Again, loving the idea, but don't you, I realize nobody's predicting a retraction in home values, but that's where people get burned, is when nobody's predicting that. Wouldn't, whether you, those who are investing in the securitized product, if there were a downturn in the housing market, wouldn't there be a potential loss for them?
Yeah, in terms of broader housing market dynamics, I think we're aligned with a lot of other economists like Freddie Mac out there. They just published a report last week. They're projecting 6.2%, in home price appreciation this year. But it makes sense in that there's still very, very limited housing supply. Barely a month of supply out there. There's no new significant supply expected to come onto the market. Home buyers, prospective home buyers, have had increasing wages, and the cost to build and the cost for home improvements are still very, very expensive. And so a lot of these factors, more than offset the potential of market forces like rate increases.
Eddie Lim, all the best to you once again. I'd be the neighbor, by the way, if I was investing in the neighbor's house. I'm the guy next door who yells, "Get off my lawn." But Eddie Lim is Point CEO and founder. All the best to you. We'll be right back.
Welcome back. President Joe Biden hosted a number of private sector CEOs at the White House earlier today, from GM's Mary Barra to Microsoft's Brad Smith, to discuss the administration's Build Back Better plan. For more, we have Yahoo Finance's Rick Newman here with us now. And Rick, the last that we heard about the Build Back Better plan, we knew it had been stalled, and Biden was also discussing breaking it up into smaller pieces potentially to get it passed. Do we have any more updates from this meeting?
Well, I think you characterize it right, Emily, when you say the last time we heard about it, because this has fallen off the front page, as it were. And I think the Biden administration is trying to get it back on the front page which is why one of the reasons they did this on-camera meeting, Biden and 10 CEOs from prominent companies. So mostly they talked about two basic provisions that I guess will be in the reformulated, new and improved, smaller but better Build Back Better plan that Congress may generate. They talked about green energy provisions, efforts to address climate change, and things that would help with childcare. And that was about it. So what they did not talk about is the child tax credit expansion, which expired at the end of December. That seems like it's just going to be too expensive to get in this bill. There are a couple of key Democrats who don't support that. So it sounds like we're heading toward a Build Back Better with a few of the things all Democrats can support and without the things that a few Democrats are opposed to.
The question I'm asking is, what do they gain, though, from a smaller, fewer things that everyone supports, if the public itself doesn't seem really geared for it? I mean, as you pointed out at the start of this, most people have kind of put on the back burner the whole kerfuffle over Build Back Better.
Right. I think, Adam, ironically, if they put fewer things in this bill, it might actually get more support, because one of the problems that polling showed through the fall and the winter is that many people just didn't know what was in the Build Back Better program. And as somebody who's looked at all the different provisions in the bill, I don't blame anybody for being confused, because it was a real smorgasbord of programs. And some of them were social programs, and some of them were green energy programs, and some of them were pragmatic efforts to help families with childcare. So I think it's fair to say the Democrats did a terrible job on the messaging, because most Americans didn't know what was in that bill. So if you scale it back and it just ends up being green energy provisions and some things to help with childcare, that seems like it's an easier sell to people, and it's also easier to describe. So we'll see how well they do at marketing whatever the new legislation turns out to be. But I don't think it's a bad thing that it might end up smaller and simpler.
Rick, some previous news from this afternoon as well was that Supreme Court Justice Stephen Breyer plans to retire at the end of the current Supreme Court term. What does this mean for the court, and who might ultimately fill this vacancy?
The makeup of the court is not going to change, because Breyer is one of the three liberal judges. They are outnumbered by the 6 conservative judges. So Biden, presumably as a Democrat, would appoint somebody who falls on the liberal side. So it won't change the makeup of the court in terms of political leanings, but it probably will change the makeup of the court demographically. So Stephen Breyer, obviously a white male. Biden has said that at the first opportunity, he will appoint a Black woman to the Supreme Court. And the leading candidate at this point seems to be a judge named Ketanji Brown Jackson. You can call her KBJ. That's the new shorthand we're going to start hearing. She's a judge on the DC Circuit Court of Appeals, and she's well known in legal circles for saying in a filing in 2019, presidents are not kings. That was in one of the many cases involving how much stuff President Trump needed to turn over to Congress for the first investigation into some of the problems there. So she seems like a very strong candidate if she wants the job, and she has already been confirmed by the Senate for her current job. So she would probably be a strong candidate.
All right, Yahoo Finance's Rick Newman. Thank you so much.
Bye, guys.
Coming up, we've got a look at some McDonald's menu hacks. Stick with us.
Okay, so we're going to get McDonald's Q4 earnings before the bell tomorrow, but Brooke DePalma is here with a preview, not only on the earnings, but cheeseburgers in paradise. Brooke.
That's right, Adam. First, let's get to the earnings. Then we'll get to the cheeseburger in paradise. But Wall Street expects the Golden Arches to report an adjusted earnings per share of $2.33 with a revenue of a little more than $6 billion for its fourth quarter results. Now, keep in mind in Q3, the company topped similar expectations set by Wall Street, with those results back in Q3 boosted by strong sales across the board after customers were enticed by new menu items like crispy chicken sandwiches, as well as a famous orders campaign, which included Korean pop star band BTS. Now, as far as expectations for same-store sales go, as you can see here, it's nearly 11% in the fourth quarter. But keep in mind, Wall Street is also keeping a close eye on COVID-19 era trends that may be here to stay. Those include delivery, digital, as well as loyalty. It's been nearly or a little more than 6 months since McDonald's launched its loyalty app back in July, My McDonald's Rewards. So it'll be interesting to see how that's doing now 6 months later as we approach that 1 year mark. But Adam and Emily, on the other hand, analysts are also keeping a close eye on the impact of the Omicron variant, which they did not, which was not fully contemplated into their guidance for this quarter, and also staffing shortages really hitting the restaurant industry at large, as well as commodity cost inflation really hitting the cost and really pressuring McDonald's potentially this quarter. So Wall Street has lots to look out to, but they have high hopes.
Brooke, as we head into this earnings results, McDonald's is also shaking up its menu with 4 menu hacks that have been inspired by its fans on social media. Break down what these are for us and which ones are you trying?
That's right, Emily. So 4 new menu hacks, they're calling it, are going to be added to the menu for a limited time only. They include a hash brown McMuffin, as a sausage McMuffin with an egg, as well as a hash brown that's only available during breakfast hours. The Crunchy Double, which is what I'll be trying. It's a 6-piece chicken McNuggets, a barbecue sauce, and a double cheeseburger, the surf and turf. Now, it's not steak and fish. It is a Filet-O-Fish and a double cheeseburger that's only available on the app, as well as a land, air, and sea. That's a Big Mac, a McChicken, and a Filet-O-Fish. Now, keep in mind, all these menu hacks were created and went viral on social media. So McDonald's took a page out of its fans' playbook, and they added it to the menu, lucky for me. So we are trying the Crunchy Double. So as you can see, that's 6 chicken nuggets, a cheeseburger, and then to top it off, we have their tangy barbecue sauce. So I'm just gonna, look at that. It's not really coming out too fast. So I'll just put a little bit on top to get the hang of it. Oh, yum, guys. Oh, yikes. So now we will close the sandwich. And if you guys want to chat about what you would try on the menu while I take a bite, that'd be wonderful. And I do want to say this is my first time ever having a cheeseburger from McDonald's. So I don't know if this is the right occasion to try it, but let's give it a shot.
We're watching. Just want you to know that your 90-year-old self in the future has emailed us and said, don't do it. My heart is saying don't do it. This is a woman who runs marathons, by the way, everybody.
One marathon, one time, but all right. A mouthful.
Looks
I would
good.
say it's a little bit, it's good. It's a bit of a too much for me, I'll say. The cheese is a little bit cold, which is definitely not helping. But the barbecue sauce does add a bit of a delightful flavor to it. This, I have to say, was only less than $6. So you're getting quite the meal for that price. Don't know if I'll get this for myself again, but it was an interesting and fun new campaign for McDonald's that I'm sure fans will flock for.
Your 90-year-old self just emailed us again and said, thank you, Brooke. The heart is feeling very good. All right, Brooke DePalma, everybody. Thank you. As we get ready to wrap up, let's take a look at where the markets finished today. And we're going to bring Emily on this because, you know, the Jay Powell presser threw everybody into a hair on fire conniption, it appeared, with the Dow closing down 129 points. It had been positive, as had the S&P 500. It closed down slightly today. Nasdaq was positive, though, up 2 points. Was there one thing, do you think, that stood out, Emily?
Well, Adam, I think the one key quote here from the press conference from Fed Chair Jerome Powell earlier today was there's quite a bit of room to raise interest rates without threatening the labor market. So definitely a little bit more of a hawkish tilt in that quote, potentially a little bit more of a hawkish tilt throughout this press conference, but definitely something to take a look at as we head into that next March meeting, Adam.
All right, on tap for tomorrow, we have Southwest earnings before the bell, and Gary Kelly, the outgoing CEO. He's going to be with us live on Yahoo Finance. Be sure to tune in the 10 o'clock hour. We will see you tomorrow. Be well.